Good morning, everyone, and welcome to all of you watching online and on FiOS 1 News. I'm Alexis Christoforous.
And I'm Brian Sozzi, and this is the first trade for Monday, November 4th.
McDonald's fires its CEO over a relationship with employee. We'll look at the changes happening at the Golden Arches and what it could mean for the entire fast food industry.
Under Armour under pressure. The athletic apparel company beat earnings estimates today, but a federal probe is weighing on the stock. We'll dig deep into their problems.
And it's that time of year to evaluate your health benefits. We'll explore what you need to know to choose the right plan for you and your family.
Let's get a quick look at the futures here ahead of the opening bell. Lots of green on the screen. The bull market continues. Dow futures up 165 points. The S&P 500 and NASDAQ also in the green.
We'll get a full check of those markets for you in just a bit. But first to today's big story.
A new era for the Golden Arches is now underway. Chris Kempczinski has been named the new CEO of McDonald's. He was previously the U.S. division president. He replaces Steve Easterbrook, who has been fired for what McDonald's is calling a consensual relationship with an employee. Taking a look at the stock in the pre-market, has been down as much as 3%, down right now 1.7%. Let's break down the details of the shocker with Yahoo Finance's Julia Roche. And on the phone is consumer analyst for Hedgeye Risk Management, Howard Penny. Howard, let me start with you. Is Kempczinski the right guy to be leading McDonald's right now?
Well, good morning. Thank you for having me. So the way I look at it, Chris has two main jobs as president of McDonald's USA. First, he's only been at McDonald's for 3 or 4 years and 2 years as president of the USA. So he comes in with the least tenured executive of McDonald's ever, right? And he has two primary jobs as president of McDonald's USA: grow same-store sales and traffic, right, and keep the franchisees motivated and under control. And in the last 2 years, he has not been able to do either of those two jobs. So why now is he CEO? I have no idea.
Julia, I mean, we see the stock under some pressure here in the pre-market. Looks like Wall Street doesn't have a lot of confidence in him as either.
I mean, just reading through a series of analyst notes, a lot of them were referencing the bear case in the near term because of the announcement. And when you look at Steve Easterbrook, he was well liked by the franchisees, and he was also well liked by the broader investment community. He was basically a lifer at McDonald's, having been there since 1993. I think it's interesting that Howard just pointed out that Chris Kempczinski is one of the least tenured executives, but he did run the U.S. business, which is one of the most important businesses for McDonald's.
Howard, you mentioned Kempczinski's relationship with the franchisees. What does that look like?
Well, so back in November of last year, there was a first ever for McDonald's where they formed the National Owners Association. And this is the first time that McDonald's has ever had this association, and it's not a sanctioned McDonald's organization. So there's a lot of tension within the franchise community, and it was all pointing to Chris as the reason for that. And the big, bold vision of 2020 is the reason for that, and what they're trying to do to the stores and the money the franchisees are spending. So the rumors has sort of been that there's been a thawing of that relationship of late. And so, you know, that sort of has died down. But now that Easterbrook is gone, what does that mean if you now have, you know, sort of the person who was at the center of the franchisee unrest now running a company? So I suspect that we're going to see more from the National Owners Association and more commentary around, you know, the strategy for the company and some of the issues that they all still face, because the numbers, McDonald's business depends on same-store traffic. They call it transaction counts, and 5 of the last 6 years, transaction counts have been down, so they're effectively losing market share to others in the industry, and that has to change. And you're putting a guy in charge of the CEO who's not been able to do that in his entire career.
Howard, a lot of executive changes at McDonald's the past few months. Is this a stock you can own in 2020?
I don't think so. I really don't. I would be. I mean, we're short it today, so I don't believe that you want to own McDonald's.
Easterbrook has been with McDonald's since 2015. Julia, the stock more than doubled during that time. I mean, what do you think investors, can expect here? And might we see some more changes in the C-suites at McDonald's?
Right. Well, to be clear, he's been he's been the CEO since March of 2015, but with McDonald's going back to 1993.
Right.
I wouldn't imagine there would be any changes. You saw some changes. You saw when Chris moved into the CEO role globally, then they brought over the other guy to run the U.S. business. So you've seen those changes for now, but I can't imagine at this point we would see any. I mean, this was one of those kind of things that you don't expect to see coming. It breaks on a Sunday night. Obviously, this was a thorough decision on the board's part to oust Easterbrook because he violated company policy.
Howard, was it good that McDonald's moved so swiftly? I mean, we don't have many details here about this relationship with this employee that they are calling consensual, but was this the right thing to do optically for McDonald's?
So I can second guess the decision that the board made, but why not? Here's one thought that I had around that question. Why not, he violated company policy, so he had to go, right? But why did you have to appoint a CEO today, right? Why didn't you say, okay, we're going to be in a search, or we're going to go into a search for a CEO and maybe appoint him as interim CEO or something like that? But why they just went all in with this guy who really does not have any relationship with the street, if you will, or the franchisees, and they're just betting the farm on this guy. Just like, why not an interim CEO, or why not say we're going to go through a search?
Howard Penny,
it's strange. It's sorry.
No, I think that's an excellent point. I want to thank you so much for joining us via phone this morning. We appreciate it, and I want to continue that point that Howard just made, guys. He could have been interim and sort of see even how Wall Street reacts to that decision, Julia.
I mean, sure, you could have put him in as interim, but at the same time, it's still really early. So we can sit here and determine, is he going to be a good CEO or not? Who knows at this point? Yes, he has big shoes to fill that Steve Easterbrook is leaving behind, but I don't want to completely discount the guy just because of a quick read on him.
Yeah, he absolutely deserves a shot here to leave his footprint on McDonald's. But, talking to some McDonald's insiders last night, his relationship with the franchisees is mixed at best. He's a data-driven executive, and a lot of these franchisees, a lot of the big franchisees, are still relationships-driven. They still do a lot of things on a handshake, and I think that has not jived with Kempczinski's experience, a lot of data-driven, making decisions. So I think he has to reach out to him, and reach out to him even more in a big way.
It was under Easterbrook that didn't they do breakfast all day under his tenure?
Yep.
Interesting to see, and he was also very big into tech, which I think is what upset some of the franchisees.
So I was just thinking of other things that he did under his tenure, but yeah, go ahead.
Yeah, share that with us, because I think he leaves behind quite a legacy for being CEO for about 4.5 years.
Exactly. I mean, quite a big legacy too. I can't even believe it feels like a longer time than it has been going back to 2015, but even just changing the way people felt about how they worked at McDonald's, upgrading uniforms, adding new technology.
Cooking the food better.
Yes. I mean, I'm a millennial. I eat at McDonald's, not going to lie.
Real ground beef in the...
Yeah.
I don't eat beef, but I think it's important, though, to give the guy a shot at this point.
Yeah. I will add this. I met Kempczinski about 2.5 months ago when the McDonald's New York City flagship opened up. Can't wait. He clearly knows the McDonald's business. He knows what he's doing, and most importantly, he understands tech. I think he's the main driver in a lot of ways behind this big delivery push with Uber Eats, and also digitizing the drive-through experience. I think he deserves a lot of credit for that, and hats off to him. Let's see if he gets a job done.
He's a big believer in tech. We'll see how Wall Street reacts.
See how it goes. Thanks so much.
Julia.
Thanks, Julia. Thanks. Let's get down to the New York Stock Exchange and check in with Yahoo Finance's Inez Ferrer. Inez?
Yeah, Brian, Alexis, we're watching Under Armour this morning just tanking in pre-market. So the company reported its quarterly earnings, which earnings, by the way, came in above estimates. Revenue also came in above estimates. The company did cut its full year revenue guidance, but it was already down in pre-market. This is because Under Armour has confirmed that it is being investigated by the SEC and the Department of Justice regarding its accounting practices. This comes on the heels of a Wall Street Journal report over the weekend, and in their statement, Under Armour says that they have been cooperating with investigators since 2017 and that they don't believe that they have done anything wrong, that their practices have been appropriate. We're also watching Sprint this morning, not moving too much on the heels of its fiscal second quarter. Its fiscal second quarter revenue came in below what the Street had been expecting. The company did say that they lost less postpaid phone subscribers than anticipated. Their CEO in their press release says, though, that of course the merger with T-Mobile, he sees this as the best outcome for everyone, for customers, for employees, and also for shareholders. Right now, in pre-market, we're actually set to open at record highs, and President Trump has already tweeted about this, saying the stock market hits record highs. Spend your money well.
All right, thanks so much, Inez. Well, maybe everybody can just keep taking the president's advice there, and consumer spending will continue to be strong. All right, let's take a look now at the European markets, and the rally there continues as well. As you can see, the FTSE 100 up 82, CAC 40 up 65. The DAX in Germany rallying nearly 200 points. Yahoo Finance's Tom Belger is joining us from London. And Tom, we see European stocks now at a near 21-month high. What is fueling this rally?
That's right. There's a lot of hope right now among investors. They're reacting positively to news on Friday of progress in US-China trade talks with all the ramifications for the rest of the world. US officials saying an agreement could be reached by the end of the month. That sparked the biggest rally in global markets since February last year. And the Chinese yuan was at a 12-week high against the dollar. And even in Europe, as you can see, France, Germany, Britain, all of their major indices leaping more than 1 percentage point there. And the European rally is particularly striking as we've had some pretty bleak PMI numbers out today as well. Eurozone manufacturing shrinking and German factories cutting jobs at the fastest rate in more than a decade.
And Tom, what did you glean from Christine Lagarde's first speech as the head of the ECB?
Well, Christine Lagarde's focus seems to be very much to emulate business as usual from Mario Draghi. I haven't seen the speech myself, but she was understood to be pushing for governments to emulate, to share the burden a bit, if you like, with central banks in doing their bit on fiscal policy rather than leaving it to monetary policy to stimulate growth. She won't like those manufacturing figures, though, certainly. The more industry struggles, the more she may feel boxed in by Draghi's negative rates, potentially setting her on a bit of a collision course with some of her governing council colleagues.
Tom Belger, good to see you. Thank you. Elon Musk's SpaceX completes an important test. Your news bites are coming up next.
Welcome back. Time now for today's News Bites. 3 people are in critical condition in Hong Kong after violent clashes between anti-government protesters and police. On Sunday, riot police stormed several crowded malls one day after firing tear gas, rubber bullets, and water cannons at demonstrators across the island. Chinese state media is calling for a harsher crackdown on protesters, with more demonstrations planned for this week. The U.S. and China may be inching closer to signing phase 1 of a trade deal. Commerce Secretary Wilbur Ross met with Chinese Premier Li today at a conference in Thailand. Before the meeting, Ross told Bloomberg that he was optimistic an initial agreement would be signed later this month by President Trump and Chinese President Xi. And several key witnesses in President Trump's impeachment hearings scheduled for this week are expected to be no-shows. 3 White House budget officials, including the acting budget director, have already made clear their intention to skip the hearings, along with the top lawyer for the White House National Security Council, John Eisenberg. The Trump loyalists are refusing to testify, citing the White House's opposition to the inquiry. Well, President Trump could finally do what he's been talking about for more than 2 years now, pull the U.S. out of the Paris Climate Agreement. It would still take a year for the U.S.'s withdrawal from that pact to become official, which would actually be the day after the 2020 election. A new president could rejoin that deal in just 30 days. SpaceX has completed a vital test of its newly designed parachutes. In a video posted on SpaceX's Twitter, the Mark III Crew Dragon landed safely while only using 3 of its 4 parachutes. The company says it has now successfully tested the system 13 times in a row, and CEO Elon Musk has said SpaceX could be ready for its first crewed flight by 2020.
Yeah, that's pretty cool. Coming up here on The First Trade, 'tis the season. The new report that hints millennials will be in hot water this holiday shopping season. And under investigation, what it means for Under Armour's investors now that it's under a federal probe for its accounting practices. Taking a look at the futures here, lots of green on the screen to kick off this week of trading. Dow futures up 155 points, the S&P 500 and NASDAQ solidly in the green. We'll be right back.
Welcome back to The First Trade on this Monday morning. Stock futures are rallying here with Dow futures up 157 points. There is hope that phase 1 of the trade deal with China will soon be signed.
The holiday shopping season is fast approaching. A new creditcard.com poll finds that 61% of credit card holders would be willing to add to their already existing debt this holiday season. Thank you, Jerome Powell, for that one. Here to discuss this with us is creditcards.com's industry analyst, Ted Rossman. Ted, good to see you. Millennials are willing to tack on a lot of debt here. Here comes the holiday hangover?
Yeah, that's for sure. I think a lot of this is because many millennials are parents these days. It's really hard to resist that allure to give your kids a great holiday. So I think that's part of it. We've also found millennials are the most likely to be traveling this holiday season. I think it's still traditional in many households for the baby boomer parents to host. Millennials, often with their own kids in tow, are making that plane or car trek. It's all expensive.
Do they say how they plan to pay off that debt as in the coming months?
Yeah, when people incur debt, they say they're going to pay more than the minimum, which is good. Not many people are saying balance transfer cards, and I think they should. You can still get 0% interest for up to 21 months. This is really unheard of to a lot of people. It's a great deal. Strike now. I fear these could get less generous because of all these Fed rate cuts, but right now there's still some really good balance transfers out there.
What are millennials out there buying? Is it the $500 North Face coats, 70-inch TVs, or really expensive vacations?
I think it's all the above. I think there's also increasingly a lot of kid expenses here, and a lot of that is going on the credit card. If anything, I think these numbers should be higher because so many people already have credit card debt. And we know that when you're in debt, it's easy to get in and hard to get out. 56% of credit card debtors have been there for at least a year. 37% for at least 2 years. It gets hard to separate the holidays 2018 from 19 from 20. That's where you need to pay it off. Get the balance transfer, get the side hustle, cut your expenses. Don't be in long-term debt.
How about not using the credit card? How about layaway plans? More and more stores are actually using them, or take your debit card with you.
Yeah, that's true. There's also all these new point-of-sale lenders, Affirm, Afterpay, Klarna, companies like that. They'll say, well, if you pay it off in the first 6 weeks, we won't charge you interest. It's a slippery slope. There's all these good intentions of, oh yeah, I'll pay it off within those 6 weeks, and then you don't. That's what happens with a lot of credit cards. I hear you on debit. The problem is not everybody can do that. A lot of people already have debt. So that's where I think the balance transfer really comes into play.
Aren't a lot of these millennials setting themselves up for just to be financially clobbered by the latter stages of next year? Rates are probably going to be on the rise, and a lot of these credit card companies, or the credit cards from Macy's, JCPenney, they're adjustable rates.
Store cards have astronomically high rates. A lot of them are 30%.
That's ridiculous.
Or near that. It's crazy. So don't be suckered into those this holiday season. Don't let the cashier pressure you. And to your point on rates, the Fed's cut 3 times now. Credit card rates haven't come down in a meaningful way. Whether we're talking 18% or 17%, you hardly notice the difference. Yeah. It's super high.
And a great point to make about store credit cards. I mean, those rates can be 30%, north of 30%. I got rid of all my store cards.
That's loan shark level.
I have 2 major credit cards, and that's really all that you need sometimes. You're right, you can't be suckered in by you buy today, you open the card, you get 20% off. I'm curious if men and women feel differently about taking on debt during the holidays. Did you ask during your survey?
We did. Men are actually more likely to splurge on the holidays and go into debt. It's men, millennials, and parents were the most likely.
You see this data. What's your read on the U.S. consumer into the holiday shopping season?
People are feeling good. I mean, we see all these predictions about spending is going to be up. I think sentiment is up. You just have to be careful, though. Make sure that you can repay these bills in all climates, not just the best case. Right now, we've been in this long expansion, stocks near record highs, unemployment at a 50-year low. People are feeling good. Just make sure that you don't overextend yourself.
Excellent advice. I hope we all take it. Ted Rossman, thanks so much.
Thank you.
The Traders Expo in Las Vegas is happening Thursday, and Yahoo Finance's Melody Hahn will kick off the opening ceremonies with a fireside chat that's going to begin at 2:45 p.m. Eastern, and you can catch that conversation live on yahoofinance.com as well as on our app.
The opening bell is coming up here next on the first trade. Taking another look at those futures. Pretty strong all morning long. Dow futures up 160 points. The S&P 500, NASDAQ nicely in the green. And here's a quick look at 2 trending tickers right now on Yahoo Finance.
Welcome back to the first trade. We're about 5 minutes away from the opening bell, and stock futures have a nice healthy rally going on here. Let's go around the bell with Brian Levitt, Invesco's global market strategist, along with Yahoo Finance's Jared Blickery at the Wi-Fi Interactive Board. Good morning to you all. And records, guys. Brian, we have the S&P 500 and NASDAQ at records. The Dow poised to hit a record at the open today. How much higher is this market going to go here into the new year?
Well, the first thing I want to say is we shouldn't be surprised about records. So the market hits a new high once every 16 days since S&P came out in 1957. So you hit a new high every 16 days. Indices are not mean reverting. They reflect an improving condition for businesses and humans. And the last 60, 70 years have been consistent with improvements in conditions. So do we go higher from here? Yeah, I think we do go higher from here. There's financial conditions are easy. Investors are not overly enthusiastic. We haven't seen that euphoria that typically ends elongated bull markets. The credit cycle doesn't seem old. So all of these conditions for markets to continue to go higher, I believe, are still evident.
But we can't go up every single day. Is there anything in December that can trip this rally up?
Well, yeah, I mean, I think the biggest concern to this market has been policy. So we get these days where we correct or markets go down when we have uncertainty around trade or whether the Fed's going to continue through with an easing cycle. So you should expect volatility and down days around policy uncertainty. And this isn't going to go in a straight line. We still have to deal with trade. We still have to deal with Brexit. We still don't know exactly what the Fed's going to do. But to me, step back and say, what is the big narrative of this cycle? The big narrative of this cycle is policymakers getting intimidated or forced into do things to support the economy and to support the markets. And I suspect we'll continue to get that.
We had that stronger than expected jobs report on Friday, better than expected manufacturing news. Is talk of a recession at least something that should be on the back burner now?
Yeah, so the recessions don't happen because the cycle's too old. Recessions happen because of policy mistakes, and all the concerns that you had in 2015 and 16 and all the concerns you had last summer or the summer were because of concerns of a policy mistake. And in both instances, policymakers stepped back and said, okay, we're going to do what is needed to support this cycle. So Federal Reserve has now taken off the rate hikes of last year. On trade, we're seeing some incremental improvements, which is helping to moderate the dollar, steepen the yield curve a little bit. So yeah, that is policymakers working to remove the recession fears. I think what we're going to look back on is the summer of 2019 was another growth scare in this cycle, but it's starting to stabilize and improve.
What does a policy mistake look like to you? If the Fed cuts again in December, if they don't cut?
Well, policy mistake, no, the Federal Reserve needs to keep conditions easy. So what a policy mistake will look like is a stronger dollar and a flat or an inverted yield curve, right? So it's not me saying this is a policy mistake. It's the currency market and the bond market telling us this is a policy mistake. In a very slow growth world with inflation not evident almost anywhere in the world, policymakers can do no harm. And any attempt to tighten policy, whether that's through higher interest rates or whether that's through tighter trade policy, is going to weigh on growth pretty meaningfully, and we'll have to go through that whole tightening of conditions again. Strong dollar, flat yield curve, high yield spreads out, equity selling off. Every time policymakers realize that they can't go down this path, then things ease and markets hit new highs.
Jared, over to you at the Wi-Fi Interactive Board.
Lots of green here. In fact, the only two places we're seeing red is in Indonesia and the Nikkei in Tokyo. We have a lot of markets up 1.5% or more. Hong Kong, the KOSPI in Frankfurt, we have the DAX up 1.5%. In London, the FTSE's up 1%. And here in the U.S., futures are above. They're all up over 0.5% here. This is the overnight price action in the S&P 500. And yes, the Dow is probably going to open at a record high. Number to watch is 27,398. We have durable goods this morning at 10 a.m. We have ISM services tomorrow. And lots of earnings that we're keeping track of as well.
Brian, is it as simple enough to say low rates, stock prices go up?
It's simple enough to say that if policymakers continue to keep financial conditions easy in the United States and around the world, then markets should continue to go higher. Because what we have is a very modest growth environment, but it's strong enough to support corporate earnings. It's not strong enough to bring forward meaningful inflation that leads to the inevitable Fed tightening. And stocks are still very cheap to bonds. There's a lot of money around the world looking for a home, and equities still continue to be a better place to be than traditional government bonds.
All right, here we have a new trading week underway at the New York Stock Exchange and the NASDAQ, and it looks like the Dow's going to start the day off in record territory at 27,467, eclipsing its record intraday record high back on July 16th of 27,398. You know, Brian, you said you expect a risk-on rally to the end of the year. What's going to lead us there?
Well, what parts of the market are leading us?
Yeah.
I mean, you're getting a bit of a cyclical rally right now. The more value-oriented parts of the market are going to do well, and that's all because things had gotten so dire and sentiment had gotten so weak in the summer that we're recovering off of those extreme levels. I don't think that that's necessarily sustainable. So I think investors should expect a more value-oriented market right now, but ultimately we're going to get back into this slow growth world where investors are going to pay premium for true growth companies wherever they can find them in the U.S. or around the world.
Are we watching a bubble inflate in the stock market?
No, I wouldn't call this a bubble. I mean, bubbles the characteristics of a bubble is an extreme deviation from fundamentals. I don't think we're there. I mean, price earnings are a little bit elevated, but not extreme. Usually you have this type of euphoria build. We're nowhere near euphoria. I mean, people still love bonds, right? We still have more money going into bonds. Last year, more Americans played the lottery than invested in the stock market. Your odds in the lottery are 1 in 200 million. I just told you the S&P 500 hits a new high every 16 days. So that doesn't make a lot of sense. So no, I mean, I think people use the word bubble to suggest that markets are overvalued. I think that that's kind of dangerous to conflate the two. Is the stock market overvalued? I guess a little bit compared to its historical average. Is it particularly overvalued given the interest rate and inflation environment? No. You know, an earnings yield on the stock market of 4.5% to 5% compared to a 10-year Treasury of 1.8. That doesn't seem.
Well, what's the probability that Jerome Powell comes out in the next few weeks and probably maybe he's not comfortable with valuations at these levels and talks back the market? He has done this before.
He has done it before, but I think what the Federal Reserve, you know, what ultimately we need to watch from the Federal Reserve is what is happening with inflation expectations, what is happening with financial conditions, what's happening with the currency. So the Federal Reserve can make some comment about valuations, but the reality is every time they attempt to get too tight, whether through the power of the mic or raising rates, dollar up, conditions tighten, and inflation expectations down. And inflation expectations down is not price stability, and it is in their dual mandate to maintain price stability. So they may want to talk tough on valuations, they may want to think that they can put some rate hikes in again, but the reality is the bond market's not having it, and inflation expectations isn't having it.
Nope.
Record day for the Dow, at least for now. Jared, what is leading that index higher today?
Yeah, lots of green on the screen here. We have Apple up 0.5%, so is Microsoft. In fact, the only place we're seeing a little bit of red was P&G. That's down about 0.25%. Our parent company, Verizon, and then McDonald's with its CEO troubles, that's down as well. But I just want to take a look at the sectors, and we'll see what's leading today. We got energy and materials, but let's take a look at the year to date. One of the characteristics of this rally is just the incredible breadth that we have. We can see 8 of the 11 S&P 500 sectors are up over 20%. So we have tech up the most with a whopping 37.5%, industrials, real estate, communication services, even financials up 23%. To the downside, we just have energy, healthcare, and materials up less than 20%.
Well, Brian, when you're picking stocks and you're selecting stocks and studying companies, how important is corporate culture? What grade do you put on corporate culture? I look at the news from McDonald's today, not good for many shareholders, but it shows that the board is getting the job done and it's doing its gig.
Yeah, I mean, I think corporate culture is very important. But you know, we need to think of it in terms of a bigger story around the narrative of these companies. So culture is certainly important, but we also need to, I mean, this is an environment where the market is favoring true earnings growth companies. So culture matters. Culture tends to drive, you know, innovation and true earnings growth. But so it's not everything, but it's certainly part of the bigger picture.
And certainly that earnings recession we were hearing has not materialized, at least not yet, right?
No, I mean, you had a slowdown in growth, and that slowdown in growth led to expectations on earnings to be, you know, perhaps negative for the quarter. Expectations tend to get too low, so then businesses are able to surpass it. And usually you see these notes, 75 to 80% of companies are beating an earnings expectation. So that isn't a big surprise. I think the big story is we did have a slowdown. We had a slowdown in earnings growth as a result of weaker economic activity globally. That was all driven by bad policy. And as we step away from that, we find that, well, companies were even able to do okay in that environment and should start to do better as policy improves and growth stabilizes.
Jared, back to you.
Yeah, we're looking at the NASDAQ 100 heat map here, and a lot of companies with China exposure or outright Chinese companies at the top. We have NetEase, Baidu, JD.com, and Ctrip. They're all up 2 to 4%. And then we have a bunch of chip stocks. We have Micron, Texas Instruments, Microchip, and then all of those are up over 2%, as is Walgreens Boots. And to the downside, we have Activision, that's down about 1.25%, and then Starbucks off 0.75% here.
You know, Brian, why isn't the global growth slowdown and the weakness that we saw in manufacturing, why isn't that trickling over into our labor market? And do we need to be fearful of that in 2020?
Well, that was obviously the next step. So businesses not understanding the rules of the game in trade had slowed down CapEx significantly. So you're not going to invest if you don't know the rules of the game. Ultimately, when you stop investing, at some point you need less labor to support your business model. So that would have been the inevitable next step. I suppose we could have gotten there, but policymakers seem to be taking the necessary steps to alleviate some of those concerns. So will we get there if manufacturing stabilizes and economic activity starts to pick up in the first quarter? Unlikely.
When you talk to clients, do you sense or do you get that sense of fear of missing out, aka FOMO?
I get a little bit of both. I mean, so we all have a little bit of FOMO, but I think a lot of people are also saying this has been going on for too long. And at some point, things that go on for too long have to end. And to me, that's not studying what long-term secular bull markets look like. I mean, long-term secular bull markets could go on for 14, 15, 16 years, and they start in despair and they end in euphoria. This one certainly started in despair. If we date it back to 2009, is it euphoria yet? No. So I wish more investors would have FOMO. I mean, still a lot of money in cash and a lot of money going into bonds. Maybe some of that is the demographics of this country. I get that, but we probably need a little bit more FOMO. I think when everybody gets over their fear of missing out and gets involved, that's probably when we have to start thinking about this cycle ending.
You say it's too late to play defensive at this point, right?
Yeah. I mean, the time to be defensive, I think of everything based on the bond market and the shape of the yield curve. The time to be defensive was when rates were going down to 150 and the yield curve was flattening and even inverting for a brief moment of time. When you have a better policy mix that has long rates going up a bit and some steepening in the yield curve, well, that is the time to be defensive was over. That when the yield curve is steepening, that's the time to favor the more cyclical parts of the market, and that's why we're seeing things like industrial and energy and materials, winning the day today. I mean, at some point, we'll have an economic cycle, and there'll be another point to be defensive again, but that doesn't seem to be the case right now.
No bubble out there, and the bull market rages on. Brian Levitt, always good to see you.
Nice
Jared
to see you.
Bluegreen,
Thank you.
Let's get back down to the New York Stock Exchange and check in with Yahoo Finance's Inez Ferrer. Inez?
Yeah, Brian, a nice rally that we're seeing right here. We're looking at the Dow that's up at 145 points right now. The S&P and the NASDAQ also higher. And we're watching Fiat Chrysler this morning, seeing a little bit of a pop after receiving an upgrade at KeyBank. Also, over the weekend, Reuters reported that Fiat Chrysler and Peugeot are hoping to sign that merger deal that they had talked about as early as in early December. Also, we're watching Harley-Davidson. This is after the stock received a downgrade to underweight from sector weight at KeyBank, and with a price target of $33. This is over concerns of an increased competition, and also saying that the company has continued pressure on Road Glide, which represents about 15 to 20% of Harley's U.S. retail sales. And then we're watching Tesla, not moving too much after the news that the NHTSA has sent a letter to Tesla in late October requesting some information regarding their battery software updates for some of the models of the S and also the X vehicles. The letter cited some claims that those updates were put in place in response to an alarming number of car fires worldwide. Now, we did reach out to Tesla for a comment. We're still awaiting a word from Tesla regarding any comment about that letter. there. Alexis, Brian.
All right, thanks a lot. Inez down at the New York Stock Exchange. Oil, meantime, holding its gains as we kick off a new trading week. Yahoo Finance's Jared Blickery is back at the Wi-Fi Interactive board with our commodities report. So, Jared, what are oil traders watching this week?
Well, we're watching a nice price increase, and we've built on that over the last hour. We'll take a look at the overnight price action right here. You can see we started off slightly in the red around midnight, but now we just steadily climbed throughout the night. A lot of the positive news with respect to trade, especially the U.S.-China Phase 1 that's expected to be signed, that's lifting expectations of global growth, and a lot of fear is easing out of the market. So let's take a look at a 3-month candlestick chart here. This is something that we've been watching for quite some time. As this pattern develops, this trend channel is still holding. We reached the lower end of it last week after reaching the upper end of it the week prior, and we're steadily climbing higher. Now, 57 is a resistance level, but we could get as high as 58, 59 and hit that trend channel in there. Going back to crude oil here, there we go. Guys?
And Jared, here comes the Aramco IPO. I know we've been looking forward to it all, well, past 3 years.
Yeah, the past 3 years, that's all we've been talking about. But it looks like it's finally here. They're getting their paperwork in order. And we have a bunch of valuations. The Saudis wanted $2 trillion. Goldman possibly thinks that it could go higher than that. But most valuations are coming in between $1.2 and $1.5 trillion. This would give them a dividend yield of about 5.7%. That's in line with a lot of other oil companies. And they have promised that they're going to give a dividend over the next 5 years of $75 billion minimum. And so that is helping investment demand. And they're only going to sell about 1% of their shares in the open market so far. It's going to be that listing next year that gets most of the shares.
All right, Jared Blickery, thank you. More now on Under Armour. The company reporting third quarter earnings one day after revealing that its accounting practices have been under investigation for the last 2 years. Yahoo Finance's Julia Roche is back with us. Julia, just looking at this quarter, this was just not a good quarter for Under Armour.
It was not a good quarter, but it was better than expected, with earnings coming in at 23 cents per share, beating expectations, Brian, of 18 cents. Yeah. And then the revenue was actually in line. It was $1.429 billion for the quarter versus expectations of $1.42 billion. But it was overshadowed by this report from the Wall Street Journal last night about two investigations, one from the DOJ and one from the SEC, into the company's accounting practices going back a couple of years, specifically looking at whether or not they were shifting sales between quarters to make them look healthier, stronger. Also, they've gone through they've had three CFOs since 2016 as well, so that's something else to keep in mind.
A lot of different hands on the books.
Also, the other story at Under Armour is the sluggish North America sales, which were declining. They declined 4.1% during the quarter. The bright spot, international, saw some growth of about 5% and now accounts for 26% of their total revenues.
And they also lowered guidance, right?
They lowered their top line revenue guidance to about 2% growth versus previous expectations of about 3 to 4%. And part of that has to do with inventory, specifically inventory for their off-channel distribution. What does that mean? The sales in those outlet stores. And another challenge they're going to face in those outlet stores is actual traffic. Getting people in those stores is something you cover quite often. It's just traffic to stores in general.
And they did highlight traffic continues to be weak. What really caught my eye is the decline in inventory. It was down 23%, which helps them raise a lot of cash. I'm wondering, why are they raising all this cash for?
Well, look, they have a new CEO coming in come January. You have Patrick Frisk, the current president and COO, and he's going to be tasked. Look, they've been going through a transformation, turnaround for the last 3 years or so while he's been on board. But what is the company going to be like going ahead? Kevin Plank says they are going from defense to offense. So maybe this is a way for them to play some offense. What are they going to do? What is their innovation pipeline going to look like? What are the products on the shelves going to look like? Yes, they're focused on performance, but are these going to be things, shoes, garments that people want to actually wear? Because right now you're seeing footwear down 12%.
And they're wearing a lot of Nike. That was a big quarter from Nike a couple weeks ago.
Well, fashion and performance, guys.
The new CEO's has his hands full, put it that way. Julia LaRoche, thanks a lot. All right, the Federal Reserve did the expected last week and cut interest rates by 1/4 point, but are lower rates really the best way to boost a slowing economy? Well, joining us now to discuss this is Yahoo Finance's editor-in-chief, Andy Serwer. Hey, Andy, you actually wrote an article on our site right now about this very thing. So do rates really matter at this point, especially when they're this low to begin with?
You know the phrase, pushing on a string?
Yeah.
I think we're there. And rates now are so low that you have to ask yourself. Ask yourselves as consumers. So in other words, you've got mortgage rates at, say, 3%. and now it's going to go to 275. Is that really going to make you jump?
No.
Right.
No.
I wouldn't think it would be decision changing for
Exactly.
somebody.
And it's actually interesting when I mentioned pushing on a string because it refers back to a time when there was some congressional testimony in the 1930s during the Great Depression, and that's the first recorded instance of it being used, saying we can't really do anything here by lowering rates anymore. So what happened back then? Fiscal stimulus, in other words, the New Deal, and the government began huge spending programs to boost the economy. I think there's a very good chance we may be looking at that. Maybe not this year, not next year, but at some point to actually spur growth again, I think we're going to be looking at some big programs.
And as big as the New Deal?
No, I mean, the New Deal actually accounted for 40% of GDP. I mean, it was just massive. But there are other places to look when it comes to spending programs like this, which is China, of course. And, you know, ask yourself, do you know what interest rates are in China? People just don't know because they don't depend on rate manipulation, if you will, or rate management, I should say, the way we do. They have obviously been spending tremendous amounts of money on infrastructure projects, which, by the way, you guys, help the country develop in a huge way, and they would certainly help us. The last airport we built here was in Denver in 1995.
There's a lot of potholes where I live.
Right.
We kept talking about an infrastructure plan, really haven't gotten a comprehensive one yet from the Trump administration.
Yeah, and what happens here, everyone says they're for infrastructure plans, Alexis, but a lot of times what's happened, quite honestly, is that the senators and Congress people in red states don't like it because they're programs that are in blue states. So we're going to have to get around this political infighting and maybe get it going. But keep your eye on this one going forward over the next couple of years.
Andy Serwer, great stuff. Thank
you.
Hoping for a stock bump because of a chicken sandwich? Your companies and stocks to watch are coming up next.
Here's another look at those markets. We have the Dow, the S&P, and the NASDAQ all in record territory today on the hopes that a trade deal, at least phase one of a trade deal with China, will soon be signed. We'll be right back.
Welcome back to the first trade on this Monday morning. Lots of green on the screen. Pretty good way to kick off the week. The Dow is up 144 points. The S&P 500, NASDAQ solidly in the green.
Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. A rough second quarter over at Sprint. The company reported a loss of $274 million. That is a major miss after reporting a profit the same time last year. Sprint CEO tried to reassure investors, saying that he's convinced that merging with T-Mobile is the best outcome for consumers and shareholders. Ferrari has raised its earnings forecast thanks to a strong third quarter that included a 9% increase in deliveries. Europe saw some big growth for the sports car maker. Deliveries there were up by double digits. In the Americas, deliveries were flat and dropped 2% in China. Boeing is working with 3 U.S. carriers as it prepares to bring its 737 MAX jets back into the air following 2 deadly crashes. American, United, and Southwest Airlines are all planning test flights without passengers as a show of confidence that the planes are functioning properly and safely. It could be a month or more before the 737 MAX jet is cleared to fly again. And Popeye's legendary chicken sandwich is back after first launching in August and quickly selling out. And a lot of folks, well, they spent the majority of their Sunday waiting in line for one of these. This time around, Popeye said that the chicken sandwich will be around for the long run. And the restaurant is, quote, confident they'll be able to meet demand. Arnold Schwarzenegger is back and not making a splash at the box office. The 6th installment of the Terminator series debuted with a disappointing $29 million in North America. But Warner Brothers' Joker continues to be a force at the box office. The blockbuster is expected to break $1 billion in box office sales. And those are your companies to watch for this Monday, November 4th.
Open enrollment is upon us. What you need to know to protect you and your family. That's coming up next. It's that time of year again. Open enrollment for health benefits started last Friday, and there's some major changes coming. Here to break down some of those changes is David Reed, the founder of Ease. David, good to see you. So what are some of those changes, and are costs going higher?
Thanks for having me. And yes, it's a typical year in healthcare that costs are going to be increasing this year. It's more modest than we've seen in past years, around 5%. But because this is so expensive to begin with, and 5% is a higher increase than most of us receive for a cost of living increase, it's going to make sense to pay attention this year because there's going to be a lot more choices offered by employers. In the past, we typically seen a high deductible paired along with a health savings account, but the changes are going to be much broader this year. You're going to see many more choices as far as deductibles, coinsurance, and specialty plans. So it's careful planning is important. But the good news is these things hit home for most people. So if you break it down, it's simple. You need to decide whether or not you want to pay a higher premium to have a lower deductible or a lower premium with a higher deductible is the basic decision to start with. And it really depends on your family. Use 2019, though, as a guideline and look at how many times you went to the doctor's office or what type of prescriptions you're on. And while you might be associating the cost of a prescription or a doctor's visit with your copay, it could be very different. And your pharmacist or your physician in your health plan can tell you what these actual costs are. So you can weigh that out to choose whether or not you'd like to set money aside in a savings account and choose a lower cost, high deductible, or if you'd like to spend a higher premium amount to cover these costs. Now, if the answer is no, and your costs out of pocket are going to be a little lower than what you expect them to be, and you say want to gamble a bit, the choices are out there to give you other ways to cover those risks. For example, your employer may offer a gap-type policy to insure the deductible. Or you might find that your employer offers specific voluntary benefits for accidents or critical illness, where instead of insuring everything, you can target just the needs that you see in your own household. So the question is, what is right for me? And you might even find this year, with new laws. Employers are broadening out their options and actually allowing employees for the first time, if you can find an individual policy that you like better than your employer's plan, to actually use your employer's contribution to help pay for that individual plan. It's a new law. Look for it because it's brand new, is starting in January 1st of 2020.
David, I'm going to jump in here. Is that law state by state? And if your company doesn't offer it, you think you should go ahead and maybe talk to your benefits department about offering it?
Absolutely. It might be a little bit late for 2020, but the answer to the question is this is a federal law. It's known as an individual contribution health reimbursement arrangement, known as an ICHRA. Look for it. You're going to see a lot of this coming out in 2020.
David, with regards to the higher costs, are employers eating these costs or just dumping them on the laps of employees?
Little bit of both. It's a tight job market, so we're seeing employers step up and cover a lot of these cost increases, and also offering a broader selection of benefits to help them reduce costs and target employee needs. But as an employee, you should definitely expect that you're going to have to share a little bit more in costs this year.
And what's the number one thing you should be asking yourself, you should be asking your family when you're trying to decide whether or not to jump into a plan?
It's not just price. You're making a decision for your family's access to health care. The other thing that's very important to look at is your selection of providers. Make sure that if you're choosing a lower cost plan, you are able to see the providers that you and your family want to see.
All right, David Reed of Ease, we're going to leave it there. Thanks for some really actionable information for our viewers.
Thank you.
And that's going to do it for the first trade for this Monday morning. I'm Alexis Christoforous.
And I'm Brian Sazi. Enjoy trading this news-filled Monday. Now let's get one more check of the markets with Inez Ferre down at the New York Stock Exchange. Inez?
Yeah, Brian, Alexis, we're looking at the Dow that's up about 140 points, with the Dow hitting an all-time record high this morning, being led by energy stocks. Those are seeing gains today, as well as financials and industrials. We're watching Under Armour. That's the worst performer on the S&P 500 this morning, under pressure. Their revenue and earnings for their latest quarter topped estimates. The company did cut its full-year revenue outlook, but you're seeing the stock under pressure after the company confirmed that its accounting practices are being investigated by the SEC and also the Department of Justice. Their statement came out after a Wall Street Journal report over the weekend, and in it, Under Armour says that they have been cooperating with investigators since 2007 and that their practices have been appropriate. And we're also watching Papa John's this morning, a little bit under pressure, down about 3%. This is after Jefferies cut the stock to a hold with a price target of $58. And then we've been watching Fiat Chrysler, seeing a little bit of a pop after Fiat Chrysler was raised to buy from hold at HSBC. There was also a Reuters report over the weekend that Fiat Chrysler and Peugeot are hoping to sign a merger deal by as early as the beginning of December. Make sure to stay with us. Wi-Fi AM starts right after the break.
Good morning and welcome to Wi-Fi AM here on this Monday morning at Yahoo Finance, the start of a new week. I'm Dan Roberts. We've got Julia LaRoche and Brian Chung here on the couches. The markets are up. Let's take a look on your screen. All three major indices right now in the green. The Dow is up 140 points or 0.5%. After some positive earnings recently, but this morning we have a downgrade to McDonald's stock from Piper Jaffray after a shocker over the weekend. McDonald's fired its CEO Steve Easterbrook over quote-unquote inappropriate conduct in a consensual relationship with an employee. The stock right now, you can see, is down 2%. McDonald's did name already a new CEO. It's Chris Kempczynski, who was the U.S. president. He will be the new CEO. Now, Barclays, in a note out this morning, finds a bright side to the news. Barclays says, while the transition was unexpected and therefore not a good thing, the change was not due to operational or financial issues, but rather personal conduct. But man, a bombshell report over the weekend and McDonald's ousting its CEO. Julia, I know you wrote up the story when this news came out. What are people saying about this? And my first reaction, I mean, this is a story that I think will continue to be discussed, not just because of McDonald's, but the broader picture, because it's interesting. It was a consensual relationship,
right,
but violated company policy.
Well, and look, if you have a company policy, you can't have exceptions for who violates and gets away with it and who doesn't. That is just the standard code of conduct at McDonald's. And so this sets the tone at the top. And Steve Easterbrook, he was basically a McDonald's lifer. He had been there since 1993, held so many different roles, started as a financial manager in London. I know he was a restaurant manager at one point, ran the UK operations Europe, then was running the global business. And under his leadership in the last 4 years, going back to March of 2015, you saw just this tremendous rise in the stock, same-store sales increase, kind of the workplace culture transform, like to be a better workplace using technology. Also, all-day breakfast, guys. Very well liked amongst the franchisees, well liked amongst the investment community. So definitely a surprise. But at the same time, if you have the code of conduct and the leader breaks it, you have to have consequences.
I think we need to understand there's still a lot of details that we don't know as well. McDonald's kind of explanation of all of this was fairly thin.
You're kidding.
Well, but also what we do know, so we do know that it was a consensual relationship, but why does that raise red flags? Well, I mean, it could definitely be the optics of a CEO maybe using that relationship over a subordinate, someone that would be reporting under him because everyone is categorically under him as the CEO, and whether or not he used that to try to leverage powers, whatever, and what have you. We don't know the details of that. We don't know who it was that was involved in this, and I think that it's kind of on McDonald's to also explain how early they knew this as well. We don't know if this was something that they uncovered months ago. Did the board of directors act quickly enough? Those are all details that we don't know.
McDonald's would like the story to just go away, please.
Exactly.
Can I just ask a question that I assure you most readers had right away when they saw the headlines? Was Steve Easterbrook, or is Steve Easterbrook, married?
He's divorced. He's divorced with kids.
Okay.
He's British, also, just putting that out there as well. Not that it matters, but he's a British.
It's good to have biographical information. Yeah. It's interesting. You know, it's interesting because I think people will ask, well, is there no consensual relationship that is allowed in the workplace anymore if one party is above the other?
Or do you have disclosure rules that when you have relationships? I know in certain media outlets, if you're dating someone who might be in a beat that you're covering or at another rival, sometimes you have to disclose that.
PR person for a company you cover,
Yeah, and again, but I think it's all, every company has a slightly different policy, the way that they spell it out. And I think in McDonald's case, they said pretty clearly, hey, this is our policy. You are the CEO. You violated it, and we have to let you go, as is the policy with any other type of employee. But, you know, I think an interesting point that you raised, too, just about whether or not the standard at McDonald's is the same in other companies. Maybe we should be applauding McDonald's for reacting like this. But again, we don't know about how long they knew about this relationship.
We're going to find out. The stock right now down 2%. Let's talk about another company that is very much in trouble. Under Armour reported its Q3 earnings this morning. It actually beat expectations on earnings per share, although it missed on revenue. But the stock right now down 13%. And that is mostly because of news that broke over the weekend that the company is facing a federal accounting probe and allegedly inflated some of its numbers. Now, Under Armour had major upheaval in the CFO role. So speaking of accounting, it had 3 different CFOs between 2016 and 2017. And of course, there was news just about a week ago that CEO Kevin Plank is set to step down as CEO on January 1st. Joining us to discuss is Deb Gaber of Soul Marketing, joining us from Texas. Deb, let's start with the brand image here. I know that you are an author that have written about brand and marketing. So a lot of people think that one of the big problems for Under Armour is its brand, and worth mentioning that sales in North America, Under Armour's home turf, have fallen for 5 consecutive quarters.
Yeah, absolutely. So the Under Armour brand image has really taken a hit over the last couple of years. They've been really unable to pick up on the trend of athleisure that has been led by brands like Lululemon and frankly Nike and Adidas. The brand has largely fallen out of favor with teen boys who are the arbiters of what's cool in the athletic world. And so the brand image has been tarnished. A lot of product in discount outlets like TJ Maxx and other discount stores and things like that go towards devaluing the brand. So the brand itself is out of favor. I guess I want to say, there's a couple of other things that would impact the brand as well, because no longer is branding just the outward articulation of what the brand stands for with regard to the products it sells or its retail experiences. The brand is kind of the sum total of everything the organization does as a company. And so this is a company that's been plagued by allegations of misconduct, the strip club scandals among management, now, being investigated by the SEC for potentially illegal accounting practices and things like that. So a lot of impact from the brand side and an inability to really sort of connect with consumers at a meaningful level.
Deb, it's Julia. We have a new CEO coming in the new year, Patrick Frisk, who's been there as president and COO, also previously led the Aldo Group, that well-known shoe company. Do you think he can bring the right change to the brand, and how do you see him bringing that change?
So I don't really know. I don't have a crystal ball, and I can't predict whether or not he's going to bring the right kind of change to the brand. However, if he is going to bring change to the brand, it needs to be systemic. It needs to be throughout the entire organization, really understanding who they are for, how they can be meaningful to that audience. Interestingly, they've said, actually, Kevin Plank and Frisk together have said that they're doubling down on their core customer who is a performance athlete. I just don't know if that's a big enough market for them to really make a difference. From a brand perspective, they need to really understand, who is their core customer? How can they be meaningful to them? How are they either going to deposition competitors and get closer to a core customer, or how are they going to play along and make the brand meaningful? And then also, I think a lot of, just sort of cleaning house with regard to policies and how every single person in the company, from the top all the way down to the bottom, is delivering on that brand promise. The story right before this about the McDonald's CEO, really sort of underscores that a brand is sort of like a person these days that has a set of values and beliefs, and they have to use those values and beliefs as a magnet to attract customers and vendors and retailers and partners and employees. And, in order for Frisk to be successful in his role, he's going to really need to treat the entire strategy from a brand-centric perspective to make sure that everyone in the company is sort of marching in the same direction with the brand, regardless of the position.
All right, Deb Gabor, thanks so much. The new CEO of Under Armour certainly will have a lot to fix come January. Thanks for joining us.
Great. Thank you.
Well, the U.S. and China might be inching their way towards signing that Phase 1 trade deal finally. This is based on some new optimism from Commerce Secretary Wilbur Ross. Jess Smith is live in Washington to give us an update on the comments from Ross and the reaction in D.C. Jess?
Yeah, Commerce Secretary Wilbur Ross says he is optimistic about getting Phase 1 of this trade deal done. He is in Bangkok for an economic summit, and at that meeting on the sidelines, we know he met with a Chinese official. Before that meeting, he did an interview with Bloomberg, and he says negotiations are in good shape, negotiators are making progress, and he said there's no reason why it couldn't still get done this month, but he did hedge a little bit and say there is always the possibility that things slip up a little bit. He said there is not necessarily an obstacle in the way at this point, but he says both sides are trying to make sure they have a clear understanding of what exactly they are agreeing to. Now, President Trump and President Xi were supposed to meet in Chile at the APEC summit, but now that that's not happening, it's not clear when and where this could take place, where the two leaders could meet to potentially sign this deal. The Trump administration has floated Alaska, Iowa, Hawaii as some locations that could be possible, but negotiators are still trying to work that out. So that's something that we're watching. And Ross also made some comments about Huawei. He said licenses for U.S. businesses to be able to sell products to Huawei should be coming shortly, but he would not elaborate on when exactly that could be. Dan?
Jess, I'm just curious, for us here on the couches, almost every few days we hear that some official in the administration is optimistic that the phase one trade deal will be signed soon. So I feel like we've been burned before. I mean, I remember it was already 2 or maybe even 3 weeks ago that President Trump tweeted and said it was about to be signed, and then, well, not quite yet. And then last week, the president said, we're 60% of the way there. What do you make of that progression? I mean, I feel like there's a lot of skepticism when we get these reports that, it's coming soon.
Yeah, there's definitely a lot of skepticism because this has dragged on for so long. I think that people are a little more optimistic that phase one could get done, but once you get beyond that, phase 2 or phase 3, I think that is going to be a lot more difficult, and people are very skeptical that that would happen because, just both sides haven't really given very much to get to that phase 2 yet. So that's, I think, where there's the most skepticism in this.
Yeah, before we can even think about phase 2 and 3, let's see if phase 1 gets signed. Thanks, Jess.
Of course.
Coming up on the show, we will talk Bitcoin after new reports that one single whale is responsible for that big price surge at the end of 2017. Welcome back to Wi-Fi AM at Yahoo Finance. Let's see what markets are doing on your screen right now. The Dow up about 130 points. Hasn't moved too much in the last few minutes, but all 3 major indices are in the green. Let's check in with our friend Ines Ferre, live on the floor of the New York Stock Exchange for more. Hi, Ines.
Hi, Dan. Yeah, energy, financials, industrials, all those stocks are leading on the upside. And we're watching this morning Fiat Chrysler seeing a little bit of a pop. This is after receiving an upgrade to buy from hold at HSBC. Now, you'll recall that earlier last week also, Commerce Bank had raised Fiat to a buy from hold. Over the weekend, Reuters reported that Fiat Chrysler and Peugeot are hoping to sign a merger deal by as early December. Last week they had announced that they're planning a 50-50 share merger, and analysts are really seeing this as the Peugeot shareholders taking on a little bit more risk, market risk, than Fiat Chrysler. So you're seeing Fiat Chrysler seeing a bit of a pop on the heels of that upgrade from HSBC, and also the report over the weekend that that merger deal could be signed in early December.
All right, thanks, Ines. We'll check back in with you very soon.
Thank you.
Well, investors remember well when the price of Bitcoin surged to an all-time high near $20,000 at the very end of 2017. Now, a new study from a finance professor at the University of Texas says that the entire price surge can be traced to one whale using the stablecoin Tether on the exchange Bitfinex. Now, an earlier version of this same study came out over a year ago that concluded the price surge was due to Tether, but it had not connected the action to one single whale. That is the part that is new. And Bitfinex and Tether have the same owner, by the way, and are being investigated investigated by the Department of Justice. Now, we are watching the price of Bitcoin right now. And for more on all things crypto, we've got Guy Hirsch, who is the U.S. Managing Director of eToro. Guy, thanks for coming on.
For sure. Thank you for having me.
I want to talk about some news with eToro, but let's start with that manipulation report. And a lot of controversy for over a year now about Tether and how traders might allegedly manipulate the price of Bitcoin using Tether. What do you make of all that?
I think it's still in its infancy in terms of understanding how prices work in terms of crypto and Bitcoin specifically. We're definitely looking a close look at that and trying to understand how to not be vulnerable to price manipulation. But the whole, I would say, asset class is still new. It still doesn't have any fundamentals. It doesn't have any kind of core metrics that we can all agree on in terms of price movements and evaluation. So I think it's still early, but this research is really important, and we're definitely taking a look.
And of course, sentiment is so important in this market. And when you see headlines like this about price manipulation, I think probably the problem for the industry is that people who already think Bitcoin is shady and they don't want to touch it, this kind of fuels that belief. Now, you guys have just announced a new feature where you track crypto sentiment on Twitter, which is really interesting. Tell us about that new feature for eToro.
Yeah, so we've launched something called the long-only kind of crypto sentiment portfolio on eToro. And what's really cool about this is that we've partnered with this company called The Tie, and The Tie are digesting 850 million tweets per day using their partner Social Market Analytics, and then they go through a process to distill tweets that are not coming from bots or are not trying to manipulate the conversation.
Which a lot of those tweets are on crypto.
Correct.
Twitter.
So after that process, they remove 90% of the tweets associated with crypto, and they are scoring each individual word in a tweet, and then they score the entire tweet, and then they make it actionable towards a strategy that we have backtested and saw that it actually beat the benchmark or even Bitcoin in and of itself. So if you had invested in this strategy as of October 2017, by June 2019, that portfolio would have returned 281%. Versus Bitcoin that returned about 150% during that same time period. So we've got convinced that this is real, that there's science behind it. Also, they have been doing these things on equities for years and years now, and have been serving hedge funds, the biggest hedge funds with the same kind of tools and capabilities. And eToro are all about kind of democratizing access to wealth management, democratizing access to the best tools available to hedge funds. And so we were excited to launch this and let people have access to it.
So Guy, what's the kind of use case for a crypto sentiment kind of based exchange? I mean, I'm wondering, based on your kind of the first answer that you had, it's still kind of fluid right now about what the proper way to measure volatility or pricing within crypto assets really should be like. So from that perspective, is this something that you could tweak the algorithm in the future to incorporate maybe more than just tweets? And if so, maybe how would you create that?
So I would say yes. We are definitely looking into advancing and proposing algorithms or algorithmic way to trade this asset class that are based on signals that have been proven to be at least correlated with price movements in crypto. So going back again to equities have decades of understanding how they work and evaluating prices. In crypto, it's still early. We saw that there's a very good indication to the fact that Twitter sentiment or Twitter mentions are correlated or are indicative of price movements of crypto assets. And therefore, we got convinced to list this strategy on the platform. I believe that in the future, we will see more and more capabilities looking at different things. For example, movements in teams, forks, things of that nature, things that are happening around a specific project that help, in a back-tested way, help predict how the price would move of a particular cryptocurrency.
Which, of course, a lot of the tweets have an impact on price, because I would think a lot of the tweets come from people who want to see those coins go up. So they're tweeting, a Binance coin because they are invested in Binance coin. But it is a very interesting concept. We've got to wrap there. Guy Hirsch, thanks for coming on.
Thank you.
Check back in with you soon. Thank you. Well, our colleague Melody Hahn will be at the Traders Expo in Las Vegas at 2:45 p.m. Eastern on Thursday. She will kick off the opening ceremonies there with a fireside chat. And we want to let you know that you can catch that conversation live on yahoofinance.com or on our app on November 7 at 5:45 p.m. Eastern. We'll be right back here on Wi-Fi AM.
All right, time for today's trending tickers. The first one is PG&E. The California utility continues to face pressure as the state now threatens to take over the company unless it exits bankruptcy and enacts reform to ensure that its grids won't spark any more fires. Actually, the stock is up over 7%. The Wall Street Journal reported that California Governor Gavin Newsom is asking state officials to prepare a plan for intervening if PG&E can't agree on a reorganization plan, and has asked PG&E to meet with investors and wildfire victims in Sacramento next week to expedite the company's efforts to climb out of Chapter 11. The stock is down, however, 73% year to date. So continued challenges for this company, but it sounds like California really wants them to maybe get this resolved by, sooner than the June date that it originally set, which could be a good thing for investors, maybe.
Yeah, I mean, when was the bankruptcy filing?
I believe over a month ago.
But they've had their troubles going back to the Camp Fire just over a year ago. And I know a bunch of hedge funds have been in this name, or at least got in shortly thereafter. But I gotta say, the optics for this company, I don't know how you proceed going forward. Do you need a name change, some sort of rebranding effort? I mean, did y'all see the press conference with the CEO who said basically we didn't burn any houses down yet? Wait a second, guys. And you're saying tell people to go to food banks when they...
On the bright side.
People are living paycheck to paycheck. Their food's spoiled. It's just... it just didn't sit right.
Well, I think this raises a kind of an interesting existential question, which is that should companies like this that provide a basic service that people need to rely on to survive, whether or not that should be a public or a private company, right? I mean, because this is what California is trying to suggest, is that maybe we should private or
it's certainly a big risk factor when you're a publicly traded company, and that's what you're dealing with.
And when you're susceptible to disasters. Why do you think in so many other countries, oil and gas and utilities, energy utilities are state-owned?
Yeah.
I mean, this is the risk, So, but hedge funds know that when you get into a name like this, something could happen and then it could plummet.
For what it's worth, too, I mean, California, independent of the PG&E grid issues, is definitely susceptible to a lot of natural disasters. But when you have, PG&E admitting, I think 2 weeks ago, that they actually had some faulty power lines around the same time that the Sonoma fires took place, separate from the Camp Fire issue that happened last year, you do wonder, is this going to be a recurring issue? Should PG&E really surrender its assets to the state? Would the state do a better job? I don't even know if that's a definite yes either, so kind of worth watching.
I think one thing, though, is that you need to have humanity when you're leading a company like this, and have maybe he does. It was bad optics, that's for sure, and hopefully they can learn a lesson from that. But you have to be comfortable being transparent and just be human with people,
All right, well, moving on to our second ticker of the day, it's Aphria. The Canadian cannabis company says it has received a license from Canadian regulators for a second greenhouse facility in Leamington, Ontario. The stock up about 0.5%. The company said Monday morning that the new facility will add 140,000 kilograms of annual growing capacity, which would more than double its current capacity. It's been over a year since Canada legalized cannabis, but over the last 12 months, shares of Aphria have been down 58%. So it seems like the, no pun intended, high on all the cannabis stocks that happened after it was legalized last year has really come down, not just for Aphria, for what it's worth, it's for
the broader category.
Aurora and all those others. So you kind of wonder here, I mean, okay, great that they're doubling their capacity. Is the demand still there for these stocks, given what we've seen on the pricing here?
Yeah, I don't know. Can we pull up, what's the stock doing just today? I can't even.
Yeah, so it was up about 0.5.
Okay, so I mean, even people are like, so what?
Right.
I mean,
well, the market has not quite played out the way that everyone hoped.
I was watching 60 Minutes. I don't remember if it was 2 weeks ago, but they were interviewing cannabis farmers in California, totally different location, I understand, but they're basically saying there's like not the demand. There's such a surplus of supply, but not the demand being met. There's a lot of regulations and stuff to be played out. Maybe there's just so much capacity in
Canada, too many players rushed in, and it's like it's on every corner.
I still say this: if it's not like your typical everyday Starbucks habit, I mean, I just don't see the.
That's actually a really good point.
And read every day.
Yeah, I haven't thought about that sort of avenue of discussion. It's probably a whole separate chat for another day. But the idea that they're overbuilding because they're kind of banking too much on it being an everyday thing. It's not. I mean, I know there's some people who smoke weed every day, but other than that, I don't know that you need as many businesses as have opened in Canada so quickly.
And Julie, you make a good point, which is that there's a kind of moving parts here between both the U.S. and Canada, right? I mean, if the U.S. were to fully legalize it like Canada does, then maybe there could be some free flow of goods and production across the lines right now. But okay, great that there's more production in California, but you can't really export that to Texas or to Alabama right now, right? I mean, you maybe to Colorado, but I think in Canada, where it is federally legal, that's great for the Canadian cannabis companies like Aphria, but you can't export any of that production to the United States if the demand is not there in Canada. So I think that kind of brings up a good point about the market.
There'll
movement.
probably be a washout, and then you'll have a few that survive that are stronger than the others. There'll be some consolidation.
But investors clearly not happy, although it was up about 6% pre-market, but it's come down. So.
All right, coming up here on the show, Tesla batteries are under the microscope after a number of fires we will discuss. Welcome back to Wi-Fi AM at Yahoo Finance. Take a look at the markets on your screen because we are seeing green across the board, although the Dow not moving too much. It's been up about the same amount for the last hour. It's up 0.5%. The NASDAQ and S&P in the green as well. But time now to talk about Tesla, because Tesla's batteries are under new scrutiny. That is today's Musk Minute. The National Highway Traffic Safety Administration is looking into potential defects in Tesla's battery packs after, quote, an alarming number of car fires that have occurred worldwide. That is according to a letter the regulator sent to Tesla. The investigation will focus on certain battery management system software updates for the Model S and X that were made between 2012 and 2019, and Tesla has until November 28 to comply with the regulator's request, or it could face fines of up to about $112 million. Now, Tesla is separately still pushing forward on its autopilot feature. The latest update, which is currently being slowly rolled out, now recognizes traffic cones, which is a big development. It can also navigate lane changes around construction work. And some drivers say that autopilot's recognition of cones has been inconsistent in the past, but Tesla is now reminding anyone using the system that they are still required to pay attention at all times. You don't just flip on the autopilot and go to sleep.
Well, there weren't those videos of drivers in California or something like that had been passed out behind the wheel of a car that was in traffic but had autopilot on. It's like, guys, you've got to still have your hand. I think Tesla tells you to actually still have your hands on the wheel. Which, if you have to still have your hands on the wheel, what is the benefit of autopilot?
Yeah, and if you have to take a nap, you need to just not be driving. I'm sorry.
Pull over. Right.
Pull over, yeah.
But I mean, is that,
Well, I think it's because, Tesla acknowledges that the technology is not 100% correct. I mean, what you were just saying is that, even traffic cones might not be recognized.
Maybe it shouldn't be out yet.
Well, maybe it shouldn't be out, but I mean, when you think about any sort of new technology, it never comes out in the fully designed form, with the perfect use case from day one. So I think Tesla acknowledges that, and I think for regulatory reasons too, they want to make sure that they're not. Look, Tesla would never say, "Oh, don't worry about it. You can go ahead and play video games or do whatever the heck you want behind the wheel of your car while you're on autopilot." They still want to make sure that they are giving them some reason to remain vigilant while they're driving.
And then, speaking of this letter from the National Highway Transportation Safety Administration, there are a lot of questions that people have. We keep seeing this, news, social media, like these unexplained fires. And it seems like there was a petition here to get, this letter sent to them, ask these questions. I'm seeing so many different questions about, the design of their software, how they do their updates, these sorts of things. Like, you're basically putting your life in the company's hands when you're driving one of these vehicles.
And the Tesla bulls defend and say it's an isolated number of incidents, but you don't want to see cars lighting on fire.
It's worth also
Each incident has a major deleterious effect.
Yeah, every automaker, when you're churning out very advanced products like an automobile at high capacity, like there's going to be issues. There have been many recalls for every major automaker, so Tesla is not, exempt from that. But I think that the concern is that as a growing company, you have the street constantly demanding them that they meet these production targets. But you do wonder if there's some trade-off at some point for quality, right? And I think the safety is one huge issue there.
It is a monumental task to build a car company.
Yep. Sure. Now, worth mentioning when you say, hey, look, it's a new technology. I mean, Business Week recently in an issue, the cover story, the language was Tesla's autopilot will save a lot of lives, but first it's going to kill some people.
Yeah.
And there's a big debate over whether that's really fair and worth it.
Or right,
to get great technology. Okay, let's talk about Berkshire, because Berkshire Hathaway reported a record high cash pile to end its third quarter. Warren Buffett's company ended the month of September with a cash pile of $128 billion, and it also reported higher than expected operating profit in its earnings. So you wonder now if the recent news, I would say, 2 quarters ago, of the big Kraft Heinz write-down, which led Buffett and Munger to acknowledge that they overvalued that company, is kind of in the rearview mirror now. Julia, I know you cover Berkshire closely.
Is it in the rearview mirror? Maybe for the time being, but I kind of feel like they'll eventually resurface. But other businesses seem to look, a lot stronger. The reinsurance business was up. Railroads look pretty strong. Everyone's always going to talk about Warren Buffett's huge cash pile. What is it now? 128
Berkshire and Apple.
I love that every quarter they're always like, oh, their cash pile is still.
And then you ask Buffett.
What are they going to do with it?
And then you ask Buffett at the annual meeting, and he says, "Oh no, he's waiting for the right company to call him."
Well,
I'm
Kraft
sure
Heinz
that
is not the
phone
right
is
company.
ringing off the hooks.
Yeah.
But right now, guys, valuations are high. Even private markets, public markets, things are high right now.
Now,
what's financials where
hard
they've
to
been
find those
digging
elephants.
in? Yeah.
Yeah, and speaking of financials, what's the update on B of A? Because we know that Buffett petitioned to be able to take a larger stake in Bank of America.
Oh, I don't know the update.
Well, I think there's a regulatory question there about whether or not, a company can take more than a certain stake without actually needing to become a bank holding company. So that's a regulatory battle that I don't think will be.
And he's asked in the past, and I can't remember if it was for
Wells
Fargo.
It
was Wells Fargo.
Which, in hindsight, maybe good that he didn't get approval for that.
Yeah, well, I mean, there might be a lot of companies or investors right now looking at these large banks and hoping they can take a larger stake than 5% because the financials have been really hit for the most part in 2019. So kind of a question about whether or not Berkshire could do it, but it's a regulatory problem. So there's no reason to think that he can do it all of a sudden as a matter of I just want to do this.
And of course, speaking of Wells, it's going to be very interesting to see whether the new CEO there, Charlie Scharf, can turn around that company. I know you and I have talked about him. He comes from Visa.
It's going to take a lot of time.
It's a monumental job as well. But if he can do it, talk about a major way to set your legacy.
Right. But even those on the street say it's going to take at the fastest 3 to 4 years. So it's
a cultural transformation.
Long ride.
A lot of companies that need turnarounds that we're talking about today. Under Armour, Wells, McDonald's with a new CEO.
It's perfect fodder for some activists too to get involved. So, yeah.
We have a great graphic I want to mention on yahoofinance.com of all the different CEO changes that have happened recently. I'm sure you guys saw that. So many CEO departures.
2019. And it's not over yet.
Yeah, wild. All right, we're going to go to a short break. Coming up here on Wi-Fi AM, Microsoft doing some very interesting experimenting with the work schedule in Japan.
Welcome back. I'm Ines Ferre here with Tim Anderson from TJM Investments. Tim, before we get started, I just want to mention some news regarding McDonald's, because McDonald's agreement with Steve Easterbrook, who is the former CEO of McDonald's, who was let go over the weekend after having a consensual relationship with an employee. That agreement with McDonald's, that exit agreement, bars him from working at fast food companies for 2 years, at any fast food company for 2 years. So you're looking at McDonald's stock, which this morning has been under pressure, down about 2.5%. Tim, though, we're looking at the overall market and we're seeing all-time highs. What will it take for us to sustain these highs?
Well, I think we just want to continue to get decent economic data and follow through on whatever is left of the third quarter earnings season with where we went through the first 3 quarters of it. Pretty much, it just cannot be overstated how we're in a completely different environment than we were a year ago this time, when the market was battling a Fed interest rate hiking cycle and also battling their balance sheet reduction program, which was in effect qualitative tightening. We're doing neither of those right now. In fact, we just had 3, obviously, interest rate cuts. And we've gotten through 3 very difficult quarters of earnings comparisons following the 2018 big earnings pops, quarter 1 through 3 with the tax cuts. So it feels like we're very potentially on the way to making a new leg higher in this 10-year-old bull market. And we would like to see, ideally, the transports and the Russell over maybe the next month and a half, the rest of the year, catch up to the Dow, S&P, and NASDAQ, which are in new high territory now, where the transports and the Russell are maybe 5 or 6% away still.
What a different scenario from several weeks ago, from in August, when this possibility of a recession in 2020. So is that totally off the table?
I think it is, yes, because the yield curve has continued to steepen. The slope from the 2-year to the 10-year is now about 20 basis points. It's not really a lot historically, but it's certainly a lot from where we were 2 to 3 months ago. And also the rest of the yield curve has continued to normalize, where each further out maturity has a slightly higher yield than that before. And one of the keys, I think, for the Fed cutting a week ago was to bring that Fed funds rate down below the very short-term rates to just help normalize the entire curve, which definitely promotes a healthy economy.
Tim Anderson, thanks so much for joining us. Make sure to stay with us. Wi-Fi AM continues after the break.
Welcome back to Wi-Fi AM at Yahoo Finance. Goldman Sachs is making changes to be more family-friendly for its employees. In an internal memo obtained exclusively by Yahoo Finance, Goldman says that it will offer all new parents 20 weeks paid leave, regardless of caregiver status. The bank will also add other benefits to help all groups on their path to parenthood. This is a first on Yahoo Finance. Julia with the story. So what's the deal here?
Well, that's right. I got to talk to Goldman Sachs CEO David Solomon, and he sent out a firm-wide email this morning outlining some of these new family leave policies, really trying to make Goldman a more family-friendly place to work. You were just referencing 20 weeks paid parenting leave, regardless of your status as the parent, whether you're primary or non-primary caregiver, because this is about being reflective of different types of families. It's not just, a man and a woman anymore. You have same-sex couples, you have the LGBTQ community, you have different pathways to parenthood. So that's one thing. Upping it from 16 weeks to 20 weeks, anyone can get access to the 20 weeks. No
matter 5 months.
Yeah, no longer, and that's one of the top company paid parenting leaves. I was just looking at some of them. Netflix has a really good one, but this is definitely in the top 5, I would say.
I've rarely heard of 5 months. That is
another thing they're doing is a new program called Pathways to Parenthood, because as I was mentioning, there are different types of families and different ways to become a family. So things like egg donation, egg retrieval, increasing stipends for those things. Also upping the stipends for adoption, adding increased stipends for surrogacy as well, because
those things are very expensive.
Actually, some of the increases, adoption will go from $5,000 to $10,000 and $5,000 to $20,000 for surrogacy, and the new stipends are for the egg retrieval at $10,000 and egg donation at $20,000.
So, Julia, something that's kind of interesting is that the financial services industry has tried to definitely be better about offering paid leave. I think American Express also has 20 weeks of paid leave. So the question, though, is how do you get people to actually take that? Because yes, it's great if a company actually offers it, but if the job pressures or the corporate culture doesn't kind of encourage people to actually take the allotment that they have, it's effectively not as useful. So how is Goldman Sachs trying to tackle that?
So David Solomon came on as CEO a year ago, and his agenda that he set out was he wanted to be more diverse and more inclusive. And you've seen that in the hiring, and you've seen that in holding business unit heads accountable for promotions. This plays into diversity and inclusion. And part of that is going to be him setting the tone at the top that, hey, it's okay for you, busy trader, busy banker, to take the leave. At the end of the day, it is a very personal choice. But he said if he was talking to someone personally, he would encourage them to do that. He said, having a baby is such an amazing event in one's life, and that he would absolutely encourage. And it's going to be about getting his leadership team also to set the tone at the top, because you're right, you do have that obstacle, and he said that he expects that a lot of people will take it, some won't, but then it's their choice.
Will he start DJing people's
baby showers?
That's the real
That'd be cool.
DJ D-Sol. All right, good scoop, Julia. Good stuff. Speaking of employee benefits, Microsoft Japan tested out a 4-day work week for all of August as part of its Work-Life Choice Challenge. Employees at Microsoft Japan were still paid for Fridays, which they got off, and the results were intriguing compared to August the year before. Employee productivity rose by 40% during the 4-day work week. The number of papers printed was reduced by 58%, which is good for the environment. Electricity consumption was reduced by 23%. And of course, Japan has some of the longest working hours in the world, with 1 in 4 companies expecting employees to work 80 hours overtime a month. That's according to a government study. So boy, pretty good, a 4-day work week. I would like this experiment to make its way to the U.S.
I actually think that it makes a lot of sense, and that you can be more productive. I know, when I have crunch time and have to get things done, I can get a lot done. Otherwise, if it's spread out, I can, procrastinate.
Well, that's a famous rule.
Usually, Friday afternoon, you're kind of burned out anyway. You're not necessarily getting your new scoop. So I kind of like the idea of last night I was logging on and covering stories for Yahoo Finance, and I feel like I can go, and then come Friday, just.
Right. I'm most burnt out on Thursday, because then come Friday, you have the energy of it's Friday. And often Friday is a big news day.
So I used to work for the government, and in the government, it's common to have what they call an alternative work arrangement, where every other week you get a Friday off. So it's not necessarily a 4-day work week every time, but I found that even in those 4-day work weeks, I was just as productive as I would be
probably
in a 5-day
more so.
work week.
I would probably be healthier too, because I would find more time to exercise, and maybe I would run the New York City Marathon.
Which just happened. By the way, the thing you're discussing, that's one of those laws or rules. Someone's law is that work fills the space provided. So you have a paper assigned, and you have 30 days to do it, you'll take the 30 days and wait. But if they say you only have 4 days, you can do the same paper at the same quality level in the 4 days. You'll get it done.
That's why I felt more productive. But also, I found that at the government, the worker retention rate was a lot higher. No one really left the government, and a lot of people stick by their jobs because they found that their work-life balance was a lot better. But I do want to also caveat that by saying that the only reason why we were able to have that arrangement is because you would do 1 extra hour each day. So you would be doing like instead of 8 hours, you would do 9 hours, but you would still take a lunch break, and it didn't feel like that, right?
I mean, do like an actual 8-hour day. It's usually like more, right? Because I feel like I'm up early
exactly.
working.
So that's what I felt like.
It doesn't mean I'm necessarily at my desk, but I'm not just like, 9 to 5 and that's it. Bye, everyone.
Sounds very interesting.
Right. And the carbon footprint is also something that's often overlooked. This is not the first time we've heard a story like this, but I think that's an important thing to think about too. You can just close the office.
Well, and those numbers about, fewer papers printed, fewer energy, less energy use. Well, yeah, because people aren't coming in on Friday. I mean, that's, you know what I mean? Like that part of it isn't as surprising to me or impressive.
It would be bad for your local coffee shop in the morning. It would be bad for your lunch spot. It would be bad for clothing companies, especially like if you have work attire that you have to buy. You just don't need as many suits.
Exactly right.
Yeah.
Well, it sounds like a very interesting experiment. I would like to see it happen. Attention, our bosses. Let's try it.
Market's still open on Fridays, though, so.
All right, coming up here on Wi-Fi AM, Airbnb is moving quickly to make changes after that tragic event at one of its Airbnb houses in California over the weekend. Welcome back to Wi-Fi AM at Yahoo Finance. Airbnb says it is banning party houses after that fatal shooting in California in a house that was rented using Airbnb. The shooting left 5 people dead, and it prompted the company to release a series of statements saying that it would be redoubling its efforts to combat unauthorized parties. Airbnb is also expanding its screening of high-risk reservations, and it will create a dedicated party house rapid response team. Now, this is very interesting to me. First of all, terrible what happened, terrible. But I'm not so sure, I don't want to start too much of a moral debate here, but I'm not so sure that Airbnb is really to blame or liable in this situation. I mean, these horrible events can happen at any house, and of course it happened because a party was thrown. So the response is all about, Airbnb trying to make sure you don't book houses with the plan that it will be a party house.
I mean, how do you avoid that, though? That's
right.
No one's going to be like, I'm going to have a party. And I once tried to tell someone that I was going to have a very quiet barbecue party for my
as soon as you say
wedding,
anything,
and they said no party.
Right, exactly. Well, as soon as you indicate anything, very often the person who owns the house is like, oh, I don't like that. For my bachelor party, we booked a house that specifically said on the listing, no bachelor parties. So we booked it anyway, but it's a house that sleeps 18 people. What do they think you're going to use it for, Yeah. But we didn't say, hi, we're going to use it for a bachelor party. We just didn't say. But this is an issue.
Yeah, I think Airbnb's response to this, though, acknowledges that they do think that they have some role in this. I mean, you could argue that they're just saving face, but I mean, you do raise maybe the counterpoint that you would have some sort of vetting process as part of the Airbnb platform because people who use the platform to rent are also rated themselves, right? Hosts rate those that are using their Airbnb. So maybe there should be more of a vetting process or more of a thorough rating system to weed out people that might be booking houses for parties.
And you do get rated as a guest.
Right, so that, as a host, you would know even if someone doesn't specifically disclose if they're going to host a party, whether or not they might actually do so behind your back anyway. So, I mean, yes, the liability isn't necessarily 100% on Airbnb, but I think that the platform maybe has some capacity to do a better job at vetting.
My idea for Airbnb would be to be able to work your way up to have that kind of capacity. One of those houses that sleeps 18, so you over time can build your rating where, okay, you can have 4 people, you can have 8 people, where you develop trust and you're not someone who's a partier. Maybe that's one solution, but I don't know how you really vet anyone.
Right, and again, I actually think the response is good. The response was swift. Brian Chesky, the CEO, Like immediately did it.
If he didn't respond, we would be criticizing him.
He is exactly right, and he is clearly thinking about this. You can see Brian Chesky's tweets about the issue on Twitter.
Is this going to be a risk factor in their, if they go public?
That's a very good point, and it is going to go public soon, but likely via direct listing. I happen to think this is a good company that is one of the most impressive ideas when we talk about Silicon Valley startups. Now, that said, it has its regulatory legal issues.
And something, too, I want to highlight is there's also a risk for those that are renting on Airbnb. I mean, there's a really fascinating Vice article about how there are all these false listings on the platform. And that brings a little bit of concern to me as someone that uses Airbnb. Am I renting from someone who doesn't actually live in that city and is using, kind of catfishing you with a property that doesn't exist and requiring you to relocate?
That's why the reviews exist.
Exactly. So there are problems. There are problems.
Yes. I once stayed in an Airbnb with a friend, and it said, the room is da-da-da, but the photos weren't great, but we did it anyway. And then the room that we had rented was like the size of a closet with no door that closed, just a curtain.
It's false advertising.
In someone else's apartment, and she was still there the whole time we were there. It was not as advertised, but it's a good response. It's important that they responded. My point is just any house could have a party anywhere where something bad happens. I'm not sure how it's on Airbnb completely. All right, we'll be right back here at Wi-Fi AM after a quick break. Welcome back to Wi-Fi AM here at Yahoo Finance. Let's see what markets are doing. We are still seeing green across the screen, although the Dow has really not moved much in the last hour. It's been up 140 points for about an hour. The Nasdaq is up 42 points. S&P in the green as well. Let's talk about Nike, especially a good time to talk about it after yesterday was the New York City Marathon. The Nike Vaporfly has become a very popular sneaker for marathoners, but the shoe is very controversial because of its materials, which some people say help runners run faster, and Nike says the same, that it can improve a runner's time by up to 4.2%. But guys, the sole of this shoe has a layer of thick foam that is meant to mimic a spring, and there is a plate inside the shoe that helps runners run faster and helps push the runner forward. So that is why a lot of people think that, well, where do you draw the line with whether a sneaker is actually increasing your performance? Now, my response, my take, I want to get yours, my take is just whatever the sneaker technology is, then great. Everyone can have it and everyone could buy that sneaker, so fine.
That's exactly how I feel.
Technology is going to keep getting better.
It's not like, look, it's not going to make me an elite athlete if I wear these, but hey, I kind of like the idea of being a little faster for the JP Morgan Challenge next year. Bring it on 2020.
Which got canceled due to weather. That was very disappointing.
But, I mean, boo-hoo, wah. Go ahead and whine about the shoe making people faster. I don't really care.
Well, and also, if it makes everyone the same amount faster.
So I own the Nike Zoom Fly, which is not the exact same model, but it's got the sole that has the foam and then also the carbon fiber plate that's in question here. Now, when I bought those shoes, I didn't all of a sudden run an under, sub 2 hour marathon, right?
No, you're a cheater.
You're only as good, right? You're only as good as you train for.
Right.
So, and I love the stats. People are saying, oh, well, all the marathoners that run this shoe end up, decreasing their marathon times by 4%. Well, it's because Nike gives it to the most elite, train athletes in the world.
Well, and also, if it helps everyone the same amount, then it's okay.
Yeah, and they look pretty freaking cool. So other shoe brands out there, step it up. That's all I have to say.
Right. So, I mean, yes, maybe you call me a cheater if I have those carbon fiber shoes, but again, it didn't help me. So it didn't even work. Even work.
So all three of us come down on the side of it's fine.
Yeah.
Interesting. Some people out there
if they come in
the
pink,
same.
I'm going to go check them out.
I think they do.
Oh, sweet.
All right. Let's talk now about the chicken sandwich boom. Popeyes chicken sandwich is back, and it's getting another celebrity shout out. Texans quarterback Deshaun Watson attributed the quick healing of his eye injury to the spicy chicken sandwich this week. It was a joke, but he told reporters after a Texans win, "It was the Popeye spicy chicken sandwiches that I ate this week. That helped the eye. Ha ha ha." But the chicken sandwich is back, and I tried it this weekend. I know that Yahoo Finance's Heidi Chung also tried it this weekend. And Brian Chung, you tried it as well. Julia, did you eat the sandwich?
Yeah, I don't.
Wow.
I saw your Instagram stories. It looked awesome, but.
What do you think? What's happening? What has the response been?
So I took to 2 separate locations here in Manhattan. I went to the one in Union Square and I went to the one in Chelsea to kind of get a temperature to see what the initial reaction was to the return. And Union Square was a mess. They weren't ready. They opened 30 minutes later than they were supposed
Shocker.
to. There was one cashier, one person assembling the orders, and one person cooking them. The line took an average of 1.5 to 2 hours to get chicken sandwiches.
Oh my golly.
Yeah.
Chicken sandwich, like
Guys,
Chick-fil-A just turns them out, you know?
It's just a fast food chicken sandwich. Yes, I also think it makes
get them
Popeyes
ready to
look,
go.
it's embarrassing for Popeyes. That it
But then I went
Bun,
to
pickles,
Chelsea,
go.
and in and out in 10 minutes, very seamless. The workers were not stressed. They knew exactly what to do. And I spoke to you guys, and you guys said that you didn't have to wait at all either.
Yeah, that's the experience I had in Norwalk, Connecticut.
Yeah,
You
same
went
in
to
Rockaway, New
like
Jersey.
a classic drive-through. You went to a mall
mall.
food court.
Oh, he went
Strategy
into a
guy.
I
mall.
went into the mall food court to go
No one
get
goes
it.
to the mall anymore.
Poor Brian.
Yeah.
You really were willing to do anything.
No,
to get
I
this.
did it. I did it because my dad asked me to go get.
Wow.
Your
You
dad
got it?
reviewed
My
it.
dad had heard about the hype. He's like, "Look, I don't even go out for fast food, but I gotta try this chicken sandwich."
Wow, see, it's everywhere.
He had me go over to the mall to go pick it up for
You're a
him,
good
but
son.
and he was satisfied with it.
Papa
so
Chung
it was worth
approved?
it. He approved.
Stamp
He
of
said
approval?
he said it was better than Chick-fil-A.
I agree with him.
This was my first time in a
Yeah,
Popeyes.
that's shocking. That's the first time Yahoo Finance. That's
Guys, I thought the sandwich was good, but to say better than Chick-fil-A is ridiculous.
well, and I wonder about how much of this is driven by the hype. Like, did I think it was good just because everybody else had said it was good?
Right.
Right. I mean, there's kind of
it
that
just
version.
it tastes like a fast food chicken sandwich.
Y'all are making me so
I like
hungry
the
right
Wendy's
now.
chicken sandwich. I like the burger. They all taste
But Heidi, you
relatively
taste
similar to
tested.
me.
Which
I
of-
did. I
which
did
of
the
three is the
Wendy's,
best?
Chick-fil-A, and Popeyes. I like Chick-fil-A's deluxe sandwich the best out of them
It's
all.
100 times better.
But the
Lettuce,
regular
tomato, yummy.
Chick-fil-A sandwich that just has the pickles, that's supposed to be the same level on the same playing field as the Popeyes
Yeah.
one, the Popeyes was superior.
Well, what's the deluxe with Chick-fil-A?
It has the
It has
lettuce,
and tomato to balance out the
Look
fries.
at the cheese on there, though. I take the cheese off of that.
Oh, gotta have
Really?
cheese. I will say we got a regular at Popeyes and the spicy was much better, much more
Spicy was
flavorful, and it's not too hot either. All right, thanks, Heidi. We'll keep
guys.
monitoring. This is a big business, the
Yes,
chicken
it
sandwich
is.
beat. Heidi's all over it. That is Wi-Fi AM for today. Thanks for watching. We'll see you right back here tomorrow, but don't miss On the Move. That's our next Yahoo Finance live show. It starts in just 2 minutes, so stay here on yahoofinance.com.
It is 11 a.m. here in New York City. We're 90 minutes into the trading day. Stocks are rallying. Now the Dow joining the record high club. It is reaching that milestone today. Change at the top. McDonald's ousts its CEO over a consensual relationship with an employee. We're breaking down the details and what it means for the fast food giant's future. And Under Armour under fire, why federal authorities are looking into the company's accounting practices. Plus, calls for impeachment. We'll speak to former White House Communications Director Anthony Scaramucci as a new poll shows nearly half of Americans support the president's removal from office. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Good to have you here. Our top story right now, of course, McDonald's. It fired CEO Steve Easterbrook after he engaged in a consensual relationship with an employee, and that, of course, was in violation of company policy. Now, as part of the separation package, Easterbrook will not be allowed to work in the fast food industry for 2 years. Joining us with more on all of this, Yahoo Finance's Julia LaRoche with more of the details, which caught a lot of us by surprise today.
Yeah, well, Adam, the board voted to oust Steve Easterbrook on Friday. They announced that decision on Sunday. Now, it's unclear if it was actually a unanimous decision, but we were told that it was a thorough process. And you were just referencing some of those separation agreement terms and that Steve Easterbrook can't work in the fast food industry for another 2 years. And that's actually a big deal because he's someone that competitors would likely want to snap up. He is a lifer at McDonald's. He joined the fast food giant in 1993, and he's held a number of key leadership positions. He really worked his way up the ranks, running the UK business, the European business, and then taking over as CEO in March of 2015, really getting those same store sales growth up for just several consecutive quarters. Also revamping the restaurant experience through technology, making it a better place to work, updating the uniforms, things like that actually mattered to people. The franchisees loved him. The Wall Street community really liked him as well. The stock surged during his tenure. So this was a big surprise. Yeah, it definitely was. Thank you so much, Julia. We're joined by this hour's panel to discuss this further. TD Ameritrade Chief Market Strategist JJ Kinahan and Yahoo Finance's Editor-in-Chief Andy Serwer. Also joining us on the phone, Bloomberg Intelligence Analyst Michael Halen. Michael, you just heard Julia speaking about Easterbrook's tenure at McDonald's and what he was able to achieve. Certainly the stock did well. U.S. same-store sales, though, have been choppy in recent quarters. So is that something that the new chief now needs to address?
Yeah, you know what? There's been some concern, some talk that it was choppy because traffic has been down, right? But guest counts have been traffic across the industry. I mean, most chains would kill to be generating mid-single-digit same-store sales comps, especially a brand that's been around as long as McDonald's, and one with AUVs, around 2.6 million. So, U.S. is humming along. And the new CEO, Kempczinski, was in charge of the United States, right? So he knows that business very well, and we don't see really too many problems ahead in the near term.
So you don't see too many problems in the near term. Easterbrook was a lifer, basically. The new CEO has been there, correct me if I'm wrong, 5 years. What should an investor right now on the sidelines pay attention to so that they don't make a mistake either pulling out too soon or staying in too long?
Yeah, that's a great question. I'd say right now this transition causes some uncertainty on the long term, right? So when it comes to the short term, you're not going to see any change, in plans, right? And these plans that McDonald's are following are probably laid out through the next 2 years, right? So we're not going to see any slipping, in terms of same-store sales. We don't think over the next year, maybe year and a half. Right. But on the longer term, we don't know. Mr. Kempczinski hasn't been a CEO anymore prior. Right. We don't know how his relationship with franchisees will be going forward. He has a great track record over the last 3 years in the United States. So that gives us some confidence. But, for the longer term investors, I think there may be concern that things could change down the road, right? Because you can make a very strong case that Mr. Easterbrook was the number one CEO in the entire restaurant industry.
Hey, Michael, JJ Keenan, how are you? So I think one of the concerns coming off earnings, though, and I don't know if it concerns you, is you talk about the same-store sales doing better, you know, at a 5.9% growth compared to 5.6, which is awesome. But isn't one of the concerns that they were so reliant on the promotions, the buy one, get one free, et cetera, that if they take that away, although the margins may increase, it could cause a slipping of the sales? And as sales increase, is it due to this and margin going to continue to get cheaper also?
Yeah, there's some concerns. Well, I mean, listen, traffic is the number one concern. And the fact that they're basically improving their same-store sales by getting customers to purchase higher priced items is a concern, right? Because the more prices get increased, the more traffic might dip, right? People may decide, you know what, I'll just brown bag my lunch or go somewhere cheaper, right? So there is that concern, but a lot of this has been technology driven. So it's been through the mobile ordering, it's been through the kiosks, and then now with the suggestive selling on the digital drive-through menu boards. So a lot of this has been technology driven. The new CEO, Kempczinski, has been a big proponent of these things. So we think that this technology is actually, a competitive advantage for McDonald's. You know, McDonald's was really behind most of their peers in terms of technology before Easterbrook stepped in, and they've caught up and passed their rivals really quickly. So we think this is, like I said, this is a problem for all of the restaurant industry. There's just a lot more competition coming in, whether it's grocery stores, convenience stores, you name it, right? We think they're in a much better position than a lot of their peers.
Michael, let me ask you, the stock's down about 5% today on this news. And the other thing, though, the question I have about McDonald's is innovation in terms of the menu. And, all we've talked about the past several months is chicken sandwich mania, and they're not there. And so don't they have to really step up in terms of adding things to the menu?
Yeah, that could be an opportunity, and there's some talk that there's going to be a chicken sandwich, a breakfast chicken sandwich released sometime next year through McDonald's. But yeah, so if you're able to put up a 5% comp over a 3.5% comp next year, I'm sorry, the year prior, I mean, those are very, very impressive. And so not having a very strong chicken offering, we see that more as a big opportunity for them than something we're kind of worried about.
Michael Halen, it's good to talk to you, senior restaurant analyst at Bloomberg Intelligence. Thank you.
Ferrari beat earnings estimates in the third quarter and raised its guidance. Inez Ferrer is on the floor of the New York Stock Exchange with more details about this for us. Inez?
Yeah, Adam, let's take a look at RACE, R-A-C-E. That's a ticker symbol for Ferrari, up more than 6% after a strong quarter. The drivers for Ferrari during the quarter were Portofino and their 812 super fast models. Some Morgan Stanley analysts have said that it is a strong quarter from the top to the bottom line, but the focus will now be on 2020. Next week, Ferrari will be presenting a new model in Rome, and they have an aggressive plan to unveil 15 models between the year 2019 and 2022. We're also watching this morning Fiat Chrysler seeing a little bit of a pop. It received an upgrade at HSBC to buy from hold. And also over the weekend, a Reuters report says that Fiat Chrysler and Peugeot are hoping to sign a merger agreement as soon as early December. And we're also today watching Harley Davidson. This is after the stock received a downgrade to underweight from sector weight at KeyBank with a price target of $33, citing increased competition and also continued pressure on Road Glide, which represents about 15 to 20% of their U.S. retail sales. Julie, Adam.
Thanks, Inez. Let's talk about another big mover today. That is Under Armour. Third quarter earnings topping expectations, but the company cut its revenue outlook for the full year. And really what's overshadowing everything is it's disclosing that federal officials have been probing its accounting practices for more than 2 years. Those shares are trading sharply lower in today's session. And I've also been reading some various tweets and other analysis of the call, which a lot of folks are saying was a little bit tone deaf. Kevin Plank, for example, was asked, did you step aside, which he recently announced he was going to do because this was coming, and he said, no, this was my decision, was his
reply to that. What's going on here, JJ? This was a hot one for a while, but
I think he's trying to say it was his decision as compared to being forced out because of the accounting irregularity. One thing I would say, you know, as you think about this as an investor, these situations usually go on longer than you think they are going to. So I would say that if you're going to get into the stock, you're going to try and catch the falling knife, pick a bottom. Think about your time frame. Are you investing in this for 2 or 5 years? That's fine. If you're somebody who's trying to pick bottoms, those things tend to not go well. News tends to come out every few months. Then it'll be quiet for a while. All of a sudden, you'll have a blockbuster sort of news item there. To me, the important thing to look at, they lowered their guidance. That tells me what I really want to know about the stock. In an earnings quarter where so many companies are actually surprisingly upping their guidance. So I think that that's really what you should pay attention to.
How's an investor, though, supposed to protect themselves from a company which might be pulling orders which haven't been fulfilled into the quarter when they're not going to be delivered or closed until the next quarter, and these kind of accounting issues that cloud the picture until you find out there's an investigation?
Trade loading, essentially. And, you know, this is something that companies fall into this trap, and it has to do with managing numbers to meet your quarter. And you said it, Julie, this was a hot tamale for a long time. You know, and then I think it tripped up first in 2016. So maybe that has something to do with its long-term record, right? Like how suspect were all those numbers? But I think JJ made an excellent point. I mean, this is a company that does have a good established franchise, but there's so many problems. I mean, we haven't even talked about like the expense account problems, the Me Too problems this company's had. You know, Kevin Plank's gone, and you know the discounting that's going on.
But he's not gone, right?
No,
which is also interesting. He's now in charge of the brand, right?
Yeah. So, well, in terms of so he's sort of gone, which is, to me, again, it just all speaks to this cockroach problem and the accounting things, and there's unknowns here, and so getting in is tough to know. Staying in is tough to know. It's a conundrum.
One thing I would say, if you don't mind, is I always think it's a good lesson for investors to separate the product from the stock. I think personally, it's a wonderful product.
Yeah, that's what I was saying.
Under Armour.
Right.
But I do think you have to, as you said, separate that the stock might have problems.
When you say wonderful product, and you also say it's going to take longer to turn this around, and you warn about catching the falling knife. Okay, so what's the end game here? Do they get bought by somebody? Can they really turn this around? Because they've fallen behind on the product side.
And they don't know who they are. You can buy them at high-end stores. You can buy them at the lower end or the discount stores. Get an identity, I think, is actually their biggest first problem.
I would say this company can be turned around. I mean, this is like the ultimate cyclical business. I mean, look at Adidas, right? Dead. Look at Nike. They've had their ups and downs. I think they'll come back. You just need someone to clear out all this stuff, which is probably going to take years at this point, and then refresh the brand.
And speaking of Nike, it's happening there too a little bit, right? With the departure of Mark Barker.
Yeah, Adidas is in the driver's seat right now.
You know, when we talk about your time horizon, there's a new note from Morgan Stanley warning of a bleak decade for stock and bond returns, blaming low growth, low inflation expectations, low yields versus history. JJ, let's start with you. Basically, what the article or what the note is saying from Morgan is that historically, if you had a 60-40 mix in your investment portfolio, 60 equity, 40 bond, you've averaged about 4.9% returns over every year. They're saying going forward, it'll be about 2.8%.
I think so. A general note like that to me is a little bit tough. And the reason, I'm not discounting what the person says, but I would be giving much different advice to my children who are in their early 20s than I am. I'm probably closer to that model than should they be. They should be taking risk at this point. But if you're going to go with a very traditional model, we haven't had yields like this, so you have to consider that. What it does make a case for is perhaps dividend stocks, and the other thing I think it makes a case for is people understanding how options work, even so they can do a covered call if they want, so they can enhance their returns over time. And I think that as the market has grown, people's education level has grown, and to me that's a very simple concept of covered calls. And again, there are a lot of tools out there that I think many investors are like, oh no, that's too complicated. Doing a covered call is a very uncomplicated thing to do, and when you have such low yields, it probably makes sense for your viewers who don't understand options to at least get educated so they have one more tool to hopefully enhance their returns over time.
Really quickly, how does a covered call work?
A covered call is you sell someone the right, they can call the stock away from you. Maybe you write it out 3 months, you write it perhaps 10%, 12% out of the money. And if it goes there, they have the right to call the stock for me. People are like, oh, I can't believe I'd get the stock called for me. If I make 10 or 12% in 3 months, I'm going to be really happy to sell the stock there. So think of it similarly, not the same as a limit order that somebody's paying you for upfront.
I mean, you've got two problems here just with regard to future returns on a balanced portfolio. One, yields at like zero, right? I mean, in this 40-60 thing was like basically you were losing money on the bond part of your portfolio, which dragged down the equity part. And that's number one. Number two, of course, you've had good equity returns, and then so going forward, they're going to probably be less than the past 10 years to revert to the mean. But this whole fixed income thing, I mean, it's like someone's going to come up with a headline, "The Death of Bonds," and at that point,
When you say the death of bonds?
Yeah, the death of bonds.
Even if we go
That's
up,
what a lot of people are saying
there was
now.
one prediction that we're going to see a 100 basis point increase in the 10-year yield. That's still below 3%.
Right.
So is it the death of bonds? I mean, and what you're talking about, by the way, is being actively engaged with your stocks. A lot of our investors are passive.
Well, I will say this, though, to get to what I'm suggesting, that's why I said 3 months out. I think if you're active or you're passive and you're not checking on your investments every 3 months, you're making a mistake. 4 times a year, most people will spend that planning their vacation. So you can spend that time at least checking in on how your financial health is doing.
Right.
So I agree, even if you do a passive investment like an ETF, we'll say you buy the spiders, the QQQs. There is still a way to do things like that to try and enhance your returns. We are let's not forget, we're in an unusual time. We have gone kind of straight up over the last few years. That's not going to continue forever, and anybody who thinks it does, I think, is mistaking themselves.
Yeah, I just wonder what's going to happen with those bonds, though. I mean, it's like you get zero. I mean, the correct allocation of bonds is zero, right? But that couldn't be right. You know what I mean? I mean, if you had an adjustable rate product that you could buy, I would buy that, right? In other words, so I could ride rates going up. But
well, bonds are also not monolithic, so maybe you buy corporates instead of sovereigns. I don't know. All right, coming up, trouble in the skies, how the Boeing 737 scandal could lead to job cuts at Europe's Ryanair. Plus, a Fox News poll finds nearly half of Americans support impeaching President Trump. We'll be right back. We've got some trending tickers for you from yahoofinance.com. We start with Insperity. NSP is the ticker. This is a human resource solutions provider. Adjusted EBITDA last quarter fell by nearly 17%. It cut its fourth quarter outlook, and the shares are paying a steep price. They're down about 32.5% in today's session. On the flip side, we've got an up mover that's up by almost the same amount. Wright Medical Group. This company makes implants to treat joint injuries. It's a big ankle replacement company. It's being bought by Stryker for $4 billion in cash, or $30.75 a share. You can see the shares rising here to $28.88, so almost to that buyout level. Stryker shares, by the way, are also on this list. They're down by about 4% today. And then Berkshire Hathaway was out with its earnings over the weekend. Those shares are up about 1% in today's trading. Profit rising more than estimated. It now has a whopping $128 billion in cash. The stock, though, this year has not been doing real great. It has lagged the broader market the most, going back to 2009, up about 7% year to date, and again another percent following those earnings numbers. We'll be right back.
So shares of airliner Ryanair in focus today. This is after it warned of job losses, saying the Boeing 737 MAX scandal made some of its bases unprofitable. Yahoo Finance's Tom Belger joins us with more from London. And so what's the outlook for Ryanair? Aren't they one of those discount airlines that people like to beat up on?
That's right. Ryanair's shares trading now at the highest in months. That is obviously bad news for cabin crew and pilots that they're announcing job losses. They haven't specified the number yet, but this is a pretty intensely competitive sector, as you say, the cutthroat industry. And you'd think at first glance, why are shares rising, given that there's a lot of concern about overcapacity and a price war in the sector. That took Ryanair's shares earlier this year to their lowest in nearly 5 years. Ryanair's average fares actually slid 5% to just 44 euros. And it downgraded its forecast for passenger growth. And the long wait, crucially, to get 737 MAX planes back in the air is now costing jobs. The number it expects to have, it says it could potentially be 0 next summer rather than the more than 50, 60 that it was hoping for. But on the other hand, analysts say the actual prices that Ryanair is getting in add-ons from things like extra luggage, priority boarding, that, as you say, customers love to hate, that revenue is up 16%, which I'm sure is music to the ears of customers. And the reality is it's still expecting to hit its full year profit. It's narrowed its guidance to 800 to 900 million euros. So the price war does seem to be hitting less badly than first feared.
All right, we can't not talk about Brexit, I suppose. You must be contractually obligated. Let's talk about the upcoming election in the UK and how that relates to it. Conservative Prime Minister Boris Johnson and Labour leader Jeremy Corbyn, they are set for an arms race on public spending. They're trying to win over UK voters after almost a decade of unprecedented cuts. So, Tom, what does all of this mean for taxes as we throw Brexit in the mix amidst this election?
taxes are going to have to rise, whoever wins the election. That was the pretty stark message from a think tank today. As you say, this is supposed to be the Brexit election, but it looks set to be just as much about big spending pledges as Brexit, with both main parties promising tens of billions of pounds already when the campaign's not even officially started after an unprecedented period of austerity. So quite a change of tune and prompting big questions about how they're going to pay for it all. Jeremy Corbyn, who you can see there, he's promising to make every single home in Britain energy efficient in a £60 billion home improvement scheme. He wants to end increased outsourcing to public services that we've seen over the past couple of decades. And he's pledging a big nationalisation programme for certain industries like rail and energy. Whereas Boris Johnson, the Prime Minister, famously attached to that £350 million a week NHS remark in the, or pledge in the election, in the referendum even. He's now focusing on the NHS in a bid to live up to those promises. And a think tank says either party really would take spending to levels not seen since the 1970s. Whoever wins, it looks like we're going to be in for more spending to come.
All right, watch this space. Thank you, Tom. Well, staying with the UK, uncertainty still reigning, whether it's that election, whether it's Brexit here, as we talk about potentially increased taxes here. We're seeing gearing up for that election that's going to be happening, that snap election in December. Let's bring in Seema Shah here, because we have to talk about how investors should be navigating all of this. She's global investment strategist at Principal Global Investors. I believe you're in Des Moines today, Seema. Good to see you there.
That's right.
So as we watch Brexit, whether it's the political developments here, whether it's trade wars going on around the world, I know you're watching the sort of velocity of uncertainty. In other words, every day, if not every moment, things are changing for investors.
Yeah, that's right. You know, we've got used to listing the number of risks that there are out there. The one thing that we haven't spent much time on, I think, as a general market is thinking about how quickly those risks translate and impact portfolios. And I think we're getting to a point where, you know, a number of different factors, such as the disconnect between underlying technicals and the fundamentals and the strength of the market, as well as corporate debt risks, political upheaval in a number of countries. There are so many risks that if they materialize, they will translate to your portfolios. So it's something that portfolio managers, investors need to watch very clearly, very closely. And Brexit is also one of those risks.
So Seema, help us understand, though, how you should react, because you point out in your note that, for instance, the taper tantrum that we got with Bernanke, what was it, in 2012? It was a while ago, was much slower to react than would happen today when you get a tweet from somebody. So how does someone who's managing my money react appropriately, given the fact we're in this world where things happen in milliseconds?
It's a really good question. I think one of the things that we're seeing is that, like, you know, portfolio managers, investors should not be watching every single headline. You can't react to every headline, but you do need to take that into perspective. The main thing, though, is to really focus on those fundamentals, the fundamental economy, and within that, then focus on where you can try and reduce some of those risks. So for us, from a portfolio asset allocation perspective, you need to be looking at more defensives. We like mega caps. It's been one of our favorites for a number of months now because it's simply more defensive. We also seem to like real estate as well. Again, I guess it's related to the economy in different ways than typical equities and fixed income are as well. So there are a number of ways that you can be positioning your portfolio. It doesn't mean that you start turning away and looking at cash, absolutely. We do believe that it's still time to be fully invested. It's just a different way of looking at these things.
But what about playing the risky markets, Seema? I want to get back to the UK. I mean, you can buy the ETF, the EWUS. It's actually up pretty strongly over the past 6 weeks. At what point do you look to get into something like that, or the Hong Kong ETF?
I think with the Hong Kong issues, you know, we have concerns about how that's going to impact the overall economy. So again, you're bringing it back to fundamentals. With the UK specifically, with Brexit, it is a tougher one to call because there are so many changes almost on a day-to-day basis. Now, from our scenario analysis, we do believe that Brexit will take place. We think it's going to be a managed Brexit, which is a better scenario, better fundamental outlook than we have had in the overall marketplace over the last 2 or 3 years. So for us, this is actually maybe the time for investors to get back into it, to the UK. But within that, you also need to have some kind of caution and also take into consideration that this isn't just the end. If you do have Brexit at the end of January, whichever party wins, this is not just the end of the Brexit process, it's actually just end of phase one. So you need to go into it with a strong stomach, knowing that there will continue to be volatility ahead, and you're looking at it as a long-term investment.
Hey, Seema, JJ, on the strength of the dollar that's a potential continuing against both the British pound and, with everything we see in Asia, does that give you any fear as you think about companies who are exporting, some of these big international companies? Because we haven't really, we started to hear a little bit of it in the last 2 quarters, but we haven't heard as much of it recently, that the strength of the dollar may affect earnings going forward.
It's a really good question. I think with a strong dollar, you may see some of that weakness coming through in Q4. But what we are seeing now, actually, in the last few weeks, is some of that expectations for a strong dollar is starting to fade out, and we may well have reached that peak. Given that the Fed is expanding their balance sheet, we have seen a bit of a recovery in Europe, maybe, and certainly in emerging markets. So this could be the time, actually, for us to start reallocating towards places like emerging markets, because we don't think that strong dollar is going to continue to weigh on asset markets like it has over the last few months. But we do see Q4 as a weakness. 2020 should be a lot better, though.
Seema, good to see you as always. Seema Shah, Global Investment Strategist at Principal Global Investors. Thank you.
Coming up, California engulfed in flames, why the state is turning to its prison population for help. Plus, before we go to break, take a look at some of the biggest winners right now in the Dow. Walgreens Boots Alliance, they're leading the way. $11:33 here in New York City, 2 hours into the trading day. Stocks are trading higher today. We're setting some new intraday level highs with the Dow hitting an all-time high. And oil trading higher as well today. I'm going to be talking about Saudi Aramco, but right now oil at $57.15. Here comes Aramco, the company finally launching its long-awaited IPO after nearly 5 years of delays. Is it really worth $1.8 trillion? We'll deal with it. One more go. A new poll has Hillary Clinton tied with Joe Biden, but will the former Democratic nominee enter the race? And on the front lines, prisoners are among those who are fighting the numerous fires in California, but it's their pay that raises some serious questions. Some people actually saying it's a lot like slave labor. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for sticking with us. Well, stocks are notching record highs as bond yields jump again. Yahoo Finance's Jared Blickry is at the Wi-Fi Interactive Touchscreen with more. Jared.
Yeah, we got the Dow up 135 points, or about 0.5%. S&P 500, NASDAQ, and Russell 2000 all up between 4 and 0.5%. Let's take a look at the S&P 500 price action for today. Yes, record highs across the board. This is going back year to date, actually. And if we take a 2-year look, we can kind of project where we might find our next resistance area. If we draw a line from here all the way up to here, we can see we're right at about the upper end of that. However, if we draw a trend line from here to here, we got a projection of about 3,110. So a little bit of a room to go there. Also looking at the 10-year T-note yield, it is up 6 basis points. And again, this goes back 2 years, so it's not really showing the big moves that we've had recently. And with that jump up in bond yields today, we are seeing value, transports, and Russell 2000, the small caps, outperforming as well. And so let's take a look at our heat map. This is going to be the NASDAQ 100. And here we have the FANG stocks clustered in the upper left. We have Apple up 0.4%, Alphabet up almost 1%, Facebook up 0.25%. If we sort this by equal cap, we can find that we have a lot of China names and names with China exposure at the top. NetEase is up 4.5%, JD, Baidu, Ctrip, all of those are Chinese companies. We also have a lot of chip companies up there as well. We have Micron up about 2.7%, AMD, Microchip all up over 2%. I want to take a look at the sectors here because this has been a really broad-based rally. And we're going to take a look at what's happened year to date. We have 8 out of the 11 sectors trading above 20%, up 20% for the year. We have tech and industrials and real estate in the top 3 spots, and only energy, healthcare, and materials are trading below 20%. Guys?
Jared, thank you. HuffPost is relaunching its tagline to It's Personal, according to the online publication. It plans to reinforce the brand's commitment to a new kind of journalism that focuses on individuals. HuffPost editor-in-chief Lydia Polgreen joins us now. And we should point out, we are all owned by the same parent company, Verizon Media. But this idea of It's Personal, how is this going to be different than what people who use HuffPost have experienced in the past?
In a few different ways. HuffPost has always been about telling stories of ordinary people, and now we're really putting that front and center of everything that we do. At HuffPost, we really think of ourselves as being engaged in service journalism, and people tend to think of service journalism as, oh, help me figure out what kind of shampoo should I use, or what dress should I wear, or what pair of boots is best for the winter. But we like to take that approach of helping people live their lives and make better decisions to everything that we do. So we bring it to politics, we bring it to our coverage of the environment and all kinds of different sectors and parts of people's life. So when we say it's personal, there's this old saying that the personal is political and the political is personal. And the reality is that life is full of really stressful news right now, and people are really trying to think about how they can make really great choices that are going to make their lives better and hopefully make the world better as well. So that's how we think of our news as being personal.
So HuffPost is also known for its political coverage. So give us some examples of how you're going to sort of weave the more personal into the political coverage in particular.
So we've been really focused on issues and how issues affect ordinary people. And it's very easy to go out there and cover the horse race and say, this candidate is up today, this candidate is down. But we're really taking a deep look at the policies and how the policies affect ordinary people. So we've spent a lot of time looking into the backgrounds of the candidates, and then also looking at how the policies that they've enacted in their previous positions have affected ordinary people, and putting those stories at the heart of our journalism. So it's not about who's up and who's down, it's really about how is this going to affect you.
And one of the things you're doing is the trending at the top line because, on the mind of a lot of your readers, the 2020 election.
Yep.
I mean, tell me, the latest polls, what are they showing you and what are they telling your clients?
I think this is a wide open race. This is a moment where, we're still a year out, if you can believe it. It's going to be the longest year, I think, of all of our lives, waiting for this election to actually happen. There's new polling that's really kind of all over the place. There's, it seems clear that the president's popularity is really taking a beating. But at the same time, when you put the president up head to head with individual Democrats in the key states, it's quite close. So I think this race has a long way to go.
Hey, Lydia, let me ask you a question, because I want to know about the nexus of these personal stories and the political story, which you're going to be covering for the next year and beyond that. But you have to look at stories that are somewhat emblematic. Mm-hmm. And that's always hard to do because you can sort of stray into the anecdotal. Mm-hmm. How do you make those kinds of decisions as an editor as to what resonates and what's really representative?
It's a great question, and I think that the thing that we can do now is really bring the empirical together with the anecdotal, right? And so we like to use a mix of what we're seeing with polls, and we have colleagues who are some of the best polling analysts in the country who work at on HuffPost. So we can bolster our coverage of ordinary people's stories with our deep understanding of polling and what that's telling us about where the electorate is right now.
So I do want to bring up one poll, even though I know this is the horse raceness of it. The Harvard-Harris poll that's out that looks up at a hypothetical matchup between Hillary Clinton and Joe Biden.
She's back?
Shows
unofficially.
She never left.
I guess that's
It shows 19% of people would support him, 18% of people would support Clinton. I mean, how should we take this, or should we take this?
I mean, I think that the idea that people are open to Clinton right now is a sign of just how unsettled the field currently is. And it's interesting because there's lots of paradoxical information out there. When we've done polling to ask people, are you satisfied with the array of candidates, when asking Democrats, are you satisfied with the array of Democrats that are running for the presidency right now? People say, yes, we love this field. We think it's a great field. At the same time, we have polls like this one that show that if Hillary Clinton were to jump in, then suddenly she'd be a head-to-head challenger to the person that we think of as the front runner. But I think one of the themes that's been going throughout this race is that Joe Biden is a very, very weak front runner, if he's in fact a front runner at all.
Interesting.
All right, HuffPost editor-in-chief Lydia Polgreen, thank you for being here on The Move.
Thanks, Lydia. Well, coming up, why Andy says our obsession with the Fed's interest rate policy could be dangerous. Plus, before we go to break, let's take a look at some of the top trending tickers on Yahoo Finance today. Under Armour and McDonald's, the two companies with big corporate news, both trading lower. California's firefighters have spent day after day fighting to protect communities as wildfires continue to sweep through the state. Among those on the front lines, prison inmates. But while the mean salary for firefighters in California is over $81,000, some inmate firefighters only make about $27 a day. And once they get out of prison, their criminal record will make it virtually impossible for them to get hired as city or county firefighters. With us now to discuss is David Fati. He's ACLU National Prison Project Director. David, thank you for joining us. So this is obviously a perennial issue that comes up again and again as we see fires continuing in California. What to you is sort of the most urgent or egregious issue when you look at prison firefighters?
Well, the problem is that prisoners are a uniquely vulnerable part of the labor force. They're not protected by minimum wage laws. They can't unionize to bargain for better conditions. They're not covered by workers' compensation if they're injured or killed in the line of duty. And so when you put all this together, it really creates a situation where the usual constraints on exploitation and abuse don't operate. And so there's a risk here that we need to be attentive to, that this uniquely vulnerable workforce not be exploited or abused.
They're also very much needed in California, and yet, after they've served their time, when they get out of prison, they have to wait, correct us if we're wrong, 10 years before they would be eligible to even get a job, say, as a firefighter?
I don't know the details of the law in California, whether it's 10 years or some shorter or longer time. I do know that the vast majority of them cannot get jobs as firefighters when they get out of prison, and that's just an absurd situation. We know that one of the best predictors of successful reentry and going straight after incarceration is being able to get a job. And so to these people who have fought fires while incarcerated, gained a valuable skill, for them not then to be able to get a job using that skill is supremely ironic.
So I guess the question is, would you be for them doing it if it was at a different wage and perhaps there was some credit toward, afterwards to cut their time for a job or something? Or is the use of prisoners in general kind of what you're against?
Well, we're not against prisoners working. In my experience, a lot of prisoners want to work, and it can be a very positive thing to have something productive to do, to learn a skill, to earn some money. But the problem is that firefighting in particular is extraordinarily dangerous work. 6 prisoner firefighters were killed on a single day in Arizona back in the 90s, and prisoners have been killed fighting fires in California. And so in an environment like prison, that's an inherently coercive environment where there's very little that you can say is truly voluntary, we just want to make sure that the prisoners who are doing this very dangerous work are making a truly uncoerced and informed choice. And informed choice is particularly important when it's something as dangerous as fighting fires, not only the risk of being killed right there on the fire line, but we know that firefighters have much higher rates of cancer and respiratory disease. The New York Times just reported that people fighting the fires in California are starting to get sick, some of them, like the first responders on 9/11. So are prisoners who choose to do this work being given this information? It's critically important that they be given this information before they decide to take on this very dangerous work.
David, is there any movement on all of this? Are you seeing in the states where prison firefighters are used any kind of changes either on wages, on training, on post-prison employment? Any movement on any of these?
I know there's been some movement in California to ease the restrictions on former prisoner firefighters on their ability to get jobs as firefighters when they get out. Beyond that, there really isn't much movement on this. This is as I said earlier, a uniquely vulnerable and disempowered workforce, literally a captive workforce. And there are, with the exception I mentioned in California, there's really no movement afoot that I'm aware of to change that.
All right, David Fati, ACLU National Prison Project Director, we appreciate your being here on The Move.
Thank you for having me.
Another story we've been watching today, Saudi Arabia's giant state-owned oil producer, Saudi Aramco, announced plans to go public, finally, in what could be the largest IPO ever. The public offering part of Saudi Crown Prince Mohammed bin Salman's plan to wean his country off oil and develop other areas of the economy. I want to chat about this with the panel. JJ, in particular, I keep wondering, every time we talk breathlessly about Saudi Aramco and its valuation, when it's coming to market, do people want to buy this thing? Are they really that hot for this?
I think they were probably hotter for a lot of the IPOs that came out earlier this year, the Ubers, the Lyfts of the world, only because they use those products day to day. You know, Saudi Aramco, they use that product, of course, but they already get it from other sources. So I don't know that there's quite the retail interest in this one as there was in some of the other more retail-friendly products, so to speak, that were a little bit more of unicorns. That being said, after, you know, the whole WeWork thing, I think that an exciting IPO is probably good for the market. I do think if you're coming to an IPO right now, your numbers are going to be studied much more than they have been in a long, long time. And with that, that'll be healthy for the market, because when this does go IPO, you can believe that those numbers have been studied very carefully.
I wouldn't buy this thing for three reasons. Yeah. Number one, I would worry intensely about that transparency, JJ, with this particular
because it's from Saudi Arabia and not U.S. based in the accounting methods?
1,000%.
Okay, that's fair.
But, you know, the proof will be in the pudding.
Okay.
Number one. Number two, don't like their behavior. Don't want to be a part of their political system. And number three, it's just going to be a proxy for the price of oil, right? In other words, why not just buy the ETF? It'll probably be cheaper, might be more transparent.
Dividends,
I already own
maybe.
XOM.
How about the fact that you
right?
know,
I don't know.
They have huge revenue, but how much longer?
I
Because
could be
the world
wrong.
is
I
gonna
often
be-
am.
Well, I'm not saying you need to buy it, sorry, but as I said, I don't think there's the excitement among retail. I think this is an institutional excitement, much more than a retail excitement.
Right, yeah.
All right, well, coming up,
retail.
Ronan Farrow exposed Harvey Weinstein along with alleged sexual abuse cover-ups at NBC. Now he says it is time to re-examine allegations of rape against former President Bill Clinton. Plus, breaking news, President Trump has to turn over his tax returns after losing another round in court. A federal appellate court ruled today that President Trump's tax returns must be turned over to prosecutors in Manhattan. The appeal panel rejected President Trump's argument that he is immune as president from criminal investigation while in the White House. Though the fight is not over, Trump's lawyer says they will take this to the U.S. Supreme Court and asked them to overturn the ruling. Goldman Sachs will offer new moms and dads parental leave. The new policy replaces one which offered moms 16 weeks of paid leave but gave dads 4 weeks of paid leave. Yahoo Finance's Julia LaRoche broke the news this morning about the change in policy, which now places Goldman at the top of companies that offer paid parental leave. At Goldman, 20 weeks. Journalist Ronan Farrow says rape claims against President Bill Clinton are overdue for revisiting. Farrow has made a name for himself, exposing sexual abuse and corporate cover-ups. Juanita Broaddrick accused President Clinton of raping her in 1978 when he was then Arkansas's Attorney General. Hungry people lined up at Popeye's restaurants across the country to buy the chain's reintroduced chicken sandwich. It was first offered last August, but proved so popular, Popeye's ran out of supplies. We'll be right back.
Time for Word on the Street, where we check in with our panelists and find out what stories they're watching. Andy, you say close followers of Fed policy, they're like a cult.
Yeah, I mean, we're just so obsessed with central bankers and rate cuts, hanging on every little twitch. And I think we've kind of gotten to a point with the rate cuts that they're not really effectual. And I think even central bankers would acknowledge that.
Say that, yeah.
We're getting very close to what's known as pushing on a string, right? Which of course means you try to do something, there's no result. And it's interesting, that phrase actually goes back to the 1930s when it was first used in congressional testimony about the Great Depression. Some Fed officials were saying, we really can't do anything with cutting rates, so how did we get out of the Great Depression? We got out through fiscal spending, the New Deal. And I think at some point, you guys, to spur the economy, at long last, we're going to have to see government spending or maybe public-private partnerships on infrastructure. And, you know, by the way, there's another template somewhere around the world, a country that does this very well, which is to say China. Ask yourself, what's the interest rate in China? Don't know. You know why? Because they don't use interest rates to manage their economy the way that we do.
But
they use
when we get that
spending.
When we get that $1 trillion infrastructure spending, though, how do you think we're going to finance it? It's going to be the Fed. Buying U.S. Treasuries?
Not necessarily. I mean, there's a lot of ways we can do it, Adam. I mean, the problem right now is we do have those deficits that we have to attend to. But, you know, going forward, there's things like tolls, and there's things like, again, public-private partnerships. I mean, look at all the cash in Silicon Valley.
The one I would say on that, though, is I think getting some sort of settlement to tariffs, and companies will start spending on infrastructure.
Right.
The problem is they're not now because tariffs are an overhang. So if you're a CEO, it's much better to say, I'll return the money in dividends or stock buybacks than get fired for spending money on some infrastructure product that may be obsolete within 6 months or a year.
Let's shift to this, because you're watching TD Ameritrade's out with its Investor Movement Index. Explain to us what this is.
So what we got tired of hearing that your viewers, the retail investor, is dumb money. And it drove us crazy. So we started this index a few years ago. It measures people who engage at least once a month. If somebody engages once a year with the market, they might not make great decisions. So it makes at least one trade a month, not a survey, what people actually do. We measure all trades, put in a volatility factor, and measure their exposure. What we saw from October, little more exposure. Two big themes on the air. The biggest theme being that when markets go higher, people are more in fixed income, but really short duration, like basically 6 months and under. when markets come down, our clients become quick buyers of equities out of fixed income. So that's been interesting. And a second interesting thing, going back to the China tariff situation, Apple has been a net sell almost every single month this year. Wow. Why? Because it's easy for the retail client to synthetically play Apple because they think many of their suppliers might be involved in the tariff game. So they use Apple, which, by the way, remains our number one held stock, but people are lightening up their exposure as their fear of tariffs becomes greater.
Really interesting intel. Thanks, JJ.
Sure,
appreciate
thank you,
it. JJ Kinahan of TD Ameritrade. Great to see you.
Always a pleasure.
Appreciate
Thanks for
it.
having me.
All right, coming up, big shakeup under the Golden Arches. Why McDonald's just fired its CEO, Steve Easterbrook. Plus, make sure to catch our coverage of the Las Vegas Traders Expo. That's on Thursday, November 7th. Our own Melody Hahn will be there. She'll host a live fireside chat to kick off the opening ceremony. That's November 7th, right here at Yahoo Finance.
Stream on down the road. 12:01 here in New York City. We are 2.5 hours into the trading day. Stocks are trading higher. The Dow has hit a record high. Let's see if we hold it. And we want to take a look at the 10-year Treasury yield. It is also gaining today. It is up to 1.79%. There is a change at the top. McDonald's ousted CEO over a consensual relationship with an employee. We're going to break down the details and what this means for the fast food giant's future and your investment in McDonald's. Under Armour under fire. Why federal authorities are looking into that company's accounting practices. Plus calls for impeachment. We will speak to former White House communications director. We got the mooch, Anthony Scaramucci, as a new poll shows nearly half of Americans now support the president's removal from office. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for being with us. Well, Chinese electric car maker NIO is surging on the heels of its October vehicle deliveries. Inez Ferre is on the floor of the New York Stock Exchange with the details on that and all the other movers you got to watch.
Yeah, that's right, Julie. NIO is up more than 14% this morning. This is after their October delivery numbers coming in at more than 2,500 vehicles in October. That's an increase of 25% from the previous month, and the company says this is despite a 7-day national holiday at the beginning of October. We're also watching Marvell Technology seeing a pop today after being upgraded at Wells Fargo to outperform with a price target negative $32, with the analyst note there saying that 5G related sales to Nokia and Samsung will help between 2019 and 2020, and also more data center spending. And then we're watching Xilinx up more than 4% on the hopes that U.S. companies will soon get those licenses to do business with Chinese company Huawei. Again, Commerce Secretary Wilbur Ross, during an interview over the weekend, said that there's no reason why those licenses wouldn't be coming very shortly. So you're seeing some of the semis seeing a pop today. Julie, Adam.
Inez, thank you. Our top story, what was it? 2 all-beef patties, special sauce, lettuce, cheese, pickles. McDonald's firing CEO Steve Easterbrook after he engaged in a consensual relationship with an employee that violated company policy. Now, as part of the separation package, he will not be allowed to work in the fast food industry for 2 years. Joining us to talk about this, Yahoo Finance's editor-in-chief Andy Serwer, as well as Brian Sozzi. Brian, I know that you follow McDonald's. The stock's down today, but is this a long-term blow?
Yeah, I've been pounding the phone so far since this hit last night. The general consensus on Wall Street is that they're sticking with him. You're not seeing a lot of ratings changes. You're not seeing a lot of price targets. But the one theme that continues to pop up out of all these calls is that he may have some problems with franchisees. Kempczinski is long known as a data-driven executive, and the franchisees are still, they value relationships. And I think he's come off cold to many of them over the past. So he really, I think, first he has to extend an olive branch to a lot of these franchisees. A lot of them own a significant number of restaurants.
And it's interesting because he is head of the U.S. business. And that's the business where we've seen a little bit of choppiness. Although an analyst we spoke to earlier on the phone said, you know, the numbers that for them look choppy, for any other fast food joint would look great.
Yeah. McDonald's US has been doing quite well. I think 17 straight quarters of same-store sales increases. That is very, very good in a competitive industry. But another theme here, too, he doesn't know the international business. So I hope he's hopping on a jet and going to visit some of those big franchisees overseas and helping to learn or getting to understand those local markets.
I'm a little surprised, Brian, that the stock, the analysts are not actually downgrading a little bit more, because this is a guy who's been successful, and it's a mature brand. It's been very difficult for them to make any headway. He did make headway. Just look at the stock. I mean, that's a real sign. The other interesting thing to me is what happened here. And it probably is not of huge concern to investors because, okay, it's over. Right. But, I mean, it's very opaque. And it's curious, too, that even though he's thrown out, he's forbidden from working in the business for 2 years. Seems to be a contradiction.
And to that point, I'm really curious what he's going to do next. He's only 52, so he's not an old guy, right? And he had a consensual relationship with an employee. So if you look at the spectrum of Me Too, of which there is a broad spectrum, at least from what we know, and to your point, we don't know everything, this doesn't seem to be the most egregious.
Well, you might not even, or one might not even put it in that category.
Right. So it seems like he could have another act.
I would CEOs, think so. We've already seen it. I mean, of fond memory, Mark Hurd survived the experience.
Right. That was a different time, though.
Different time and a different experience. But getting back to this person who's going to be in charge, would this person have been, how do you say his name, Kaczynski?
Kempczinski, yes.
Right. Would he have been groomed to replace Easterbrook?
Well, the mood is that, yes, he was the person in line to take over the CEO position, but not today. He's only been with the company since 2015, led the U.S. He was hired to lead strategy. Who everybody's pointing to who should have this gig is the current CEO of Dunkin' Brands, which is David Hoffman. He spent 26 years at the company. He led the international business. Obviously, he's leading Dunkin' Brands right now.
Interesting. All right, well, let's get to another company that had a recent change at the top. That's Under Armour. Third quarter earnings there topping expectations, but the company cut its revenue outlook for the full year and disclosed that federal officials have been probing its accounting practices for more than 2 years. Those shares are plunging today. Joining us now, Challenger Grain Christmas Vice President Andrew Challenger. He watches employment trends. So I guess what is this going to mean here for retrenching in Under Armour and in the broader sort of retail business?
Yeah, I think what's interesting about it is that it's coming at a time when there's a lot of founder CEOs that created the company out of nothing that are departing right now. We've actually tracked more CEO departures this year than we have at any other time since we started tracking it in 2002. So that includes 2008 data. And there's a bevy of CEOs that created companies, Uber, Juul, WeWork recently, where the CEO that created the company feels like they're no longer the right person to lead the organization at a time when it's a little bit more of a mature organization. So I think corporate boards and shareholders are all a little bit wary about this magic bubble surrounding these founder CEOs, and it feels like it's popping a little bit right now.
That and the fact that, the replacement CEOs are getting older and more male. We can come back to this, but in your report, you saw retail hiring up 18%, notably absent from the list of companies you tracked was Amazon. So I'm on a holiday mindset already. Was singing Christmas carols on Friday, boring my team. But let me ask you, this holiday season, what should we look for from Amazon, but also some of the bigger retail? Because I know Target is already front and center.
Yeah, like you mentioned, we saw an 18% increase in retail hiring. That's not surprising in this environment when unemployment's very low, wages are rising, consumer spending is really strong. That's a time when we expect to see hiring. We actually saw a 17% decrease in retail and the warehousing and logistics side of holiday hiring. That is a little bit more surprising with the rise of e-commerce, and I think it certainly says a little bit more about the labor markets itself than it does about retailers' expectations for consumer spending this holiday season. When we talk about Amazon, they haven't made an announcement yet. They typically have announced about 100,000 hires temporarily during the holiday season, and they're the biggest player. They're driving a lot of change. 2 years ago when they increased their wages to $15 an hour, it really shocked the system. So we can expect to see some announcements from them coming in the next couple of weeks here.
Andrew, I follow your CEO departure data very closely. How do you explain a lot of the shakeups we've seen in C-suites since pretty much since the summer?
Yeah, there's not a simple answer. A lot of it has to do with being in the longest expansion in American history. There are certainly some CEOs that are taking this moment in time to step down when their company's on top. They can cash out at a good time. They can put into place their succession plans, which they may not have the luxury of doing later on. But we're also seeing a lot of these founder CEOs that created companies out of nothing, and as they've come into a new life cycle, are deciding the boards are deciding to move them out. And then kind of a third main reason is that we're seeing people leaving those areas for a number of different reasons.
All right, Andrew Challenger of Challenger Grain Christmas. Good to see you. Thanks.
Thanks for having me.
Nearly half of voters want President Trump impeached and removed from office. That's according to a new Fox News poll. 6 in 10 also believe the president did ask foreign leaders to investigate political opponents. President Trump tweeting this morning, quote, "All-time high for stock market, and all the fake news wants to talk about is the impeachment hoax." Joining us now is former White House Communications Director Anthony Scaramucci. It's good to have you back here.
It's great to be back.
You predicted accurately that things would heat up for the president last time you were here, but you also predicted that at some point Republican leadership would go to him and he would resign. Can you update us on where you stand on that?
So unfortunately, I got that part of it wrong. I was counting on levels of valor and patriotism from my fellow Republicans, so we didn't necessarily get that yet. And so unfortunately now it's going to be the millstone of approval ratings and polling data for the president. And so he's had a terrible month. I mean, he went from 43% of that Fox poll to 49 in terms of people that want him impeached and removed from office. I mean, sorry, that's the aggregate. He was 52 in the Fox poll, down to 49. Mm-hmm. But the other two polls, MSNBC, NBC Wall Street Journal, they're all at around 49%. So listen, we're going to get that up, and I predict that's now going to have to go to 60. And when it's 60, the Republicans will cut and run. It's a shame, to be candid with you, because when you talk to these people privately, and the last time that I was here, when you talk to elected Republicans privately, they can't stand the president. They know the president is a lawless person and basically a criminal, and so they are just afraid of him. And so unfortunately, political expediency is ruling the roost as opposed to patriotism. And that's a sad part of where we are in the state of affairs in the United States right now. So my prediction now is we're going to get that number from 49 to 60, and basically you're delayering levels of a cult right now. And so that's what's basically happening. A lot of people are locked in and fortified. The president tries to shame people. He'll bully people. Remember, you have to be 100% loyal to him, like he's David Koresh or Jim Jones from the Jonestown Kool-Aid Punch. If you're not 100% loyal to him, he flips out. Your former colleague and my friend Ed Henry, I mean, he bashed him 19 times on Twitter that one weekend when he asked that benign question to Mark Levin. So that's where we are right now, and so this will eventually happen. There's no way this guy's going to make it. You probably saw the Jared Kushner information related to Khashoggi and the journalist. There's more stuff coming out. Over the next 3 weeks, there'll be a waterfall of illegality and lack of fitness to serve issues hitting the president.
And something else we've talked about is who could be a viable alternative. Because the other reason it seems that Republicans have stood by the president is because he supports their agenda, right? They have stuff they want to get done, and so they've held their noses, it seems, over a lot of these alleged misdeeds to get that agenda through. So if he's not going to be the one to get the agenda through, doesn't there have to be a viable alternative?
Well, I mean, that unfortunately, when we were talking back in August and September, had the Republicans moved, I mean, they got the goods. They know forget about the transcript percent. We're talking about legitimate, honorable Americans that have actually, under oath, testified before the Congress. Mm-hmm. They have the goods on the rank illegality and the lawlessness. And so they could have moved. They could have said, okay, listen, it's not going to work for you. We're going to pinch 20 senators and we're going to blow you out of here. The stink of the president would have lasted a little while, but not that long. I mean, they're overestimating his power of intimidation, and they're underestimating how good they could be post his departure.
You brought up the transcripts. The first ones have just been released, although we don't have the headlines that are coming out of them. But let me ask you this, because we always introduce you as the former White House communications person, but you're also a highly respected investor. And we're watching these markets, and the president tweeted about this earlier. Well, we're at record highs. So as we go to, forward into 2020, doesn't this kind of give the president the kind of cachet to keep going forward?
Okay, so again, I'm running $11 billion. I've been a market participant for 31 years. You're at all-time highs for a number of different factors, but the major factor is the Federal Reserve. Federal Reserve has lowered rates 3 times. They're in the process of purchasing assets, and so that is a levitating effect on the market.
$360 billion.
But what you have to be worried about when you look forward into 2020 is an earnings recession. There's only so much that you can peel from the current earnings environment in terms of share repurchase and dividend increases and things like that. And so if you're telling me that we're going to get another layer of multiple expansion and the market's going to go up another 25%, so you're going to move multiples from 18 times forward multiples to 20 to 20 and a half times forward multiples, that is possible because, anything can happen in our markets. But what also has been happening over the last year, Adam, is you've had unbelievable market volatility. You saw the market go from November 15th of last year to December 31st, down 14 and a quarter. It zigged back up 17 and went down 6.5 in May. The market's moving like Donald Trump's signature. And so real market participants know that there's a liquidity crisis in the market. There's a lack of principal capital. The Volcker Rule pulled out about $450 billion of principal. And so you have a lot of algorithmic traders. And yes, the market is trading up. The volume is not terrific if you look at the volume where the market's trading up. But yes, the economy's doing well. And I predict that you won't have a recession going into next year. So this won't be a market judgment. This will be, is somebody in the United States above the law? If Donald Trump is above the law,
now, the court ruling today already said on the tax returns, no, the president's not above the law.
Yes, okay, Brian has a question.
Who deserves most of the credit here for this rally? Is it President Trump or is it the Federal Reserve? I mean, just playing on the other side of this, President Trump is overseeing record low unemployment.
Listen, I'm an objective guy. What I will give the president credit for, the reason why the unemployment is so low is that he cut the illegal immigration at the border by 85%. I don't like the way he did it. I don't like the separation of the women and the children, putting the children in the cages. I think that was ridiculous. But he did cut the illegal immigration. And so what ended up happening is he tightened the labor market, took all the slack out of the labor market. It's the main reason why the bottom 10% of the wage earners experienced a 5.4% wage increase. I want to give the president credit on that. The president also delayered, from a regulatory perspective, a lot of the regulation in the industries. Give him credit for that. He's taking down aspects of the administrative state. Give him credit for that. He's botched the trade deal. The investment capital numbers have been negligible for the last 3 quarters. That'll eventually show up in the economy because what we recommended to him was that he ratcheted up 2% a quarter for 10 quarters. He could have gotten to trade parity with the Chinese, and he could have done it without a disruption in the supply chain for everybody. He would have prepared business leaders, large and small, for the anticipatory tariffs. He didn't do it that way. And so yeah, there's a mixed bag, but he certainly does deserve credit for where we are unemployment-wise. This is not about that. This is he above the law or is he not above the law? If you want to say, let me hold my nose, we're going to accept somebody that's supposedly above the law because the economy is going well, we can do that. And, I would say to my Democratic friends out there, I mean, come on, you can't pick somebody like Elizabeth Warren. Because you pick somebody like Elizabeth Warren and he survives this impeachment inquiry and doesn't get removed from office, which I predict he will, meaning he'll get removed from office. Absolutely believe that'll happen by March. But let's say he was able to survive it, because I get paid when I'm wrong, right? I'm a money manager. We get wrong a lot. If he does survive it, and they put up Elizabeth Warren, he'll beat Elizabeth Warren. No, if we just look at the polling numbers today, give you a good example of that.
Okay, really quick.
I want to be objective.
Really quickly, there's so much to dig into there, but I want to ask you about the Political Action Committee that you're reportedly starting, as of January. Give us some details on that, and what exactly how are you going to deploy that money?
I put the paperwork together. I'm in the process of raising the assets, so I'll make an announcement early January, number of assets that we've raised and where we're going to target the thing. I've been visiting 2 swing states a week for the last 10 weeks. I was in Ohio and Michigan. I was in Saudi Arabia last week, but the week prior to that, I'm heading to Florida tomorrow afternoon. And so I'm going to do 2 swing states a week. There's 11 swing states, and we're going to specifically target primarily suburban voters to explain what the president's doing actually to their children. Okay, you can't have somebody that's lawless at the top of the food chain who's supposed to be the #1 law enforcement official in the United States. And so there's many, many layers. I mean, the bullying is one layer, the cult-like behavior, the repetitive lying, all of this sort of stuff. I think suburban women in particular, they don't really like it very much. If you suppress that vote, he loses the election. And so for me, it's a very targeted and very surgical thing that I'm doing.
Gotcha. Anthony, you're with us for the whole hour, so we've got much more. Thank you so much. Coming up, as the Dow hits a record high, is it time to sell? Why you may want to fight the urge to cash out. Plus, let's take a look at some of today's trending tickers on Yahoo Finance as we see this rally going on. NIO, the Chinese electric car maker, out with its latest delivery numbers. That's sending the shares higher. We've got some trending tickers for you from yahoofinance.com. On your watch list today, companies that are out with earnings this week. Roku due out with its numbers on Wednesday. The set-top box maker down 4.5% in today's session. It's frequently on the Yahoo Finance trending tickers list, in fact, so frequently watched in part because of how spectacularly it has done this year, up more than 350%. So we'll see if that performance continues to stall out after we get those numbers. Also out after the close today, we've got Uber. Uber shares down more than 1.5% in today's session. The company is still expected to post continuing losses. We'll see how it does versus estimates. Of course, it has had a rocky time since its IPO earlier this year, down about 26% in that period of time. We're going to be talking more about Uber later on in the show and throughout the rest of the day until we get those numbers after the close of trading. And if you're following today's trending tickers, make sure you're watching the ticker. That starts right here at 2 p.m. on Yahoo Finance. We'll be right back. The Dow hit its first all-time high since mid-July today, with the S&P 500 also riding a wave of positive sentiment. So is this a good time to take your profits, take the money, and run? Our next guest says doing that would be a mistake. Joining us now from Milwaukee, Michael Antonelli, Robert W. Baird Managing Director and Market Strategist. So presumably this is because you think things are going to keep pushing higher.
Well, hey, by the way, it's great to be back on. I think it's been a little while, and I really love you guys. So first, I want to hit you guys with a headline that was in a major newspaper this morning, okay? Major financial newspaper. It said, U.S. stock market new highs baffles investors, all right? Now, what would we rather hear, that or U.S. stock market's new highs celebrated by investors? People are still disbelieving this whole thing. If you look institutionally, retail-wise, people still disbelieve this. And you have to remember something about new all-time highs. They are not a sell signal, okay? New all-time highs empirically are actually a buy signal. Why? Because it's just, you'd miss out on the vast majority of a bull market if you sold all-time highs. They're just part of how the market works. Sideways markets are not bullish. Markets going down are not bullish. So all we're left with is being bullish when the market's going up, and it is right now.
But isn't it expensive? Because we get a note like we talked about in the last hour from Morgan Stanley, the next 10 years, don't expect the returns we've had in the past 10 years. I mean, nobody knows for sure, but I'm not you. I get scared because I'm an average investor.
You know what's funny, too, about having a little bit of a bearish tilt to you? Those kind of people have gone from, well, this is going to end soon, to, oh, well, you shouldn't expect this kind of returns for the next 10 years. I just find that funny how that changes at the margin. But, you know, none of us know when the market's going to end, when the economy will tip into a recession. You know, certainly in private wealth, we're just trying to create portfolios that can be durable and last through all kinds of cycles. But the best we could do if we don't know where the market's going is to kind of think probabilistically. What's the highest occurrence of something to happen? And right now we're out of a sideways range that lasted over a year, and the market's breaking out. Those are powerful technical signals. You got a friendly Fed, you got seasonals going for you. Stop trying to time it, right? Stop trying to time it. All-time highs are not sell signals empirically. That's proven by history. Is it expensive? Sure, but valuation's a terrible way to time the market too. So it's just, you have to just keep riding the trend right now.
So Michael, what would be the warning lights on your dashboard where you would recommend your high net worth clients that maybe they need to scale back or rethink equities?
Yeah, certainly. I and my team will have our eyes on consumer nonstop. So that would be jobs data, that's new housing type data, that's retail sales. You know, my favorite indicator. If everybody in the world could pick one indicator and only one indicator, you know what it would be? It would be weekly jobless claims. That is kind of the number one indicator I would choose on a desert island. Are people working? Are wages rising? Are they starting to lose their jobs? Those are the things we will be looking for, and they've been hanging in there. In fact, through all the noise, through all the tariffs, through everything, the consumer has kind of held steady, and that's the reason why the market continues to kind of grind higher here.
But one last question for you. Isn't the key, I forget who it was who said it, it was years ago, but the key to becoming a wealthy person who invests is to sell too early. Isn't it time to maybe heed that advice?
Well, there's always the famous phrase, right? Bulls make money, bears make money, pigs get slaughtered. You know, it certainly would depend on, you know, what's your investing time frame, all the different things that you would say to somebody about whether to sell or not. I think rebalancing is a great answer to this question. Rebalancing is just, hey, we've got some stock gains, we've got a bond portfolio, maybe we rebalance from one to the other. I think that's a great kind of answer to people who say, should I take some profits? Sure, let's rebalance a little bit from our bonds to our stocks to take advantage of this. And that's probably what I would say to somebody that really wanted to kind of ring the register.
Mike Antonelli of Robert W. Baird, it's great to see you again. Hope to see you again soon.
Thanks so much.
Thank you.
And that quote was from Bernard Baruch. He bought too late and sold too early, and he was a billionaire. Stocks are setting up for a record close after hitting all-time intraday highs. Jared Lickery back at the Wi-Fi Interactive touchscreen. What's the latest?
We got the Dow up just under 100 points now, giving back a little bit of the gains we had earlier. S&P 500 up 0.4%. NASDAQ and Russell 2000 holding on to their gains. And we'll take a look at what has happened. Now, this is a one-year chart that we're going to look at here. And again, I just want to outline some of the potential resistance levels that we have. If we draw a trend line from here all the way up here, we can see we've actually poked above that. So if we instead draw a trend line from this high to this high, we get a target of about 3,110, 3,120. We should look out for that. Also looking at the 10-year T-note yield, that is up 0.6%. And in this one-year chart, we can see how the trend has been down, but we have had a lot of gains over the last few months. And so as a result, we're seeing financials broadly higher, also seeing transports higher as well. And we want to take a look at WTI crude oil because that is up again today. Let's look at a 3-month chart. This is up against a resistance level of about 57, but we do have this trend channel that has been in place since early October. We could go as high as, let's say, 58, 59 before heading into some more resistance right there. Now let's take a look at the Dow heat map. And we will find lots of green here. Apple is up only 0.7%, but it is a new record high for Apple, up 63% year to date. And we also have JP Morgan at a record high as well. It's up 0.2%. And if we look at its year to date performance, we can see it's up 32%. McDonald's having some trouble with their CEO and now another executive. They're down at about 2.7%. Procter & Gamble, the worst off, it is down 3%.
Jared, thank you. Coming up, competition on the slopes. The CEO of Vail's top competitor, Alterra Mountain, joins us to discuss his company's plans to win on the mountain. Plus, take a look at some of today's losers on Wall Street.
It's 12:30, just afterwards here in New York City. 3 hours into the trading day, stocks are rallying with all three major averages now at record highs. Driving towards a problem. It could be a long week for Uber as the company gets set to report third quarter earnings ahead of its expiring lockup. Climbing to the top, we'll talk to the CEO of Alterra Mountain on his company's plans to beat powerhouse Vail on the slopes. And setting up teams for success, the man behind locker rooms for the likes of the Los Angeles Lakers and the New Orleans Saints joins us just ahead. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Good to have you here. Let's go skiing because the ski industry has seen a ton of consolidation in recent years. Since 2012, most of North America's 50 largest mountains have been acquired or joined a collective. One of the biggest players in the industry is Alterra Mountain Company, and its CEO, Rusty Gregory, is here now. We're also joined by Ethan Wolfman because skiing is being dominated by multi-mountain passes like your Icon and Vail's Epic Pass. But I'm going to back off a little bit here. I've got a question that I got to imagine it's very hard to make money in your industry with climate change because isn't it expensive to have to make snow? And that's a big part of skiing now. It's always snowmaking.
Snow is a very important part of skiing. It's essential, actually. And whether it's machine-made snow or natural snow, it's very important to have it. And it's not easy to make money, but we do make money. I'm back here where all our banks are, so I want to make that clear. We actually make money in skiing. But the ability to react to climate change issues that are serious and really just the volatility of weather that we've always had, that's an essential part of skiing. So being able to understand how to variabilize cost structure based on how much demand there is, reacting to snowfalls, to lack of snowfall, all those things, that's essential to the business.
So obviously the ski industry has changed significantly from a consumer aspect. There are all of these passes that you buy either off an Icon or the Epic Pass, and you get kind of a buffet of a bunch of mountains. How has that changed the ski industry since this model has become kind of the incumbent model?
Well, further to Adam, to your comments, it's a big part of what it's changed is that it provides the company a hedge, a weather hedge. So, in times where there's less snow in one geographical area, we're in globally now, beginning to be spread globally. We're in really all weather zones. So it provides a hedge for weather volatility. But what's often overlooked is it provides our guests, our consumers, with hedges on weather as well. So they may have their first, their local resort that they have a pass that's good to, the Icon Pass. And if the skiing is a little less than what they want there, not as much snow as they'd like, they've got 40 other resorts to choose from for what used to be the same price for one resort. So works very well for both the company and for the consumer.
Yeah, presumably it smooths out your cash flow, smooths out that ability to then invest in things like snowmaking. To get back to Adam's question for a moment, how much of your CapEx at this point goes into snowmaking versus maintenance of the resorts, for example? How does that balance change?
Well, we've spent in our first 2 years, we're a very young company, made up of a bunch of brands that have been around for a long time. And a lot of our resorts already have really state-of-the-art snowmaking, but we continue to invest in that, expanding the resorts, making it that much more energy efficient. So some of our, not a huge amount actually goes to snowmaking because it's already well established, which says something about the priority of it, that it exists.
So obviously you guys have been on a spree kind of collecting different mountains. What's the plan forward? Do you guys have a lot more kind of on the plate, and especially kind of as, the competition against Vail as Vail does the same thing? How do you guys plan for the future here?
We don't call it a spree. That sounds like impulse control problems. And we have a methodical approach to the acquisition and partnership of resorts. At least that's what I tell people. And we're really very focused on, not really on Vail or our other competition, although it's a competitive industry, no question about that, but really on the consumer. And understanding what we call the experiential ladder. People start off skiing in their local mountain where it's convenient, and like mountains are, they aspire to the next place, and they take an overnight trip by car to somewhere else in the east, in the case of this region, and then eventually get on an airplane and go somewhere else, often to the west from here. So understanding how those consumers kind of view their experience, what's the next aspiration, it's important to have those resorts in our network so that people can stay with us and ski where they want.
And they're already skiing in Colorado. Colorado is open for business right now, right?
That's right. A-Basin's one of our pass holders. They opened first this year.
So you mentioned you're here meeting with bankers. Got to ask you, raising more money, as Ethan was hitting at, more mountains, or is there perhaps a discussion going on about taking this all public to raise the capital to expand?
Actually, we like, there's a lot of discussions about taking this public, but by others, not so much by us. We actually really like our private profile. I mean, Vail's public and done a great job. Rob Katz, the head of Vail, really runs a great company and created a lot of room for not just us, but also other smart independent resorts. So we're not back here raising money, maybe stopping in saying the bankers to let them know they put their money to good work. And
why is the private model better for you?
It's if you look at the partnerships that we have, we're able to create a bespoke, customized relationship with each one of our partners so that it works out with their needs. We don't have to have a largely scalable public disclosure of how we're dealing with other private companies. And our investors through KSL and the Crown family out of Chicago, it works much better to be private for us.
We wish you all the best. Rusty Gregory, Alterra Mountain Company CEO, good to have you here.
Thanks, Adam.
Well, coming up, setting your team up for success. We'll talk to the company behind the locker rooms of such teams as the Chicago Bears and the Detroit Red Wings, not to mention SoulCycle. Plus, take a look at some of today's most actively traded stocks by volume. General Electric topping the list, bouncing by 5%.
Holman Inc. makes locker rooms high-tech and better for the athletes who use them. Clients include the Washington Redskins, the LA Lakers, other major sports teams, but also major companies. Ever heard of Equinox? Travis Holman is the CEO and joins us to talk about personal space and locker room innovation. It's good to have you here. I use some of your product at Equinox, and how does this grow? Because never thought that there was a business behind the locker room.
Lockers are personal space, and with how everything's moving, all the kids, the new millennials they're moving into smaller spaces. The office market's opening up, they're using flat desks. So the only personal space people are having anymore are these lockers, whether it's in your country club at Equinox or whether it's at your desk where you work at every day. A lot of the new companies, we're doing Google, we're doing Facebook, all the high-tech companies are going to flat office spaces and flat desks and lockers. I mean, it's just growing like crazy.
So, Travis, what does innovation look like when you're talking about lockers? I mean, I still envision my metal lockers, right, from high school. Like, you know, so when you sort of have that image in your head, there's only so much you can imagine. But you guys, you do some pretty crazy stuff with lockers. What are some of the innovations that you've been the most excited about?
Well, right now, our big push is into the office space. So we've come up with acoustical lockers to kind of trap the noise inside of these offices. All the new types of materials now are antimicrobial. So when you touch them, you're not spreading diseases. They also are anti-fingerprint, because all these lockers that are going in are used more frequently by the average user because it's just becoming a more frequent spot, especially in the work environment. In the athletic environment, everything is going to multiple materials. We're doing some incredible cool stuff right now for the Texas Rangers, where every single compartment's thought out. They've got even a spot to throw your watches and stuff that's all velvet lined. We've got facial recognition in some lockers, so when you walk into a locker room, Dallas Mavericks, you walk in the locker room, you walk up the locker, at the locker it pops up a screen that tells you, go see the coach, go take this supplement, go do these workouts, you know, whatever you need to do that day to be successful. So they're using the locker room as a space that's your only personal space. So say you're playing for the Mavericks, that's the only personal space you can get to, and they're using that as a space where all your information comes. And then they're starting to know you know, how often you go there, when you walk in the building. They're pulling all that data together, and it's running through the locker room.
Travis, you deal with a lot of these boutique gyms. Do you feel at some point there will be consolidation in this space?
You know, yes, but the boutique gyms give everybody an opportunity. Business is really getting down to smaller businesses. So these boutique gyms are getting everybody the opportunity to go in and own their own company. And I think that's just going to grow. If you think about how people are living, the millennials, everybody's downsizing, everybody's becoming part of these little communities everywhere. These little gyms make those communities special, as where some of the bigger gyms, it's not that community feel. So I think there's a real big push towards these small boutique clubs. We see it. Our locker count on production has gone way down on our gyms because, you know, we used to be about 65 frames, so about 120 some odd lockers per club, and now we're averaging about 25. The boutique clubs are really coming up and really doing well.
You know, when you go to the Federal Reserve for some of their press things, you have to lock your cell phones up in a little locker. Maybe you have a client there, because those lockers they got.
Those are mine.
Oh, they are yours.
Those are mine.
See, there you go. You're everywhere.
Yeah, we do the Federal Reserve. Yeah.
Travis Holman, thank you very much for joining us.
Thank you.
Coming up, stepping up. Apple promises billions to help fight the California housing crisis, but is it enough? Plus, take a look at some of today's winners on Wall Street. Take a look at the top trending stories right now on Yahoo Finance. Krispy Kreme is ordering a Minnesota college student named Jason Gonzalez to stop reselling donuts to his own customers. The 21-year-old student would drive to Iowa every weekend, buy hundreds of donuts that he would then charge his customers $17 to $20 per box. The company's Nebraska office gave Gonzalez a call and stated that his sales created a liability for the North Carolina-based company. SpaceX ran 13 successful tests for its Mark III Crew Dragon parachutes, demonstrating that it can land the crew craft safely in case of any failure. This has become a key milestone for SpaceX's creator, Elon Musk, who set out to complete this goal last month. This has also become a big step for SpaceX's plan to launch NASA astronauts aboard the Dragon. Microsoft Japan says its 4-day workweek experiment led to a 40% rise in productivity. The Work-Life Choice Challenge had full-time employees take off 5 consecutive Fridays in a row during the month of August, while meetings were shortened and online chats were encouraged. Surveys from the program saw that 92% of workers were pleased with the 4-day workweek, and the company plans to hold another challenge this winter. We're going to be right back.
Time for our buzzer beater round. 3 stories, 1 minute each. Let's get started with this. Apple is donating $2.5 billion to combat the California housing crisis. The donation includes a $1 billion housing investment fund and a $1 billion first-time homebuyer mortgage assistance fund. Apple will also free up $300 million of land in San Jose for affordable housing development. CEO Tim Cook says the company felt a, quote, profound civic responsibility. Anthony, is this the right way to tackle the housing crisis?
I'm hoping Tim Cook would use some of that money to buy my house in the Hamptons, actually. I'm kidding. Well, listen, I think it's great public relations for them. It's a very small amount of money for them given their cash reserve. So it's a good idea.
But what took them so long?
Yeah.
But isn't the way to deal with the housing shortages in so many places the land use regulations that prohibit certain kinds of construction? Because $2.5 billion in a place like San Jose and Silicon Valley really
go as far. Well, maybe the biggest part of it is them freeing up that land that they own in San Jose in order for affordable housing.
But it's also a signal to other tech companies that have a lot of cash on their balance sheet.
Yeah, pony up.
Airbnb is taking action. The company is banning house parties after there was a deadly shooting at a Halloween party held at a rental house in San Francisco in a suburb. So, how is Airbnb really going to regulate this?
I'm completely unclear on that. But I think it's going to be, there should be a large section in their prospectus. And when you eventually go public, as they're rumored to be next year, they better list all this stuff. Because this could be a potential train wreck and a major liability.
Factor. Yeah.
But is it fair to hold them accountable for the behavior of an individual who breaks the law?
But I mean, that's a plaintiff society, though. They could sue you, Adam, for that. Okay.
My parents are lawyers. I get it.
Yeah, you can sue a ham sandwich. But I think that the big issue for them is in densely urban markets like New York, they're going to have a harder time. There's going to be more walls of regulation up against
I mean, I think they've
Airbnb.
got to be responsible, particularly if there have been ongoing complaints from neighbors, for example. This is a party house, you have an ongoing issue. Then that increases the risk of liability, it would seem.
You'd think they would address it, but I don't know if when you're nationwide. Well, I got mine.
Nationwide, how do you do it? All right, let's talk about Uber. It's set to report after the bell today. Meanwhile, its post-IPO lockup period expires on Wednesday. That could spell trouble, but how are we setting up into this report?
If CEO Dara Khosrowshahi doesn't hop on the earnings call and give a path to profitability like Lyft's management team last week, this stock's going in the tank.
But it doesn't
this
seem
stock's
like
going in
that's
the tank even
happening,
more.
is it? Is that happening?
No, and he needs to do it. A path to profitability. It could be 2-3 years. There is no path right now. He has not articulated that at all.
Plus, you've got the pending California situation with will the employees be considered employees?
I'm surprised it's held up as well as it's held up. I mean, I know it hasn't held up that well, but I'm surprised. Just given all the potential supply that's going to about to come on the market.
Exactly. I mean, that lockup period, we saw what happened with some other stocks when Beyond Meat, one of your favorites to watch, went down sharply, although that one is still up pretty sharply since its IPO.
But are you surprised though that, I mean, Lyft, we used to categorize Lyft and Uber. We would say Uber's on the right trajectory because they were so big in so many different venues, whereas Lyft was concentrated on just rideshare.
All right, we got buzzed. I want to get the last word from Anthony because Anthony, we have asked you the last couple times we've come on who your 2020 candidate would be if indeed President Trump doesn't end up being the Republican candidate. Who are you pulling for?
I think that there's 3 or 4 people that would enter the race. Nikki Haley, Larry Hogan, the governor of Maryland, somebody like Charlie Baker from Massachusetts, possibly Governor Mitt Romney. Obviously, him I know the best, and he's the person I'm the closest to. But I think there would be a stable of Republicans. And what I would say to my Republican friends, if you're thinking about running in 2024, what are you going to say in 2024? That you whistled past the criminality and you accepted it and you were fearful and intimidated by President Trump, so you didn't say anything? Or do you actually like criminality? I mean, what are you going to say? So you have to have standing in 2024. You got to start speaking out now.
Of those people, who has the best chance to defeat a Democrat, whoever that is?
Well, I think any of those people could defeat the Democrat because they're so far left on the socialist stuff. The country really doesn't want that. One of the best things that Donald Trump has going for him, the Democrats. I mean, at the end of the day...
Well, not all of the Democrats are
well, no, look at the polling numbers. The only one that seems to be beating him in the important swing states is Joe Biden, and he's eking out 1 to 3% margins.
Could a Buttigieg beat, do you think, President Trump if the Democrats were to go that young and have the first gay candidate?
I think so, yes. I do think so. And remember, the Democrats do better below the age of 50. John Kennedy, Barack Obama, Bill Clinton. Republicans do better above the age of 60. Ronald Reagan, Dwight Eisenhower, Donald Trump. And so picking a 70-year-old to be the nominee is not the best strategy for Democrats because their voting bloc is a lot younger.
And if President Trump doesn't get removed from office,
Buttigieg is wicked smart, by the way.
If he's the nominee, would you support one of the Democrats, and would it be him, for example?
So, I could not support Elizabeth Warren. I would have to not vote in the election, frankly, because I'm ABT right now, anybody but Trump, except for Elizabeth Warren. So it's EW, except Warren. You know what I mean?
She hasn't gotten endorsements, by the way. We should point out she's not gotten the major Democratic Party
first of all, there's nothing about what she's saying that makes any sense, okay? And she's talking about $35+ trillion of expenditure on a $20 trillion economy. So nothing that she's saying makes sense. And
what does she do to the markets if she's elected?
Well, I think she would have the markets. I mean, just don't go by me, go by Lee Cooperman, go by Paul Tudor Jones.
I think there's a lot of hysteria around what you're saying, though. I mean,
no. Let's look at it this way. The reason why the market is up, don't forget, there was a 35% corporate tax down to 21. That's a 40% increase. That propelled about a 45 to 50% move in the markets. She's talking about reversing all of that and then taxing a wealth tax.
Okay. All right, we'll have to keep debating off camera.
We really appreciate your being here.
Asset migration.
As well,
Run for the woods. Run for the woods.
Come on.
5 p.m. next.
It is 1 p.m. in New York City, and the major indices are starting the week by hitting fresh all-time highs, with the Dow finally getting in on the record-setting action. On tap for today, McDonald's missing out on the Monday rally after parting ways with its CEO following an inappropriate relationship with an employee, while the fast food giant is still paying a 6-month severance despite the controversy. And as one fast food company falters, another returns to glory with the return of the Popeyes chicken sandwich that sparked a nationwide frenzy. We'll have the final report card on its return weekend. Plus, Under Armour shares plummeting as the retailer slashes guidance yet again and discloses an ongoing investigation into its accounting practices. All that and more. This is Wi-Fi PM. Good afternoon, I'm Zach Guzman. Happy Monday. Joining me on a Wi-Fi PM today is Yahoo Finance's Kristen Myers, along with Drucker School of Management Senior Fellow at Claremont Graduate University, Ryan Patel. Ryan, good to have you with us today. We'll start the show by checking the market action we're seeing right now. As I mentioned, it's a strong Monday to start the week. The Dow up by about 102 points as we continue to trade at record highs. We'll see where we close up on Monday. Of course, we could close anywhere, so we'll be watching it throughout our hour. But first, an executive shakeup at McDonald's as the fast food chain stock is slumping today after its board voted to fire CEO Steve Easterbrook for a consensual relationship with an employee at the company. The New York Times reports Easterbrook wrote in an email to employees that the relationship, quote, was a mistake. The current president of McDonald's USA, Chris Kempczinski, will now take the helm. Ryan, when we talk about this, obviously, in today's era of Me Too and such focus on having these relationships with employees at the company, even Easterbrook is admitting that this wasn't the right thing to do and agreed with the board's decision to part ways.
Yeah, I mean, I think if you look at, this goes longer, bigger picture for transparency, not just for the employees, but to the consumers as well. What are you trying to say if you're trying to push a mission out there, right, as McDonald's is trying to do? And I think what's really interesting here is we usually pick on the board of directors not to move quickly enough, to move with some pace. And in this case, they made an affirmative decision to make sure that it was clear that this action was not, is condoned, and he apologized. But I think what was a big deal, I think, again, to the employees is that the transparency is clear, right? And that kind of nips this maybe controversy and scandal that you would say in its beginning stages of this.
Yeah, and I mean, we saw them act swiftly, and we also saw today we got the information regarding the severance package as well. But it's not the only shakeup at McDonald's, because the company is also parting with Chief People Officer David Fairhurst. He's leaving the company, according to Bloomberg. No reason was given for his departure, but he's been at the company for 15 years, has a relationship with Easterbrook as well. So there is that piece of this as well. When you talk about the CEO leaving and also the Chief People Officer, of course, in context of this, you might connect the dots there. Not saying that we should, but that's kind of the backdrop for it.
I mean, if there was any kind of doubt, I think unfortunately, we live in this place now, like, we need clear trust, right? And if you don't have trust, if your Chief People Officer if there's any kind of maybe tie to anything, I think it's the move that they had to make was to make that cut. Because what are you sending the message to everyone in the employee base that is thousands and thousands with the brand, right? And this is an iconic brand. So you have to make a decision that represents the employees and the brand as a whole.
And it's pretty unfortunate for McDonald's, particularly. Easterbrook took the helm 4 years ago, back in 2015, and since then has really pushed the company to be far more innovative, really to embrace technology. The organization became leaner. They used so much more tech, and they have been able to become, even though their last quarter didn't do so well, they have done incredibly well under Easterbrook's leadership. And so for him to have to leave, and for this to be his leaving legacy, is pretty unfortunate for the company. And obviously right now shares is down over 3%. So investors don't seem incredibly happy with the news of their new CEO. But no company wants a scandal, but clearly I don't know how long this investigation, I don't know how long it was going on. If something was maybe swept under the rug, we might be hearing about that in the coming days as more of this news kind of drips out. But it might come out that, McDonald's found out about this and just decided to take really really swift.
Yeah, it was fast. I mean, when we talk about the investor reaction, Kempczinski has kind of downplayed what kind of changes might be made here when we're talking about buying into the philosophy and every investment that was made on the part of McDonald's moving forward. But it comes nonetheless amid a slew of recent CEO departures, with 7 other food industry executives besides Easterbrook departing this year. And joining us now is As You Sow Program Manager for the Power of the Proxy and Executive Compensation, Rossana Landis-Weaver. And Rossana, I mean, when we look at this, your nonprofit uses shareholder proposals to push for environmental and social issues, but one of the most important reactions, or I should say responsibilities of the board, is to make sure that these companies are running appropriately. I want to get your reaction to the idea of giving Easterbrook a 6-month severance package after these details came out. What's your instant reaction to that?
Well, my instant reaction to that is that was probably promised ahead of time. I expect that was contractual, and that's not the worst we've seen by any means in terms of severance packages. His compensation is quite high. He had exercised a ton of stock options this year. I think that brought him in $13 million. He had vested restricted shares of $11 million. So in that context, the severance is not huge.
Mm-hmm. It's not huge. It's not huge, but what do you think about the reaction here? Of course, as we were talking about before we had you on, just kind of the backdrop of the Me Too movement, and knowing that some of these relationships aren't necessarily approved, and how quickly the company and the board here moved to remove Easterbrook, and his reaction as well, saying that he understands that this was a mistake. So just your thoughts on that as well.
Yeah, I think the board did the right thing. They needed to move quickly and decisively, and they did. You haven't mentioned, I don't believe, that the company has also faced some other allegations of sexual harassment. I think the Fight for 15 people have been putting a lot of noise around that. So they really couldn't afford to get a reputation here. They're a consumer-facing company. They have to respond quickly. They also don't want to be sort of the poster child for economic inequality, and there's some risk for that. Easterbrook's 2018 total reported comp was $15.8 million. So the proxy statements now have to disclose the ratio to the median employee. He made 2,124 times what the median employee McDonald's made. Median employee made like $7,400, like less than $10,000 a year. Now, of course, that's part-time. Many are part-time, many are students. I understand all of that. But you're also looking at a situation, and this gets to some of McDonald's larger issues, where McDonald's employees practically can't afford to eat at McDonald's. And I think Easterbrook did some great things, some really positive things. The breakfast all day thing, I got an Egg McMuffin for my son at 9 o'clock at night. But there are still some fundamental underlying problems. There's going to be, the stagnating traffic issues aren't going away no matter who's the CEO.
Yeah, no, for sure. And there's going to be a lot more to shore up there. But at least in this one instance, the board making its decision, as we've said, very quickly, decisively, and moving on now. But Rossana Landis-Weaver, got to leave it there. Thank you so much for joining us to break that down.
Thank you so much for having me.
Appreciate it. Well, when we're talking about the rest of the fast food space, we'll shift away from McDonald's, because the Popeyes chicken sandwich is back after the fast food giant ran out of the limited time sandwich back in August, causing a nationwide frenzy. And Yahoo Finance's chief gluttony correspondent Heidi Chung is back with the details.
I didn't approve of that title, first of all. We have to have a chat about that.
I just read the words. Heidi, you hit the streets to find out how Popeyes was dealing with the demand and how it would be received when they got the sandwich back in stores. So what did you see?
Yeah, so we knew it was coming back on Sunday, so our producer, Sarah, and I hit the streets. We went to 2 different locations here in Manhattan, and you would think after 2 months of it being gone, that the hype would have died down somewhat, but that was definitely not the case here in Manhattan. We went to the Union Square one first, and it was kind of a mess. So a lot of people there were waiting anywhere between an hour to 2 hours. The store actually opened 30 minutes later than it was supposed to, at 11:30 instead of 11 a.m. And I spoke to several different people, but specifically I spoke with Michelle. She had been waiting there for roughly about 2 hours when we chatted. And I want you guys to take a walk, see what she had to say in reaction to her first bite. I'm here with Michelle. Michelle, is this your first Popeyes sandwich? It is. Okay, we're pretty close to the line. How long have you been waiting? About an hour. If you go, take one bite and yes. You have to eat a bite here. Okay. This is the moment of truth.
The mild one. So let's see. Okay.
It's pretty freaking good.
But compared to Chick-fil-A?
Ooh, it's different. Thicker. Definitely tastes unhealthy. Like Chick-fil-A, you don't really think it's that bad for you. It just tastes very oily and greasy.
Was that the regular?
That was the regular. This is the mild. Or this is spicy.
Okay. Moment of truth, guys.
The bread is good though. I like the bread and I like the pickles.
That is a bite right there.
I think I like the regular better. Spicy sauce is good though. Worth the hype.
You're down 4. I mean, you said she had 4 sandwiches?
Yes, so she was there with her boyfriend. They had been out really late the night before, and they were like, this is the perfect hangover food. So they were waiting in line even before the store had opened. She picked up 2 spicy and 2 regular. But most everybody in line, it was about 90 or so % that said that this was their first ever chicken sandwich. They had heard about it through their friends in social media, and they were ready. They were ready even before the store opened to go check it out.
I mean, I was at the 14th Street one later in the day, around 8 p.m., and the scene looked exactly like this. It's not like this was just right when they opened. This was throughout the day. I couldn't actually get one. I decided to wait
I doubt
too
that.
long.
You probably had a few. Don't.
Well, if I did, I'd expect Heidi to shove a camera in my face apparently as I took it. But no, I wasn't able to get it. The delivery app wasn't working as well. So I mean, as much as people were happy to see these back in store, I think the actual rollout, for as long as we waited, wasn't as smooth as it could have been.
But that was specific to the Union Square store. So I went to Chelsea to see if that was a situation there because it is a less busy location. And I was in and out in 10 minutes. Sandwich was still really hot. The workers were not stressed. There were 2 cashiers. They were doing everything very seamlessly. But the Union Square one, everyone was frazzled. They had no idea. It didn't seem like they were very prepared for it. There were some people in line that were supposed to be at work.
It's a good point that you bring up, though, here, too, though, because when we talk about this, I mean, franchise, like the relationship between the franchise and the company, very important as well. And it's not just New York City. There may have been some problems in Union Square. I want to highlight what it looked like around the country, though, because a sandwich didn't just come back in New York City. Here's a look at some very happy customers in Los Angeles who were able to get their hands on some out there as well. But I mean, Ryan, you've worked with many companies who have been working to roll these things out and franchisees around the country. So I mean, what do you think of the way that they got this back to the public?
Listen, franchisees of Popeyes are loving this, right? Yeah. This is the buzz that they really needed to come back and take some of the market share from Chick-fil-A. They wanted this natural grassroots word of mouth. They hadn't had it for years, right? Now to be able to capitalize this, and yes, I think operationally they need to really get that sound here pretty quickly, but to create this kind of buzz with how much marketing money dollars they spend? Not
much, especially because everything was sort of natural with the Twitter feud. They didn't have to pay a cent for that, right?
Yeah.
Right.
So, and you got to give them what you give companies due when they do great on social media, and they've done it. So it's really interesting to me that they've got this. Now the question becomes for the franchisees, specifically growth. How are you going to integrate that for the rest? This can't just be a hype thing. It has to be now. You have to execute on that product consistently over time now.
Yeah, no, for sure. And I mean, the bar is going to be there. The bar is now set. It's very high. Yep. The sandwiches we know are very tasty. We tried them on the show ourselves, even before Michelle got 4 of them.
I mean, I like it better than Chick-fil-A. So.
I know. I don't disagree with her, but thank you so much, Heidi. Appreciate it. You can catch part 2 of Heidi's Popeyes experience on the ticker coming up at 2:50 p.m. Eastern Time for more on that. Well, Under Armour is tumbling today after the disclosure of a federal accounting probe. And this comes as the sportswear brand reported quarterly earnings that beat expectations. The company reported adjusted earnings of 23 cents a share on $1.43 billion. Importantly, though, its forward guidance took another hit, slashing that for the second time in a row. Joining us now to discuss more on this, though, is Yahoo Finance's Alexis Keenan. And Alexis, I'm not sure which one right now investors are more worried about, whether or not growth continues to slow, or the actual important investigation that's now out there into Under Armour's finances.
Right. So this is coming from the Wall Street Journal, and they're saying that there is an inquiry into the accounting practices of Under Armour and its associated disclosures. And it's coming from the SEC as well as the DOJ. And I think that's the important part to zero in on here, is that the DOJ, the Department of Justice, has found it appropriate to get on into this inquiry themselves. And keep in mind that that does not happen automatically. Just because the SEC is conducting a probe does not mean that it goes automatically to the DOJ. And so for them to find that they want to be interested, it raises the level of potential risk, perhaps, because they're finding that perhaps there is a reason to look at potential criminal responsibility here. So we don't know what that is at this juncture. We know very little about what's being looked at in terms of any finite details, but this again coming from the Wall Street Journal.
So, Alexis, what is if they are found to be in violation of these accounting practices based on either previous cases or similar cases like this, what is the most likely outcome? Is it just Under Armour gets slapped with a really hefty fine, or is it that some of these executives might actually face some jail time?
So we're not quite there. I don't want to push it that far. This
Right.
is just an inquiry at this point. There have been certainly the SEC can assess fines, they can have disgorgements, and usually they're in line with what the ill-gotten gains they determine would have been for the company, for an individual. In defense, Under Armour has issued this statement to us. Want to get them on record. They say that the company is cooperating with the SEC and the DOJ. The company began responding in July 2017 to requests for documents and information relating primarily to its accounting practices and related disclosures, and the company firmly believes that its accounting practices and disclosures were appropriate. Now, the SEC has generally a statute of limitations that lasts about 5 years. So if we look at the time frame, that would put us at about late 2014, that this activity that they're zeroing in on, it would likely be sometime late 2014 and that brings us 5 years into the present here. So that's the activity that folks should be looking at for potential disclosures or accounting notes that are not in line with what they should be.
And let's not forget, too, the recent disclosure that Kevin Plank, founder, would be stepping down from his role at the company as well as CEO. So, I mean, when we're talking about all these things, you do wonder the backdrop that this might have played when we're talking about serious allegations of changing things quarter by quarter to kind of make things look better than they appear. But nonetheless, we'll be following that investigation. Alexis Keenan, thank you so much.
You're welcome.
For bringing us that. Appreciate it. Before we go to break, though, want to highlight some of the names that we track on this show here on Wi-Fi PM, as, again, we're seeing all three major indices rally today, and I guess we'll have to highlight some of the names on here that we talk about from time to time. Of course, that being names in the cannabis space, rarely seeing a wave of green as the overall indices rise as well. Aurora Cannabis up by about 0.5%, as well as Canopy Growth up by 2%. We'll see where things go from here. Coming up, President Trump renewing his battle with California Governor Gavin Newsom over his handling of the state's wildfires, and why Trump is doubling down on his threat to cut federal funding when Wi-Fi PM returns. welcome back to Wi-Fi PM. We're following the news of multiple wildfires continuing to burn across the state of California, and things are not looking up for Pacific Gas and Electric. California Governor Gavin Newsom says the state could take over the utility company in the wake of its bankruptcy crisis. Take a listen.
We are gaming out a backup plan. If Pacific Gas and Electric is unable to secure its own fate and future and work through the process of getting people together and working to address the needs of debt and equity and bondholders and lawyers and victims and subrogation claims, then the state will prepare itself as backup for a scenario where we do that job for them.
It's an interesting shift in position because just about a week ago, he was kind of trying to distance himself from that scenario, potentially playing out with the state taking over the company. PG&E, as you can see there, though, is enjoying a little bit of a rally today. It's, keeping things in perspective here. It's up 12% today, but of course, the stock's been beaten down as more news has been learned about the wildfires in California. And we should note that PG&E also told Yahoo Finance that they are not disclosing a date for their earnings report at this time. Generally not a good sign when we're talking about companies there as well. But guys, I mean, PG&E, it's caught in one of those positions because obviously we've seen residents of California struggle with even getting power back on because of issues of this company not wanting to be a potential problem, a potential spark for another wildfire moving forward. And the governor, watching this all play out, has no position or no strategy but to kind of step in here and say that maybe we'll have to step in and make sure things are better.
No, I think Governor Newsom has no option, especially since he has faced his state essentially have wildfire after wildfire after wildfire. It's gotten to the point where people are now facing fires and they haven't even recovered from the fires last year or the year before that. So forget not even being able to turn on the lights in your home and having power. Some of people don't even have a home, and now they are filing these lawsuits, and PG&E wants to have a bankruptcy filing, and people are worried that they might not be able to recoup the money that they need to move forward with their own lives. And so it's gotten to a point where I think the governor has to say, listen, you are not only causing a huge disaster to our wildlife and to the state itself, but you are harming the citizens essentially of this state. You guys haven't gotten your act together. You guys haven't been able to follow the guidelines that we have laid out for you. Yeah. So we might just have to take over. Now that comes with its own complications, right? The state is not in the business of owning a utility. They're not a utilities company. No, of course they don't want to be. No more than a bank wants to, file bankruptcy on your house and then get into the real estate business. I mean, it's not. The state doesn't want to do that. But I think we're getting to the point now where the state is increasingly facing a situation where they might not actually have a choice anymore.
Yeah, right. I mean, you're out there. You saw this. The fires are not too far from you out there.
I mean, you talk about, so I'm based in Los Angeles, and you talk about all up and down California. You saw, even Santa Clara, people in Marine Valley up in the Bay, 3 days of not having power. Just imagine, what do you do if you don't have family members? You can't go anywhere. And same in the valley with the Woolsey fire, huge destruction. I mean, people had like 30 minutes once they smell smoke to get out before their houses come out. And like you mentioned, I think as California as a whole, we haven't even really recovered from the fires from last year. And I think when you think about what do you do with the displacement of resources, you got the American Red Cross providing some shelter, but that's from them, right? What do you do? And it's tough because when you even with kids closing down schools, the air pollution, it's gotten worse.
Yeah. And I mean, we know about all this, and we know the costs still from last year's fires, and we know that California continues to battle. It's not as if all of these fires are actually extinguished yet either. No. Some of them are contained. I mean, we're watching that all play out. And despite all of that, it didn't stop President Trump from talking about Governor Gavin Newsom and the way that he's been handling the fires breaking out in the state. The president tweeting yesterday saying, quote, "The governor of California, Gavin Newsom, has done a terrible job of forest management. I told him the first day we met that he must clean his forest floors regardless of what the environmentalists demand of him." The president went on to say that every year as the fires rage and California burns, it is the same thing, and then he comes to the federal government for dollars and help. No more. Get your act together, Governor. Governor Newsom responded in his own tweet, writing, "You don't believe in climate change, you are excused from this conversation." Guys, obviously the president threatened to cut federal funding back in January. That didn't exactly play out. A lot of people we're saying that it's unclear if the president actually has jurisdiction to actually do that. But nonetheless, attacking the governor again over all of this. And it's clear that, I mean, I don't think it's as simple as just saying you need to clear the forest floor. I'm not sure. I mean, these fires aren't even burning in forestry areas anyways.
Yeah, these wildfires actually aren't forest fires, the ones that are burning right now. And also, California doesn't actually manage all of the forests inside the state. Actually, the federal government manages a huge portion of them. I just think ultimately, though, it's in really poor taste to threaten a state that is currently facing destruction. People who are losing their homes, and unfortunately some people who are losing their lives. For the President of the United States to use this as a sort of political cudgel against the governor there, to say he's going to refuse, much needed assistance to the state over their management of the fires. If you want to have a discussion about whether California is not doing what it needs to do to really make sure that fire prevention is their top priority, then you need to have that conversation. But you don't do it on Twitter. One, and you don't use withholding federal funds to assist people that are losing their homes and to assist the state to recover as the moment while the state burns. This is not the time for that.
I mean, as a California resident, and obviously whenever you see destruction like this, people, I don't want to speak for everyone there, solve the problem. Just help people. I mean, that's what we should be focusing on, no matter what side you're on, the table, left, right. Help solve the problem, get people to safety, and let's then try to have a conversation. I think that's no different from any other state, but especially with the people that are right now that are in need, I think this back and forth is something that takes away with what our resources and our energy should be facing on. I would hope that would be the case from everyone that's involved.
Yeah, it doesn't seem like you're getting much closer to a solution with that kind of back and forth on Twitter, nonetheless, as well.
Right.
All right, well, when Wi-Fi PM returns, we'll take a look at the biggest movers today, with the energy sector enjoying a nice pop as oil creeps higher on renewed U.S.-China trade deal hopes. Wi-Fi PM is back in 60 seconds. Let's check in with Scott Gamm on the floor of the New York Stock Exchange. And Scott, you're watching Dow gainers today as we trade near record highs.
Yeah, we've got stocks at record highs, Zach, that's right. And I wanted to start with some of the stocks that are actually leading us lower a little bit today. The worst performing stocks in the Dow are names like Procter & Gamble, McDonald's, and Coca-Cola. So you have some of the safer stocks in the market like P&G and Coca-Cola. We've got trade optimism today, so there's less of a reason to be buying those stocks. And then, of course, some stock-specific headwinds with McDonald's, of course, the company firing their CEO over the weekend. Now, the best performing stocks in the Dow today are names like Chevron, Walgreens, and ExxonMobil. It's no surprise that some of these oil components in the Dow and the broader energy sector are on the rise because we got that formal announcement of the upcoming Saudi Aramco IPO yesterday. We've been hearing about this for 3 years, but this announcement seems to be the closest we've ever been to some sort of action on this upcoming perhaps $1.5 trillion IPO. We also have oil prices rising. West Texas Intermediate crossing $57 a barrel today. That is its highest level in weeks, Zach.
Yeah, we're seeing a big pop in the energy sector on that. Last I checked, one of the stronger sectors on the day. But Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later on in the show. But just ahead on Wi-Fi PM, with lawsuits racking up at dating giant Tinder. We'll chat with ousted Tinder co-founder Sean Rad about the ongoing battle with parent company Match Group and where his $2 billion lawsuit goes from here. Sean Rad joins us right after this. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Kristen Myers, along with Drucker School of Management Senior Fellow at Claremont Graduate University, Ryan Patel. Guys, good to see you again. Let's check the market action right now that we're seeing, and you can see there the Dow up 114 points, the S&P up by about 14, and the NASDAQ up 52, as again, we trade near record highs. We'll watch closely for the close today, but a strong start to the week. Well, a court battle is brewing over Tinder. A group of former Tinder executives are suing IAC for $2 billion, accusing the company of undervaluing the dating app and allegedly being cheated out of stock options to capitalize on those valuations. The valuation, I should say. Joining us now to discuss is Tinder co-founder Sean Rad, along with Yahoo Finance's Julia LaRoche. Sean, we'll start with you. Last week, a New York State appeals court turned down IAC's bid to dismiss this lawsuit. So where are you hoping things go next?
Well, so they filed to dismiss. They lost that decision. They appealed, and they lost again by unanimous decision. So now it's full steam ahead. We're looking forward to getting to trial and showing the jury the facts of this case. There's some pretty strong evidence and damning evidence, and we're just excited to get paid and have IAC sort of hold them accountable to the contracts that they filed with the founders and the early team.
Now, Sean, let's talk about the broad case here with your lawsuit. And it seems to be that you all are alleging that they lowballed the valuation of Tinder. Now, I guess from their perspective, they might say, well, no, we actually unlocked value after you left the company. So walk us through your viewpoint, and how would you respond to their response there?
Well, I just think their response is ridiculous. We spent years building the company into what it is today. We had very clear agreements that outlined how we would get compensated for the value that we created. And when it came time to honoring those agreements, Match Group lied, they cheated, they did everything they could to avoid paying us billions of dollars that they owed the team who built Tinder. And if you look at what's the progress that has happened since our sort of valuation event, everything that's been launched has been in plan for years, and these are all things that we knew were coming. So there's no new information that wasn't available to the banks who were valuing Tinder back then. I think it's sort of just been business as usual. So nothing has really changed in the last year and a half or 2 years that we didn't know about back then.
Hi, Sean. It's Kristen here. So $2 billion is a pretty hefty number. How confident are you that you guys actually might receive anything close to that figure?
Well, actually, $2 billion is on the lower end. This number could go significantly higher. We're very confident. If you look at the evidence, which the jury will be exposed to soon, I think it's pretty clear and obvious what happened here. And Tinder's its success has continued just as we thought it would, and just as we presented to the banks when we were going through a process of valuing Tinder's future. But it's not just the value of Tinder back then that's in question. We had agreements that allowed us to own our stock and keep it for a many number of years. And those agreements were violated, and that ability to hold our shares, just like any employee at a startup or any founder has the ability to sort of keep what they earned, that right was taken away from us. So, this is a bit bigger than what the value of Tinder was in 2017. This is really about honoring contracts that you sign with your employees, and not violating them, and sort of people coming to work feeling that they could trust the company that they work for, which is not what happened for us.
Sean, it's Julie again. One of the things that the company IAC might point to, and they have pointed to recently, is the litigation funding. How do you respond to that when they're pointing to litigation funding and the approach that you all took there? And specifically, they're making allegations that two of the witnesses that are key to the case have benefited from that funding. How do you respond to that?
It is, look, this is what big companies do when they know they're guilty. They've done everything they can to distract from the facts of the case. It's so ridiculous. We have a litigation financier. We're individuals. We can't afford to sue a multi-billion-dollar conglomerate. So there are financiers who reviewed our case. They're in the business of providing financing to pay for legal bills for us to go and fight this case. They spent months diligencing this case, and they decided to invest in it, which I think tells the public and I see more about the strength of this case than any fictitious story that they're trying to come up to distract from it.
I mean, right now, I just want to read the statement that we have from IAC that states that this baseless lawsuit has no more merit today than it did over a year ago when it was filed. We look forward to defending ourselves in court. That being their statement, so just want to get their side out there as well, as of course we're talking about this. But it sounds like, I mean, you've obviously stepped away when we're talking about Tinder, that the product itself carries on now under the Match Group umbrella, and Match Group reports earnings after the bell tomorrow. Just curious to get your thoughts on the dating space in general, though. As you said it yourself, I mean, the company continues to be successful here. What are your thoughts on how the dating space might have changed from back when you were involved to what it is now?
Well, I think the innovation in the dating space since Tinder has been generally incremental. There's nothing that has sort of created a shift the way Tinder did. So I think Tinder is still, and I think will be for a very long time, the clear leader in the space. Anywhere you go in the world, you say the word Tinder, people recognize the brand and understand it. So while there's other apps that are doing things on the fringes or sort of focusing on niche parts or niche communities that Tinder hasn't yet to address yet, it's not going to change the fact that Tinder is synonymous today in society with dating, and Tinder sort of changed the way that an entire generation thinks about meeting and connecting.
Sean, there's no doubt that you all changed the dating scene with Tinder, but I just want to get your take as a founder of one of these well-known tech companies. And what do you make of just the environment broadly when you're seeing, we've seen WeWork flop in the IPO. Mm-hmm. I mean, from your viewpoint now, how would you do things differently? How might you advise your peers who are starting tech companies to do things differently?
Yeah, so I think there's this tendency when you're a startup to move fast, and moving fast sometimes mean that you will, you'll focus on short-term gains, and you'll sacrifice a little bit of maturity in the company in order to move fast. But I think if you're looking at being a serious business that is going to be accountable more to just your employees and your core base of investors, but the public, you need to very quickly mature your business, think about putting the right systems in place that I think that address all constituents and don't treat one party within the organization differently or unfairly. And I think, a lot of these tech companies, a lot of these startups and these unicorns, as they're going public, there's greater scrutiny placed on how they do business, their culture, their profitability. And these are things that I think they're maybe a little too late to address before they go public. My recommendation would be first get profitable. First, make sure that your business is sort of gonna test the public markets and then go public.
Well, it's interesting to hear you talking all about this right now, though, because I know you're working on a nonprofit right now. So I'm not sure if all of that is because are the reasons why you've shifted into this. But the new nonprofit's called Good Today, and dare I say that it's kind of a tinder of charity here when you're giving people the option of a social issue, and two different nonprofits kind of working on that, and the people through companies allowed to choose which they prefer to make donations. So tell us about Good Today and why you wanted to launch that.
Yeah, so it's an incredible way for millennials and employees at a company to wake up every morning, get familiar with the causes that are out there, and make a very simple decision, which is who's going to get your 25 cents today. It could be your own money or sponsored by your company. And the reason we created this is we believe that giving shouldn't be something you do once in a while. I think people want to be engaged. They want to give. They want to work at a company that has a sense of purpose and is involved in activism. But it's very difficult at the onset to sort of decide who gets your money and to discover what charities are out there. And then once you do, you can't build this ongoing relationship with the charities. The engagement, when it comes to giving, engagement is one of the hardest things to solve. So Good Today makes it extremely simple. It empowers a community, whether it's your company or a set of friends, to sort of determine what causes are important in that given day. And also start your day thinking about more than just your own problems at the company, your own problems, and understand that there are other causes out there, whether they're smaller causes facing our community or larger causes that we generally hear about. So the engagement has been incredible, and the response has been tremendous.
After hearing all that, I guess I'm going to retract my Tinder for charity, because it sounds like it's much more selfless than maybe perhaps thinking about a dating app. But nonetheless, Sean Rad, I want to thank you for taking the time and breaking all that down.
Thank you.
All right, appreciate it, Sean. Our thanks to Julie LaRoche as well for joining us, too.
Thanks, guys.
Coming up, Uber's critical earnings test after the bell today, what investors should prepare for. Straight ahead. Welcome back to Wi-Fi PM. Uber is set to report quarterly earnings after the bell today, and Yahoo Finance's Emily McCormick joins us now for more on what to expect. And Emily, I mean, obviously it's been a rough go for Uber since the IPO, but potentially this could turn it around. What are we expecting?
Well, that stock is down 30% since its IPO, so really trading below that $42 per share IPO price, just in the 30 to 31 range right now. If we look at the top and bottom line, still expecting a loss that's coming out to 63 cents per share on revenue of $3.39 billion. So that's up about 15% year over year expected, so about that same year over year pace of growth that we saw in the second quarter. Some of the things that analysts are going to be looking for is that breakdown between the various business components. So what does Uber Eats look like? What does the core rideshare growth rate look like? Because we've seen that Uber Eats really is the smaller piece of the pie for the overall Uber business, but it's growing much faster. So if we look at the last quarter, those gross bookings were up 92% versus just a 20% gain in that core rideshare business. And of course, gross bookings being the revenue that Uber is bringing in before you take out some of these discounts and incentives.
I mean, even when we talk about the food space in general, though, you just look at Grubhub and the pain that they've seen as their own kind of operating profits have taken their own kind of hits and losing share to both Uber Eats, DoorDash. You could keep looking at it in the delivery space, unless they do become almost the sole monopoly standing there in the food delivery space. I'm not sure if investors are yet sold on that kind of being the main driver. I mean, you could see growth there, but nonetheless, the main question is still boiled down to what we're seeing on the Lyft side as well, is when will this company reach profitability?
Well, it's interesting that you bring up the Grubhub sort of fiasco, because that's something that analysts are really taking as a good sign for Uber and Uber Eats going into this earnings report, because Grubhub had specifically pointed out Postmates, Uber Eats as taking share from it, so it could actually be constructive for Uber, and we'll probably see that later today. If we look at profitability, you know, this is coming just a week after we got the reports that Uber plans to now be adjusted EBITDA profitable a year earlier than expected at the end of 2021. Uber hasn't been as clear as to when it expects profitability, but it did say in the second quarter that it expects 2019 to be its peak investment year. Investment, of course, being a euphemism typically for losses. So we should potentially see things start to turn around next year.
Yeah.
How critical do you think investors are going to be as they are looking through the financials and at these numbers? Because we've started to see Pinterest had this happen recently. Right. Investors are becoming increasingly tired or fatigued, I think, after seeing these companies go public and then the numbers just really not panning out. I'm wondering how, for this quarter, how critical do you think investors are going to be looking at some of those losses?
Well, one of the things that's interesting about this quarter, and we just saw that for Beyond Meat too, is that this report is coming just a couple of days before that lockup period ends for the post-IPO. So we saw with Beyond Meat, they had great numbers, raised guidance, beat on the top and bottom line for the reported quarter, but shares still tanked overnight and into the next day of trading because of that lockup expiry. So Uber's is actually taking place on Wednesday. We have seen this stock be much less of a high flyer. I mean, not a high flyer at all, completely sinking since the IPO. So we could see, maybe that early investors don't want to cash out necessarily at this initial expiration date, but that could stir up some extra volatility too.
A lot of euphemisms we're using here. Not a good sign when you're describing a stock. But Emily McCormick, thank you so much. We'll be watching for Uber's results after the bell.
Thanks, guys.
Well, next up, with Halloween in the rear view, it's officially holiday shopping season. So how are the different generations gearing up to shop, and which retailers are poised to win? We'll dig into that right after this. Welcome back to Wi-Fi PM. The rally continues to start the week. You can see the Dow up 105 points, the S&P up by about 14, and the NASDAQ right now, as you can see there, the biggest gainer on the day. We'll see where we go as we approach 2 p.m. Eastern Time. Well, as the holidays inch closer, a new study is revealing how millennials might differ from other generations when it comes to shopping. And joining us now with the details is Yahoo Finance's Sabeel Marcellus. Sabeel, what can you say about millennials and our shopping behavior?
So, the pursuit of the perfect Thanksgiving, Christmas, and New Year's is one of the main reasons why consumers with credit cards are willing to go into debt this holiday season just so they can afford it, just so they can buy gifts for their loved ones, for their kids. And what we're seeing is creditcards.com put together this new report, and it's millennials, the generation that's the most willing to admit that, yes, the holidays for them does justify going into the red and taking on a lot of credit card debt. Now, this is very concerning because a lot of Americans are living on the edge right now. Like during the 2008 financial crisis, we had peak consumer debt at $12.7 trillion. But right now, it's at $13.9 trillion and moving higher. So it's very concerning that consumers are feeling so much pressure that they feel like they need to go into credit card debt to be able to afford the things that they want to buy this holiday season.
Yeah, and I wonder how many of those is just, millennials needing to jump into debt, I suppose, as well.
Yeah,
they have no money to buy gifts.
I'm so glad you said that because millennials are in a lot of financial straits.
Yeah.
Because they're facing a lot of challenges. There's the student loan debt crisis we talk about, like the $1.5 trillion crisis. Plus, many millennials have a tradition of traveling home for the holidays. So you're talking about airfares and the airlines, they love to capitalize on that. And also millennials who have kids. When you have kids, they want things. Santa is supposed to bring them their whole list, and parents just want to keep up, and they want to make sure that their kids have what they want and have a nice Christmas, a nice holiday season, so that adds even more pressure. And the report also found that people who already have debt, they just bury their head into more debt.
Yeah,
They're going to spend even more with their credit card this holiday season.
You can't go home and say, hey, Pops, Mom, I got you nothing because I'm in debt. Although maybe you could.
Yes,
maybe
you can,
could.
because you should say, Merry Christmas, at least I'm not living in your basement. So, I mean, that's a silver lining.
You can't say that to your little kids, though.
That's true.
They're living in your house.
Well, that's so interesting. You got consumer confidence is a different number. It's high. Then obviously that ties into what you were just saying about the credit card debt. I mean, what about the Gen Z? Did it talk about anything about the Gen Zs and kind of how that influences as well?
Yeah, so not so much about Gen Z because they're just like coming up. So millennials are really the ones that are in their late 20s, early 30s that should be more established, but they're not really. Let's remember a lot of millennials graduated into the recession. So when they actually did get a job, often the salaries were really low, and currently, they have less wealth than boomers had when they were in their 20s and 30s. I know there's a lot of generational wars going on right now between boomers and Gen Z and millennials. But there is some facts, some truth to the accumulation of wealth is not as strong as it was for the boomer generation.
Yeah.
Is there at all any part of this about the fact that millennials right now are in this age group where they might be willing to take on more debt because as they're looking at it, they're like, okay, I've got a much longer tail, right, to pay that debt off. Whereas if you are a baby boomer, or you're already someone who's already retired, you're like, oh, I can't really be taking on this debt right now for something like Christmas, especially as I'm looking to retire.
So overall, with people with credit cards, 45% are willing to go into debt during this holiday season just to be able to afford the shopping. But when it comes to millennials, it's really about they don't want to go into debt. Many of them are broke. And that's the only way they can actually afford a lot of these things that they want for their loved ones. So that's what we're seeing here.
Yeah, and I mean, generationally, the pressure's the same to get a good gift. Whether you're 20, whether you're 30, 40, everyone's counting on you to get a good gift.
But
and it keeps starting earlier and earlier.
And you could save money. Maybe instead of buying Louis Vuitton heels for your girlfriend, maybe make a homemade pie or something like that.
Yeah, homemade pie is very big these years.
Cheaper gifts. Show other types of skills if you
My
can't
kids won't buy that.
Yeah, got you a pie. Sorry.
What?
Oh, you wanted AirPods? Well, I made you a
Yeah.
cranberry. All right, Sabeel Marcellus, thank you so much. Ryan Patel, thanks as well. Christian Myers, thanks to you. As always, let's check in with Scott Gamm on the floor of the New York Stock Exchange. He's with trader Peter Tuchman. Scott?
Hey there, Zach. Thanks very much. So, Peter, what do you make of the record levels again today in stocks?
Okay, so I think it's really important to note I don't think it's about trade optimism. I'm taking that out of the equation now, going forward until it's locked in stone. I think it's about the fact that 65% of the companies have announced earnings that were better than expected, I think, give or take, or good. Okay, I think the revised numbers on payroll from last week that came out, non-farm payrolls were better, revised months coming into that, so that the condition of the consumer sentiment, consumer spending, and and just consumers in general seem like coming into the Christmas season are in good condition with a little bit of gas from the Fed. I think it should be a good couple of months coming up.
So basically all of these good things, even with a lot of trade uncertainty, the fact that we were able to get those good jobs numbers, a good GDP report, good earnings, even with headwinds in the background.
Correct. I think that to offset the headwinds of the uncertainty about trade, which has been going on for virtually 2 years, I think that's where the Fed put the bandage on that problem. That's sort of out of our focus. And I've said it over the last couple of weeks. I think the market's very ADD. It likes to focus finally on things that have fundamentals behind them and things they can sink their teeth into. And the China trade story is no longer anything like that. It's up one day, down another day. But the things that are in our direct focus right now, which is the fact that the Fed's putting fuel on the fire, the fact that the consumer is in good condition. Yeah. We've got Christmas season coming up. That's what it's focusing on. We got to break out above all different all levels, technical levels here. So I think the higher ground is the way to go.
Now, just quickly, the last 2 times we hit record highs in late July and early May, those levels did not hold, largely because of trade tensions.
Correct, but I think we've got a little bit of a backwind coming into it, and I think that those levels we hit them in sort of. We didn't get as much of a breath above the highs before that. There's breath here. We're at 27.5 really quickly. We're at almost 3,100 in the S&P. So there's some breath between the most recent breakout and here, right? So there's backwind into this. Right. Into this situation.
Peter Tuchman,
looks good to me.
Thank you so much, as always. Zach, back to you.
All right, coming up, McDonald's CEO is out at the top of that company in the latest leadership exodus. We're breaking down the details next. The ticker starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Akiko Fujita. We are breaking down the biggest stocks to watch today. We've seen the Dow hit a fresh record today. It is up 115 points right now. The S&P 500 and Nasdaq also firmly in the green. Let's start with our big three tickers. McDonald's is disclosing how much ousted CEO Steve Easterbrook is getting in severance. A federal probe into Under Armour's accounting practices sending its shares nosediving. And Berkshire Hathaway is disclosing a mountain-sized cash pile in its latest quarterly results. Let's begin, though, with the latest developments on McDonald's this afternoon. A top executive now stepping down a short time ago after now former CEO Steve Easterbrook was fired over a relationship with another employee that violated company policy. And we are seeing shares under pressure throughout the session, down nearly 3% right now. Let's bring in Jared Blickery, who is at the Wi-Fi Interactive Board. Jared, let's talk about the latest exit here and the implications for the company, because even prior to that, because of that big exit over the weekend, we have seen the shares under pressure.
Yeah, we don't have as many details as we do about Easterbrook, but this is basically the head of global HR. So it's a pretty big spot, and he is resigning suddenly. We weren't expecting this. We weren't expecting Easterbrook to resign either. It makes you wonder, does he know something? Was he involved in some way? But that's all speculation at this point.
So there's also a big question mark here about what Steve Easterbrook's exit means for the company. He really saw the turnaround of McDonald's, not only in this shift to digital, but also in a shift towards more healthier ingredients as well. What are you hearing from some analysts out there who are watching McDonald's about the impact this could have?
There's some concern because he does have to prove himself. This would be Kempczynski, and we have some analyst notes on this. So here's what Barclays is saying. We're confident McDonald's has the depth and leadership to maintain momentum as a global QSR leader. That would be quick service restaurants. We're buyers on any stock weakness. And then as of Kempczynski, he has overseen the most comprehensive transformation of the U.S. business in McDonald's history and has strong relationships with U.S. franchisees. That's very important now. He doesn't have the global franchisee relationship, but he does have it with the U.S. counterparts. And there is some unrest among the franchisees because he's very data dependent, and that's kind of a change, whereas in years past, they would go with their guts as to what's best for the company, but he does have that relationship. So if we move on, we can see Credit Suisse now is saying McDonald's has a talented bench, and we expect management and the board have a like-minded strategy and view momentum as sustainable despite Easterbrook's departure. Kempczynski co-authored the Velocity Growth Plan, and we would not expect any meaningful changes to the strategy. And finally, we have UBS. Today's news likely adds uncertainty to investors' list of concerns, which already include decelerating U.S. comps, negative EPS revisions, and U.S. breakfast competition against a backdrop of valuation rewritings across QSR. We expect Kempczynski to remain focused on U.S. and global growth priorities and creating value for all stakeholders.
Okay, thanks so much for that, Jared. We are also watching Under Armour this afternoon. Shares there are plummeting after the athletic retailer confirmed a federal probe into its accounting practices. They released a statement that reads in part, quote, Under Armour is cooperating with the U.S. Securities and Exchange Commission and the U.S. Department of Justice investigations. The company began responding in July of 2017 to requests for documents and information relating primarily to its accounting practices and related disclosures. And the company firmly believes that its accounting practices and disclosures were appropriate. Brian Chung is with me here at the desk. And Brian, we should note the company did also report earnings today, which beat on the top and bottom line, but that is kind of outweighing the big concerns into this investigation. So walk us through what we should be watching for.
Yeah, and you can see it from the stock movement right now. It seems like even on a positive day for the market overall, this is a company that is struggling in trading today, as there are these concerns about the SEC looking into their accounting practices going back to July 2017. So not an incident that's isolated by any means to the report that was released today, mostly a separate issue than that. You can see the numbers ahead of you. They did beat on the top and the bottom lines, revenue of $1.43 billion, and on the bottom line beating with 23 cents of adjusted earnings per share. But the company saying pretty clearly in both the statement that they released in response to that Wall Street Journal article, which originally broke the news yesterday, and also in an earnings call with investors today, that they are cooperating with the SEC, but that they firmly believe that their accounting practices were appropriate. This has to do with the revenue recognition, kind of similar to the same practice that the Kraft Heinz company was accused of by the SEC, a few years ago. What's important to note here, though, is that it is kind of conspicuous timing that this is also falling in line with Kevin Plank, who is the current CEO, actually leaving the company He made that announcement not so long ago that he will be leaving effective January 1st. He'll be succeeded by the current COO, that is Patrick Frisk. But this is a company that's had 3 CFOs, 3 between 2016 and 2017. And as the company disclosed, the problems really began in July 2017. Actually, who knows if the SEC might unearth anything that's even earlier than that. But that's not really very good. And the optics of that were already kind of bad for a company that is struggling to try to take market share away from Nike and Adidas. So this is a big turnaround story that I think is weighing heavily more on Patrick Frisk, who's going to have to take over beginning next year.
Well, as you point out, there's also a lot of questions around the strategy for the turnaround with Under Armour. Obviously, they've had struggles in North America. We got the new numbers out today for their most recent quarter. The headline number was good, but you mentioned the outlook. They downgraded. And then, of course, if you look at something like footwear, that was a steep drop.
Yeah, their footwear fell 12% to $251 million. Important to note, though, that Under Armour's majority business is really their athletic apparel, which has actually increased by 1% to $986 million. But look, the numbers that you see in North America, which is a key focal point for their business, down 4% to $1.01 billion. But I think that investors are really focused on, despite the fact that they beat earnings for this quarter, their outlook for the future. So their revenue guidance for the full year 2019 has actually been revised down. They now only expect revenue to grow about 2%. This is compared to previous guidance of 3 to 4%. They said that this is because of the excess inventory that they've had, what they call traffic and conversion challenges with the direct-to-consumer model, which is kind of a very novel part of Under Armour. And then the third part is negative impacts from changes in foreign currency. Those are all top-line risks, right? Bottom line risks, which have not been a part of that forecast, include now this SEC investigation. So if you're an investor, you're probably not too excited, and again, that this is really a heavy lift for Patrick Frisk to turn around come January 1st.
That chart we just showed pretty much tells you the whole story. The stock is down more than 19% right now. Thanks for that, Brian. Our third ticker of the day is Berkshire Hathaway. Shares are popping after Warren Buffett's conglomerate reported quarterly operating profit that beat expectations. The company ended the quarter with a record $128 billion cash pile, despite repurchasing $700 million worth of stock. And as Foray is with me, and as we're going to get to that cash pile in just a bit, but let's talk about what Berkshire said about how trade tensions with China have affected the business so far.
Yeah, Akiko, basically, this has been a quarter which is sort of a new peak, as some analysts had said regarding this quarter. Their operating profit was up 14%. Operating income came in at $7.86 billion versus an estimate of $6.88 billion. Revenue was up 2.4%. Their cash pile, as you just noted, is coming in at $128 billion. And this is despite that investment that they made, that $10 billion investment in Occidental Petroleum. Now, as far as their earnings for the quarter, they were boosted, helped by their stake in Kraft Heinz, because that came in at $467 million. That came in all in one sum, because in the first half of the year, Kraft Heinz hadn't been reporting because of their regulatory probes, those regulatory probes into their accounting. So those were sort of left as some blank lines. But certainly Kraft has been a headache for the company. In February of this year, Berkshire put a write-down of $2.7 billion given its stake in Kraft Heinz. So it's been a bit of a disappointment. As far as its railway business, that has also helped them as well. The company, BNSF, posted a record profit in the quarter. Volume was down, but they had higher rates on shipments, and they cut costs as well. So they also had some floods earlier this year, which had closed off some of their routes, but now they're operating fully. So as far as a quarter is concerned, still this is a solid quarter for Berkshire Hathaway.
And as quickly on that $128 billion cash pile, when you look at the stock performance, it is up on the year, but it's on track for its worst performance in roughly a decade. So that's got a lot of investors, it sounds like, kind of asking why hasn't Berkshire initiated more stock buybacks or share buybacks?
Yeah, so they repurchased $700 million in shares this last quarter. For the total of 2019, that would be $2.8 billion. That's a record for Berkshire Hathaway. Last year, the board had loosened some of its rules for share buybacks, but it's certainly leaving some analysts wondering why are they not buying back more, and what will they be doing with such a big cash pile?
Okay, thanks for that, Inez. Well, U.S. equities are seeing record highs as Goldman Sachs shifts its view on U.S.-China trade relations. The bank's chief U.S. political economist says he believes tariffs on imports from China have, quote, likely peaked. He also notes Goldman expects those tariffs to remain at current levels through 2020. Joining me now is Nicholas Economides. He is a professor at NYU Stern School of Business Economics. Professor, it's always good to have you on.
Thank you.
We heard what Goldman Sachs thinks about these tariffs. What's your base case right now in terms of where things stand on U.S.-China trade?
I think it's likely that there will be some deal. It might not be a 100% deal, but it's likely to be an 80 or 90% deal by December. And that would mean that tariffs would fall. And I don't think I agree 100% with Goldman, where Goldman says they expect the tariffs to persist.
What is your expectation then?
Well, my expectation is that there's going to be a deal, and a big percentage of these tariffs are going to disappear by the beginning of 2020.
The beginning of 2020.
Correct.
I mean, from a market perspective, is it really just enough to have this kind of put on hold? Because there's some questions about how substantial this deal could be. If we're talking just strictly trade phase one, we're talking about additional agricultural purchases, but maybe not really sort of the more complicated structural issues like IP theft. Does that, you think, from a market perspective, really matter, so long as these two sides are playing nice, if you will?
I think it does. In fact, the market cares much more about both sides playing nice than for the structural issues. I think the structural issues will be hard to fix. It will be hard to fix in 6 months. It will be hard to fix in a year. So those are not going to be fixed. But at the same time, I expect that both sides are going to declare victory in December, and the market will calm down, and there won't be that type of risk anymore.
Going back to this note, though, Goldman also says U.S. stocks reign supreme among assets as we see a slowing in global growth. Isn't the argument also, though, if you look at, there's been so much talk about the slowdown outside of the U.S., but if you look at a place like Germany, for example, a lot of that has to do with the trade tensions, right? So what happens if the U.S. and the Chinese reach some kind of deal? What does that mean for some of these other trade-dependent countries that have seen a slowdown?
I think it would put a tremendous pressure on the European Union to make a deal with the United States, to make sure that they're not in a worse position than China. It will be hard on them otherwise. So does this mean that our manufacturing are going to go to full blast? I'm not completely sure. There is still some delays, lags to make that happen. But I expect that by the end of 2020, except for the internal political risk of the Trump administration versus the Democrats, except for that, the other risk, the trade risk and the issue of a recession in Germany are going to are going to be alleviated to a large extent.
So given some of the movements that we've seen on the geopolitical risks that you highlighted, how's your outlook change going into 2020?
I'm optimistic about 2020. I think that what we don't see is a pickup of inflation, but that's because of productivity increases. And therefore, I think the Fed should make adjustments to its model and not expect the same rates of inflation as 5 or 10 years ago.
What kind of adjustments are you thinking specifically?
Adjustments that take into account productivity, take into account that the American economy has growing productivity, especially in computing, in biotechnology, the high growth areas.
And finally, we haven't spoken since the Fed decision came down last week, and there's some questions about whether this pause was actually warranted. Why the timing now? What was your read on that?
Well, my read is that the Fed understands that its actions have more importance for the retail sector than the manufacturing sector. So I think the Fed is looking for ways to push the manufacturing sector to be more active compared to the retail sector, and hasn't found them yet.
And so why the pause then, if they haven't found that?
Because their impact was more on the retail side, and they have had a tremendous impact on the retail side. Maybe they don't think they're going to have much more on the retail side, so they're thinking of ways to make manufacturing ramp up.
What are we likely to see on that front?
Difficult to say. I really don't know what they plan to do. I don't think they have given indications on what they might do.
Okay, Nicholas Economides, always good to talk to you.
Thank you.
Coming up is a state takeover of PG&E on the horizon as California battles to gain the upper hand on wildfires. A top analyst weighs in next. Welcome back to The Ticker. Let's check the markets right now. We told you about the Dow hitting a record. It is up 102, although off of its highs in the session. The S&P 500 up 12 and the Nasdaq up 51. Let's head to Scott Gamm on the floor of the New York Stock Exchange, keeping an eye on the laggards in the Dow. Scott.
Yeah, it's important to look at the laggards in the Dow, especially on an up day. Those are Procter & Gamble, McDonald's, and Coca-Cola. Now, of course, P&G and Coca-Cola are some of the safer areas of the market. And on an up day, you've got investors fleeing some of those stocks in favor of some of the more riskier names out there, especially the trade-sensitive stocks. And then you have stock-specific news surrounding McDonald's with the departure of CEO Steve Easterbrook, so some negative headlines surrounding McDonald's. Now, the Dow, as you mentioned, is at a record high today, and it took quite some time for the Dow to reach a record high. Remember, the S&P 500 did that days ago. The best performing Dow stocks today are names like Chevron, Walgreens, and Exxon. And of course, the broader energy sector is up as well today. The entire oil patch really getting a boost from the news we got yesterday, which was the official announcement of the looming Saudi Aramco IPO. We, of course, have been hearing about this for quite some time, but this announcement seems to be the closest we've ever been to some sort of decision on what's going to happen with this IPO. You've also got oil prices surging today. West Texas Intermediate crossing $57 a barrel. That is the highest level in weeks. Oil finally moving out of its recent trading range. Akiko.
Okay, thanks so much for that, Scott. Well, we've been keeping a close watch on multiple wildfires over in California. And for PG&E, things are increasingly looking dire. California Governor Gavin Newsom saying the state could take over the utility company in the wake of its bankruptcy crisis. Take a listen.
We are gaming out a backup plan. If Pacific Gas and Electric is unable to secure its own fate and future and work through the process of getting people together and working to address the needs of debt and equity and bondholders and lawyers and victims and subrogation claims, then the state will prepare itself as backup for a scenario where we do that job for them.
Let's bring in Praful Mehta. He is a lead analyst of utilities and renewables at Citigroup. Praful, it's good to have you on today. Governor Newsom there talking about sort of this almost a worst case scenario, because right now we're still looking to that June 30th date next year when PG&E has to meet that deadline to get out of bankruptcy. We've got this shareholder meeting coming up this week. The governor's meeting with shareholders as well as the victims. What are we expecting on that front?
Yeah, so right now you have two big groups that have their own positions. You have the shareholder group that has their own plan in terms of an exit, that is exit from bankruptcy, and you have the bondholder plan who has their own plan for an exit. In the bondholder plan, the current shareholders get completely diluted. They are paying $25.5 billion to all the victims and the subrogation claims. The shareholders are paying $18.9 billion. So you have these two big camps with very strong views, and you're trying to have a global settlement to ensure that everybody comes together so you can get this process moving forward and you can allow for PG&E to exit by June 2020. So that's the governor's goal, but it is extremely difficult in my view to get these two parties together. That's ultimately the attempt, but we'll see how that goes.
So that seems to suggest that you don't think PG&E can meet that deadline by June 30th, which means inevitably the state's going to step in.
Well, I think it is difficult to meet the deadline, but all parties are interested in ensuring that PG&E does meet the deadline, because both the shareholders and the bondholders want the PG&E value to be there, because then that's how they make money. But in the end, hitting that deadline does mean somebody needs to compromise. And right now we don't know who that is, and that's why the governor is pushing. I don't think there is a credible plan for the state to step in right now, because that is an extremely complicated next step. But even if they can't step in, if they apply enough pressure here to get these two parties to agree to something, it might help get them to exit by June 2020.
So we're not expecting any kind of quick resolution. But in the meantime, what happens to PG&E customers? There's, of course, the immediate concern about the wildfires, and that's being fought on the ground. There's the blackouts that have been rolling out, although it sounds like this week there won't be any additional blackouts over in California, at least from PG&E. What about the customers themselves, though?
Yeah, look, I think there has been a significant improvement. If you look at the last couple of years, then the amount of damage that you've had to structures was more in the 20,000 structure range. This year, with all these fires, Kincaid's more like 430 structures damaged. All the other fires are 100, 200 structures damaged. So it's a small fraction of the damage that you've had in past fires. So I do think that the fire suppression efforts of California have been phenomenal. So I think there is improvement, and I think the customers will benefit from all that. So the efforts that the state is doing are really working, but it's not something that's a quick fix. It's going to take time and effort, as the governor's talked about.
You know, the PG&E's inability, or at least failure, to upgrade their infrastructure, and has been pretty well documented, not just with the most recent wildfires, but going back to what happened over in Paradise last year. What do you think this means for other utility companies, though, that are watching this? Is it a PG&E specific story, or is this likely to force a rethink of other utility companies?
I don't think so. I think there are a lot of utilities in the U.S. who are investing significantly in the infrastructure. They're very well-run utilities in the U.S. There are obviously winners, or some who are better than others, and PG&E clearly has not invested as much as it should have. So it's trying to fix it, but it had also a lot to invest in renewables. So the reason why PG&E may have done less on the T&D side, because they were buying a number of renewable assets or renewable generation, which has now been moved into T&D. So I think overall, the state of the U.S. infrastructure is still pretty good, but it obviously, in California specific and PG&E specific case, does need to be upgraded.
And finally, if we look at the stock itself, I mean, the chart pretty much tells the story there, but we're looking at a number of shakeups that could happen between now and June of next year. As an investor, how do you value this company, and what's waiting for PG&E at the very end of this process?
Yeah, so it is a very, very risky situation. So I would say somebody who's trying to look at it for the first time has to look at a number of scenarios before they get in. The way we value it right now is we look at two basic probability trees. We have a 75% probability that the bondholder plan succeeds, in which case the current shareholders get diluted to zero, the stock price is worth zero. We have a 25% scenario that the PG&E plan succeeds, in which case the stock is worth about $20 to $22 a share. So we do a weighted average, but obviously they are two very, very different outcomes, and it will really depend, as you said, between now and June 2020, how all of this plays out. Now, post-June 2020, whoever owns PG&E probably runs PG&E with all of these things in mind, because obviously the governor is going to push, the CPUC is going to push to ensure that PG&E is run well from this point forward. So I do think it'll be a better PG&E, whatever happens post, but we still need to get through between now and June 2020 to get to that post scenario.
But given the probabilities you just broke down, 75-25, pretty much PG&E as we know it won't exist in June of 2020.
Well, in the 25% scenario, your PG&E shareholders still have a $20 stock. So it will exist, but you're right. The ownership has already transformed almost entirely, right? The ownership base is completely different from what a traditional utility investor is. So that's already changed. So that transformation has already happened, and I think it'll continue to play out before now in 2020.
And we should note that PG&E did tell Yahoo Finance they are not disclosing a date for their earnings report at this time. I know you'll be looking out for that as well. Praful, great to have you on today.
Thank you.
Well, straight ahead, stocks rocket to fresh all-time highs. Are many U.S. corporations really in better shape than many thought? We'll have the details next. And later, Uber set to report its much-awaited earnings after the bell. What investors should prepare for, that's coming up. Welcome back to The Ticker. I'm Akiko Fujita. Let's give you a quick recap of the tickers we've covered in this show today. Our first ticker was McDonald's. It is sinking in the wake of the firing of CEO Steve Easterbrook, the now former chief executive, getting 6 months severance after having a consensual relationship with a McDonald's employee that violated company policy. The second ticker was Under Armour. It is tanking after admitting it is cooperating with the Justice Department and SEC over a probe into its accounting practices. Under Armour also reported third quarter earnings earlier today. That topped expectations, but the company cut its full year 2019 revenue outlook. Our third ticker, Berkshire Hathaway. It is reporting a record cash pile of $128 billion in its latest earnings report, while beating expectations on its bottom line. Berkshire also bought back $700 million of its own stock during the third quarter. And let's check the closing price of oil as optimism is growing over a trade deal with China. That's giving oil a slight lift there, up about 0.9%. 56.73 is the level we are looking at. Meanwhile, Saudi Aramco is moving forward with its IPO plans, formally announcing its intention for a domestic listing that is now set for December. Well, as earnings season starts to wind down, investors are getting a more positive picture of the health of American corporations than analysts had initially predicted. 3/4 of S&P 500 companies that have reported as of Friday have beaten estimates, according to FactSet, with the index setting 3 record closes last week, the newest highs since July, and the 3 major indexes are all hitting record highs yet again today. Joining us is Danielle Shea. She is the Director of Options at Simpler Trading, and Quincy Crosby. She's the Chief Market Strategist at Prudential. And Quincy, let me start with you because we're looking at record highs again today. What do you think is really driving the optimism right now?
I think there's a confluence of events. I mean, you just look last week, just for example, besides the trade truce, or it looks like a viable truce, regardless of what is inside phase one, you had the employment reports, not just a surprise to the upside, but you had 2 months of revisions upward. That's very positive because 68% of the economy is predicated on the consumer. And there were worries that perhaps we would have a much weaker number because of the General Motors strike. But the fact is the number was good, but the revisions helped bolster that report, that the consumer remains in good shape. And that also helped weaken the idea that a recession is in the offing, because if the market believes a recession is coming, we will see a 20 to 30% sell-off. So that helped. In addition, the Federal Reserve. That was very important, one word, significant, that they would not raise rates unless there was a significant boost in inflation, telling us that the Fed will probably be on hold for some time. And that also is helpful for the consumer as well, and also for the market.
Danielle, let me bring you into the conversation. I mean, Quincy rightly points out some of the data points that we got, especially that jobs report that pointed to the strength in the economy. But we also got other data last week, like business investment, that was much weaker than expected. I mean, how do you sort of connect the dots on that front, and what does that tell you about the health of the economy right now?
Well, we've known for some time that the economy has been weakening slightly, particularly because of the trade war. But what I feel at this point is that those fears were a little bit overblown over the course of the last 3 months. We've seen a lot of those high momentum stocks trading lower, such as cybersecurity, IPOs. But the test was really in earnings. And we know there are some companies that are trade related, like Caterpillar, that traded lower and didn't do as well on their earnings reports. But for the most part, the S&P is strong, earnings are strong. And so I think that we know there's a data point that the economy is slowing slightly, but we're still very strong.
Quincy, I see you're nodding your head here, but isn't there an argument to also be made that the bar was pretty low going into earnings, and so it wasn't that hard to beat expectations? How much do you read into that beat when you look at the overall number coming from some of these companies?
Well, absolutely. We do go into these earnings reports increasingly with the bar set lower, but the fact is the top line revenue growth for the companies that did beat was actually solid, and the guidance wasn't horrific. Going into the earnings report, you would have thought we would have horrific guidance from companies. That wasn't the case.
It's not exactly an endorsement, though, right? It wasn't horrific, but
no, but it was solid, and you're getting a sense also, just not from the U.S. You take a look at, you mentioned Germany in your last segment, the DAX. Basically looking at a global economy, despite the fact that the data releases are pretty negative, but the market was going up on the back of perhaps the global backdrop becoming more attractive, even in terms of the economic underpinning. One thing on a technical side, the market moving higher this way is forcing those shorts to cover. So I want to make it clear that a lot of this move into the market right now is short covering, and that's powerful. What you need now is for the money that's on the sideline to come into this market and take it and underpin it with some conviction.
So Danielle, let's pick up on that point. I mean, what do you think it will take for some of that money that's been on the sidelines to come back in? And at least on a personal level, what has that meant for your portfolio? What are some things that you're switching up?
So for me, now that we've gotten through this strong earnings season, I mean, we typically see a bit of a pullback after a strong earnings season anyways. And I think because the market has traded higher over the course of the past couple of weeks, we're due for at least a pullback to the mean, which would be around the 50-period simple on the daily charts and the indexes. And at that point, I'm definitely going to look for the high momentum stocks, especially the FANGs. I mean, those are absolutely critical. We need to see Microsoft holding on a pullback. We need to see Amazon holding up, Facebook, Google. As long as these market leading stocks can hold on a pullback, I'm going to continue getting into semiconductors. I also like housing here. And then, of course, the key tech names.
Okay, Danielle Shea and Quincy Crosby, great to have both of you on today.
Thank you.
Coming up, how Uber can prove it's getting on the right track when it reports earnings after the bell. Stay with us. Welcome back. Let's get our next group of tickers. Canadian cannabis company Aphria scoring a critical new production license. Uber trying to convince investors it's turning around its performance after the bell today. And Ferrari is kicking into high gear after reporting its latest results. But first to Aphria. The cannabis company received its license for cultivation at its Diamond facility. That location is expected to reach more than 100,000 kilograms of capacity. Brian Chung is back with me. The stock trading pretty flat. It's down just slightly. What does this mean in terms of the business for them?
Well, I mean, they can boost their supply by quite a dramatic magnitude. So, as you mentioned, they are going to, they got clearance from Health Canada to build a new production facility. This will be in Leamington, Ontario, which is just outside of Windsor, across the border from where Detroit, Michigan is. And this would supplement their current facility. They have what they call the Aphria 1 facility and also a subsidiary, Broken Coast Cannabis. But right now, they're producing around 155,000 kilograms, which means that this single new production space, which itself would have 140,000 kilograms, would more than double their current capacity. Now, of course, the question is, that's great if you have the capacity. Is the demand there for these products? And keep in mind that it's just Canada that currently has it federally legal. It's not like they can export any of those goods to the United States where it's not federally legal. So you have these questions about whether or not the demand is there. What we know is that the cannabis stocks were very heavily valued after the Canada originally legalized marijuana. This was about a year ago in mid-October. And since then, we saw prices go up on all those pot stocks and then come back down. So I think it's kind of interesting to see that despite the fact that Aphria is going to double their production, the stock's not moving all that much. So I think that investors are saying, we kind of want to see what the fundamentals of this new budding, no pun intended, business looks like before they try to decide where the stock should be properly valued.
When you look at the cannabis space as a whole and you point out the declines, how much of that has been about the demand picture? How much of it is just the fact that things on the regulatory front haven't moved as quickly as maybe some of these companies had anticipated?
I think it's more the regulatory than it is about the questions about demand. I think that there are a lot that say that it's kind of there's a lid on the current demand for cannabis products in Canada, simply because the fact that there's only a few players in the space, and they need to ramp up production. But I think that what we've seen is that the actual volume of sales is still very much limited in areas like Ontario, where the local government in that particular province has almost a complete monopoly on how these products are distributed. But regardless, when you look at the stocks of these companies, you're comparing it to Canopy Growth, for example, over the past year. I mean, look, Aphria, Aurora Cannabis, Canopy Growth, Cronos, these are all stocks that have been in the negative and vastly underperformed the S&P 500, which has been growing at about 12.5% over the past 12 months. Again, when you look at Aurora Cannabis, they've been down 51% for the past 12 months. You look at Aphria, down 58% over the past 12 months. So, I mean, these are stocks that you could argue maybe should have been at this level before the kind of exuberant investing went into it around February and March of this year. But it seems like a lot of steam coming out of these companies for right now. And I think that even despite the fact that this headline here with Aphria saying, hey, we're actually going to double our production, you have a lot of investors saying, we kind of want to see what the fundamentals of this industry look like first before we see what the long-term projections for these companies are.
Yeah, maybe investors have to be a bit more patient on that front. Thanks for that. Well, our fifth ticker of the day is Uber. The ride-hailing company will report earnings today after the bell. Analysts are expecting an adjusted earnings per share loss of 63 cents on revenue of $3.39 billion. Jared Blickery is back with me. And Jared, we are seeing the shares of the company under pressure ahead of the big release. Things didn't look as positive for Lyft last week, although it did seem to point to the turnaround that's starting to happen. What are we expecting from Uber?
Yeah, the path to profitability is a big question, and ever since the WeWork debacle, these companies are under a tremendous amount of pressure to become profitable and to also display growth. Growth is key here toward achieving a valuation that's favorable. Ask me about the performance here. It really hasn't been that great since the IPO. So this is a max chart. It shows that it's down 26.5% since its beginning trading day, down even more from its IPO price of $45. But Lyft hasn't fared fared much better. If we look at the two in combination here, compared side by side, we can see that Lyft is down 50%, and it's just been kind of a slow, steady decline. But investors are going to be focusing on some key metrics on top-line growth, such as gross bookings and also ride sharing. They've lowered their driver incentives, and so their margin should improve as they've also kind of gotten out of the fare war stage. But they have a lot of other businesses too, so there's going to be focus on Uber Eats as well as some of their other purchases. They just got into a grocery delivery business with a purchase of a South American company, so that's kind of interesting. But Uber Eats is facing a tremendous amount of pressure in margins, and we just reported the Grubhub earnings last week, and the Grubhub CEO said, you can only improve the logistics to a certain degree. It really doesn't scale because at the end of the day, you need one person's time for about 30 minutes. That's until we get robots, and so he's going to war with Uber Eats, and all of this means that there's a lot of competition out there.
So often we look at Uber in conjunction with Lyft. We're seeing the stock there side by side. Lyft last week did come out and say they expect to be profitable by 2021. How much of that will kind of set the bar for Uber, if you will? Should we be looking at each other to see who's ahead, or is Uber kind of trading separately because of all those other services that you talked about?
Yeah, it does have so many different businesses, and the scale is so much bigger. It's not a pure ride-sharing play, but I think it does up the ante with Lyft saying they're going to become profitable by X time. It just puts all that more pressure on Uber to do something similar. They certainly don't want to go back and have to access the capital markets at a reduced valuation. These are growth stage companies, and the stock market is performing well, but a lot of these IPOs simply haven't been over the last 2 months especially.
Okay, thanks so much for that, Jared. Well, our sixth ticker of the day is Ferrari. Shares are revving up after the luxury automaker posted solid quarterly earnings. Ferrari also raised its 2019 outlook on the back of strong sales of its Portofino and 812 super-fast sports cars. Inez Ferré is back with me. Inez, how do things stack up for Ferrari against the competition?
Yeah, it's a really exciting stock to watch because year to date, the stock is up more than 70% today, just hit a 52-week high. They've done a lot of things right in this last quarter. Shipments were up 9%. In September, they had shipments of that pricey Monza SP1. Those come in at about $1.7 million each, and they unveiled two models in September. They're unveiling a new car in Rome next week. They have this very aggressive plan, which they announced last year, and that was to unveil some 15 models by the year 2022. And they're on track to doing that.
And Inez, we're talking about Ferrari cars, but the company today talking about expanding well beyond that into apparel as well as accessories. What's the strategy on that front?
Right, so they're trying to diversify their brand and really make it up to par with the brand of the cars, correct? The luxury brand of Ferrari when you think of that brand. So they teamed up with Armani. They announced that they're teaming up with Armani for accessories. Now, and what they said during their earnings call is that they want to make sure that their brand is not diluted. So right now you could go to a mall, you could maybe go to airports and get some Puma shirts with Ferrari on them, or you could get some Ray-Ban glasses that are around $250. Well, what they want to do with this partnership with Armani is to make sure that they are upping the ante, so to speak, with respect to the price point that they're charging for some of these accessories, because their plan is that these types of accessories, these branded goods, will make up about 10% of their earnings in the next 7 to 10 years. That's an aggressive plan, but they're certainly working on it. They're saying that they're going to be reducing their licensing agreement by 50% and eliminating some 30% of their product category. So this partnership with Armani is very significant as they're hoping to raise prices on some of these accessories.
Yeah, trying to maybe spread the Ferrari allure.
Yeah,
we'll be watching to see.
Yeah, luxury.
Yeah, what kind of
all
products come out of there. Thanks so much for that, Inez. Well, we're off for a quick break, but coming up, how the California wildfires are triggering a major surge in solar power demand. We're going to be speaking to one company. Stay with us. the wildfires in California and ensuing power outages have put solar companies into the spotlight. Many residents trying to become less reliant on the state's power grid. Boston-based Energy Sage says demand for solar installation and PG&E's service area more than doubled in the last few weeks. Joining us now is the founder and CEO of Energy Sage, Vikram Agarwal. Vikram, it's great to have you on today. Walk us through exactly where your company fits in the overall sort of solar infrastructure and what kind of demand you've seen since these power outages began to be rolled out last month.
Great. Thank you, Akiko. Pleasure to be here. Yeah, Energy Sage is helping homeowners and businesses shop for solar. So we are an online marketplace that helps people get competitive bids from solar companies that allows them to compare them on an apples-to-apples basis and make the right decision. So over the last several weeks, since the first shutdown happened in the PG&E territory, we have noticed a significant increase in demand for not only solar, but also storage energy systems. As you mentioned, we have seen people actively shopping for solar almost over double in these weeks, over the last several weeks since the first shutdown happened.
Vikram, you've pointed out that anytime there is a natural disaster, whether it's a wildfire or a hurricane, you've often seen this kind of surge. How do you think what you've seen play out in California over the last month or so differs from what you've seen in the past?
Absolutely. I think the interest in solar and storage, we have seen this happen back in 2016 and 2017 with big hurricanes in Florida and Texas and Puerto Rico. The demand went up. But California is a little bit different. I think when your utility is actively shutting down power, it really hits it home. And I think, as you know, solar is already very popular in California. Almost 1 million homeowners have solar on their homes. And a lot of these homeowners are now thinking about adding battery storage systems to their solar energy systems. And those who have been sitting on the sidelines thinking about adding solar are now actively jumping in the market and saying, hey, I've been thinking about it for last several years, but this is it. I need to now think about installing solar and even pair it with battery storage systems.
And how easy is it for some of these homeowners to do that? You know, we've heard a lot of stories being written about a lot of these communities wanting to start their own microgrids, talking about grid defection as well, so they aren't as reliant on these utility companies. But how easy is that actual transition, and where's the price point?
Yeah, I think there are two separate questions that you're asking. Let me answer the second one first. I think in terms of the price point for solar and storage, I think the economics of solar is really attractive in California. And especially for battery storage systems, there are excellent state incentives that decrease the price pretty dramatically. And when you pair that with the federal investment tax credit, you can really reduce the cost. But as I mentioned, I think as when you lose power, people start thinking more about resiliency and make their decisions more on emotions rather than just pure economics. So just based on those two criteria, we are seeing that the interest in solar has really increased. Secondly, I think the whole idea of microgrids, of course, it is very interesting to have, or it would be very logical to have a microgrid or mini grid like system set up where power is being generated close to where power is being consumed. But I think for the near term, the utility is likely to be very integral to all of our lives. We will always be, we are more than likely be still connected to the grid, but we now have alternatives like solar and battery storage systems to reduce our cost and become more resilient.
And Vikram, very, very quickly, we're talking about independent homeowners right now, but I'm wondering if you've had conversations with some smaller cities, perhaps, those who have been affected by these power outages. What are you hearing on that front in terms of how they're rethinking power in their areas?
Yeah, we have had some limited discussions with different cities. As you know, in California, there is a concept called community choice aggregation. So a lot of communities are now taking control over how and where they're sourcing the power from and what kind of power they're sourcing, whether it is from fossil fuels or from renewable energy like solar and wind. So more and more cities and communities are now taking that under their control, and they are advising their residents to do the same and making more of these choices available. So we are working with community choice aggregators in California to educate their homeowners and businesses on their alternatives when it comes to solar and storage, and helping them make informed decisions.
Okay, Vikram Agrawal, appreciate you joining us today.
Thank you, Aki. Take care.
Coming up, Yahoo Finance's Heidi Chung braves the insanity around the return of Popeye's chicken sandwich to figure out how long the craze may last this time. Stay with us. Welcome back. Let's give you a quick recap of some of the tickers we've covered in the show today. Our first ticker was McDonald's. The stock in the red after the company fired CEO Steve Easterbrook. He's getting 6-month severance after having a consensual relationship with an employee in violation of company policy. The other ticker we covered is Under Armour. It's getting hammered after admitting that it's cooperating with the Justice Department and SEC over a probe into its accounting practices. Under Armour also reported third quarter results that beat expectations. And it's time for our last tick of the day. We are watching Restaurant Brands International as Popeyes brings back its popular chicken sandwich. The announcement coming after the fast food giant ran out of the limited time sandwich back in August. And we've got our favorite chicken sandwich reporter, Heidi Chung, with the rest of the Yahoo Finance crew. Heidi, you hit the streets of New York City yesterday to find out how the relaunch of the sandwich went.
Yeah, Kiko, so I went to 2 different locations here in Manhattan because I had to see if the hype was still alive, and it sure was, at least in Union Square. I went to the store at around 11:30 a.m., and the store was supposed to open at 11, but it opened 30 minutes late. So I was standing outside because I wanted to talk to some patrons who were coming out with their chicken sandwiches, and I actually stopped one guy, his name was Tristan, and he gave me some insight about what was going on inside even before I stepped foot inside the store. So here's what he had to say.
Tristan, so you got your chicken sandwiches right here.
Yes.
I just walked out. You're like the #2 customer.
Hopefully everyone has a decent experience. I feel they're woefully prepared for this,
You
at least
feel like they're
in this
unprepared?
location.
Oh,
yes.
wow, okay.
Because like I said, there's only like 3 people in there, two people, the manager, 1 person on, slowly putting the sandwiches together, 1 person doing the chicken, doing the fries. Like I said, I asked for apple pie day. That wasn't ready yet, so I was like, okay, forget that.
Okay.
Focus on sandwiches.
Just get me the sandwiches.
Yes, yes.
Heidi Chung trying to get more sandwiches there.
Yeah, as you heard there, woefully unprepared. There was only 3 people inside working. He wanted to get an apple pie, but they weren't even prepared to give him that. So at that point, all the people I spoke to, it was their first chicken sandwich, and they were all so eager at 11 a.m. to get some.
Okay, so we're talking about one location in New York City. Brian, you said that you were actually out in New Jersey, right? And
That's
you went by a Popeyes. Not the same situation.
No, not at all. I was in Rockaway, New Jersey, visiting my parents, and I actually foregone one of my parents' home cooking meals so that I could go to Popeyes and try it out myself. I rolled straight up to the food court at the mall, picked up a spicy and a normal, and headed straight out. It was beautiful.
I'm still waiting for my chicken sandwich here on the set. Have not stopped by myself. Jared, what do you think this means for restaurant brands? We've been talking a lot about sort of the big pop and at least the hype that's come back around Popeyes as a result of this one specific meal.
They've definitely created some buzz. This is something I think that happened in August, and it boosted their sales to an incredible degree. There's no reason they can't lap that next year with an even bigger offering, but they got to get their stuff together. If you can put an apple pie in the microwave for 10 seconds and serve it to a customer, there's something wrong there.
Yeah, good point there. All right, and as you get the last word here, we're talking about Popeyes. There's also chicken sandwiches from Chick-fil-A. Are you going to go out there and maybe line up with the crowds?
Oh, yeah, I have to try that. I have to try the Impossible Whopper. I mean, I haven't tried any of this stuff. So I think it's interesting that they launched this again on Sunday when Chick-fil-A is closed.
Good point. All right, thanks so much for that, guys. Stay tuned for the final round. That is coming up next. Hello, everyone. I'm Jen Rogers in New York, and this is the final round. Stocks hitting all-time highs as the Dow races towards the first record close since July.
Miles, other than this, as U.S.-China trade deal optimism once again boosts investor sentiment. We'll have more on that and all the market action coming up in just a bit.
Plus, Uber and Shake Shack earnings coming out after the bell. We'll have those numbers for you as they break. And a shocking revelation at Under Armour, what this means for the company as we head into the busy holiday season. Plus, McDonald's CEO is out. We're breaking down Wall Street reaction in the Analyst Rumble. Right now, let's check out the numbers. We are on record watch as the final round here is in the heat. We're going to see, can the Dow do it? We have.
I mean, we got an 80-point cushion right now. It's fine.
You never know. It's the last hour. Look, we've had already the S&P and the Nasdaq. Now it's all on the Dow. A major average is getting a boost from energy and technology stocks. Investors are also optimistic about a U.S.-China trade deal. This after comments from Commerce Secretary Wilbur Ross that licenses for U.S. companies to sell components to Huawei would come very shortly, Miles. So this is going to bring up your favorite banner, except now it says record highs. But yes,
right,
it is.
Sure.
Stocks are higher on trade optimism.
Absolutely. Why not?
And that's what it is today?
Sure. It could be that if we want.
What else
it could
could it
also
be?
be that the market made a record high on Friday. It could also be that earnings continue to be a little bit better than expected. It could also be that investors are obviously discounting any fears about a recession overall. And so I think, trade is always close by any market move up or down. But honestly, I'm not sure how much trade at this point is going to be an incremental mover if it's not a major step backwards, right? Because I think the market over the last few weeks has started to fantasize about some Goldilocks scenario where this is all fixed. And I think by way of doing that has said, great, now I'll just look at the other stuff I'm interested in, which is mainly Jay Powell saying rates aren't going anywhere and we're not going to have a recession. So, look, we're never going to have a day in the market where we get any kind of notable move and there isn't some trade headline that we can say is a mover. Right, but
Trade's here.
the environment has changed quite a bit, I think, in the last 6 weeks. And it shouldn't be a huge surprise, right? We have earnings season. Now there's other stuff to talk about. There's all kinds of corporate stories. But, you look at the way the market, and you see it quite clearly in the chart here. Once we sort of bottomed out early October and we've been pretty much going up every day, during that period, the market has become a lot less interested, I think, in what's going on in the trade front.
One thing I find interesting today is the sectors that are leading. So XLE Energy is up over 3%, and financials, which, look, we're out of the part of earnings season when we talk about the financials.
Right.
We've had some yield curve steepening over the last month. We've seen financials come in here and be a better trade, but they're up almost 1% right now. And this hasn't been a sector that we've been that focused on. Kind of everybody's getting their day in the sun as we're heading back to record highs. Is there a laggard here that could be played that we're not focusing attention on, or is it right? It's actually pretty broad.
Well, the strength in financials, I think, is telling you that there's a belief among investors in the economy. Right? I mean, I think it's an old Dick Beauvais line, and I'm sure he didn't make it up, right? What are financials if not a leveraged play on the health of the overall economy? They touch consumer finance, housing finance. If the economy is doing better, all else equal, so too will financial sector names. And so, I think there's a lot of idiosyncratic reasons to not love financials, regulatory overhead, all that kind of stuff. Are banks really ever going to be what they once were? But, backing all of that out, if we are seeing a day where the market is overall expressing a view that there will not be a negative economic event, then you would like financials.
Of course.
After every sector that we hate has already gotten rotated through, right? We've done industrials, we've done materials. That's correct. Yeah.
And we're seeing financials and energy here again today. Not everybody's happy though, because Morgan Stanley.
Mike Wilson's never happy.
Well, Mike Wilson, he has some thoughts, and
he was right last year. He's been wrong this year.
Well, he's putting out a 10-year timestamp on this, so I feel like he has a pretty good chance of being right over a decade.
Sure.
Sees market returns tumbling over the next 10 years. Morgan Stanley coming out citing low growth, low yields, low inflation. Of course, that low inflation is going to mean that the Fed's not going to do anything, but that this is going to constrain returns. Again, this is over 10 years. You could see these coming home to roost.
My entire time in the business has been spent hearing about how future returns are expected to be lower. I don't know what to tell you, because the market's gone up 4 times in that time span. So, sure. I think the textbook would tell you that if growth is lower, then you can't have, we're not breaking news here. You can't have margin growth and profit growth forever if growth isn't going to do anything, because ultimately profit growth reflects economic growth. But, I don't know. They know more than I do. I'm not a CFA.
As we've seen before, though, a lot of the textbook charts we've had to put aside.
Right.
A lot of the curves that we got used to, we've got to put in a different box because they're not working this time.
Right. And I don't know. This is kind of like a, sitting around shooting the BS stuff that I talk about with Sam all the time. Mm-hmm. It's like, okay, so everyone knows that rates are low and inflation's low and growth is going to be low, but if we know all that, why do we have to assume the stock market would trade within norms in terms of price? Why doesn't the stock market trade at 24 times earnings, right? If it traded at 24 times earnings, the market would be at 6,000. That'd be fine. Why couldn't it?
Definitely
I'm just asking. I'm just saying, the rules are going to net you lower returns most likely. However, what if they're not true?
Set a low bar, and then you'll be happy.
That's all we've got.
Expectations.
Look, when we're at record highs, we can have these kinds of conversations. All right, for more of today's market action, let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Scott.
Hey there, Miles. Well, I wanted to give you a rundown of a couple of specific names we're watching right now. First up, PG&E. The stock was up for most of the trading session and then about a half hour ago had a sudden drop and has since rebounded somewhat. There was a story in Bloomberg saying that a federal judge wants to know the number of lives that have been lost in this year's wildfires that may have been caused by the company's equipment. Now, PG&E did not respond to Bloomberg's request for comment, so we'll continue to watch the stock heading into the closing bell for today's session. And then, as you guys were talking about earlier, of course, we do have stocks at record highs, especially the Dow Jones Industrial Average hitting a record today for the first time really since mid-July. That was the last record in the Dow. We're seeing significant strength in the energy sector today. We've got Chevron leading the Dow right now. ExxonMobil, the other energy component in the Dow, is the third best performing component. And then broader strength in the energy sector. And yesterday we got news that Saudi Aramco's IPO will happen. And that was sort of the most significant development on that front that we've really ever heard. I mean, we've been hearing about the Aramco IPO for years, but a lot of the reporting and announcements prior to this, what we heard on Sunday, was speculation. So clearly the market is reacting to some of that optimism today. And on top of that, you did have oil prices, at least for West Texas Intermediate, that's the U.S. benchmark for crude, cross $57 a barrel today for the first time in weeks. Oil prices have since fallen below that threshold, but finally breaking out of that narrow trading range that oil has been in for really the past 6 weeks, guys.
All right, Scott Gam live on the floor of the New York Stock Exchange.
Shares of Under Armour are tanking today after the sportswear company confirmed reports from the Wall Street Journal that it is in the midst of a U.S. accounting probe. The investigation allegedly centers upon whether Under Armour shifted sales from quarter to quarter to improve its financial metrics. The company also reporting third quarter earnings today, beating on both the top and bottom lines, but slashing its revenue outlook for the full year. It's hard, though, to get away from the accounting issues, even in the earnings mix here.
Yeah.
I have two, Jen's, like best practices. Don't talk about the balance sheet, and also accounting. Those are just like two. And then
just accounting?
What? I'm going to throw something else in there: is don't change your CFO too often.
That's right.
And Under Armour has a couple of these issues going on, right?
They do. I mean, look, I think we talk a lot about the Silicon Valley affinity for founders and CEOs, and we give them too much the benefit of the doubt. But obviously, Kevin Plank, who is going to be leaving Under Armour, should have left a long time before this. I mean, you look at what happened at Under Armour with, and I think when he said he was going to leave, people kind of looked at the Journal series of stories about behavior from Under Armour executives on company trips that were sponsored and overseen in some cases or attended by Plank or other, high-ish level executives, guys he knew back from Maryland, all that stuff. So I think that there was that kind of frat culture around it. But obviously, the business went nuts. I mean, they had a 6.5-year run of 20+% revenue growth.
26 quarters in a row.
Unbroken until 2016, and then it just stopped. And so I think, all we know is that there's a probe, but I think it's funny, I was reading the Journal story last night, and it's like the way they line it up, it's like, there was a 26-quarter run.
Yeah.
Then it ended. Then the CFO left, and now the Feds want, and you're like, how about that?
So let's pretend that the accounting part didn't happen, just for a little bit.
Sure.
Let's just pretend.
Yep.
The earnings, they're still having trouble. They are still, this ship is not totally righted at Under Armour. And I guess, we know that Plank is leaving, but you just have to look at the trouble spots here for what's kind of plaguing this company is the fashion cycle's not great. People aren't buying it. It's not cool.
Yeah.
If Sazi were here, he'd be saying it was discounted all over the floor of the last place he'd been.
That's right.
Can they change all of this amidst an accounting probe?
Well, I think if you look at what the stock has done over the last year and a half or so, investors did believe that there was at least an idea, perhaps, that this could be righting itself. And I think that the trouble with the departure of Plank and the trouble now with the accounting probe is that it's clear the company is going to have to go through another executive level transformation to figure out if they have the right management team in place, because the management team that people sort of talk themselves into is now no longer the management team, basically. So I think it's a long road ahead for Under Armour in a very, it's always been in a competitive space, but a space that they're clearly, what would you say, the fourth player, right? The fifth?
Well, I mean, there's obviously
Nike,
and
Adidas.
Adidas, and then what are we going to say?
Well,
there's always somebody in the mix.
It depends. Like, you kind of see it from the fashion side. Obviously, like your Lulus are ahead of it, but it's such a smaller company than Under Armour. But I mean, Champion, but that's kind of like niche. I think the trouble is that Nike and Adidas are so clearly the 1 and 2, sort of in that gear space, right?
I think so.
Yeah.
Reebok?
I guess Reebok. I don't know. It's hard to get excited about anything that's not Nike or Adidas.
We're both real niche.
Well.
Newton sneakers.
You still wear your Newtons?
I do.
Oh my
I like
God.
them.
All right, we got to talk about that. Coming up here today in the final round, McDonald's CEO is out in other executive departures. Wall Street analyst reaction is pouring in fast and furious. We'll break down some of our favorite notes in the analyst rumble straight ahead. But first, let's take a look at where European markets closed on this Monday.
Time now for our analyst rumble. These are some of the biggest analyst calls today of stock names you know. And today it's all about one name. The Street's reaction to the ousting of McDonald's CEO Steve Easterbrook. A couple of notes stood out to us. There were a slew of them. Let's start with Wells Fargo. Analysts there think the news will likely feed the near term and weigh on the stock. But the company's long-term story remains intact. They expect, quote, that McDonald's will continue chugging along on the tracks laid under Easterbrook's tenure. So how do you come out with this note? Because there's a little negative and there's a little positive.
Well, so when I think about the tracks laid under Easterbrook's tenure, I mean, to me, it's about the digitization of the McDonald's experience and to some extent tension that they have with their franchisees. And I think that there was a big initiative underway from the current, now former management team to engage with franchisees. I mean, a lot of the stuff they did with All Day Breakfast was great for sales, but the people who worked at McDonald's did not like it because it really made for a worse experience in some cases. And so now what? I mean, do franchisees feel like they have leverage against McDonald's to push back against some of their plans? I mean, the stock is down 3%, so obviously the market thinks this is negative, but it would seem to me that, to use the analyst term, there's a lot less visibility now around what exactly McDonald's has planned in the future.
There are some questions, but as they note here, he was a change agent, and he got a lot of stuff done in the face of some difficulties. You got to remember when he started, a lot of people had written off McDonald's, but the remodeling nearly of the entire U.S. fleet, the menu simplification, that's not changing.
Yeah.
That's already, that's gone. The train, the plane, whatever, has left the building. So,
sure.
Yeah, I don't know. They have a train analogy here.
Right.
But that's not going to change. It's just there is some question, I guess, in terms of the execution going forward. Anytime you have a CEO leap, but I think a 3% move, that's not terrible.
3% here, 3% there, you know.
Sooner or
it's all
later.
right. I mean, speaking of firms that think this is fine, Credit Suisse says this is a buying opportunity. Good old-fashioned BO with any kind of sell-off. Credit Suisse thinks McDonald's management, it's in good shape, sees the company's momentum as sustainable despite this departure. So I think on that side, and this was a theme that came out in most of the research that we saw today, was a sense that this isn't great, but also the stock is it's $20, $30 off of its most recent record high, which it hit back in the summer. And so we can't look at an additional 3% or an additional 5% move as a real reason to get more structurally bearish on the story.
Right. Credit Suisse saying that any material pullback they see here as a buying opportunity, and calling out the talented bench, which you have to admit for how fast this
minus
came
the company's
down.
HR head, who also then left.
Yes.
So,
what do they call it there? The people person?
Yes, CR.
Yeah, it has like a name like that.
I'll
People
find it.
person. You look.
Yeah.
But the talented bench, at least getting a new CEO in here who already seems to know Wall Street pretty well. Kapczynski also co-authored the Velocity Growth Plan.
Right.
Did you know the Velocity Growth Plan?
I'm
He's
aware.
a co-author of it,
That's right.
so that seems to be something that you can write home about here. Outperformed $230 price target, not backing away at all from that at Credit Suisse.
Chief People Officer.
I told you, something to do with
CPO.
people. CPO.
Right.
Human relations is so old. People. Meanwhile, UBS thinks that the changes at the top come at a pivotal point in the U.S. franchisee-franchisor relations. As for the incoming CEO, Chris Kapczynski, who was most recently president of McDonald's USA, UBS expects him to remain focused on U.S. global growth priorities, creating value for all stakeholders. So another one of the, we know what we're doing. You co-authored this Velocity plan. Just stick to the plan, buddy, and everything's going to be fine.
You know, what stood out to me in the UBS note, Kapczynski used to be at Kraft.
Yeah, I know that too. Well,
That would give me-
everybody's got to start somewhere.
I know. I'm just saying.
Yeah.
Well, I think that the analyst community and the street sells the stock today. Fine. Analyst community, us, everyone else. There's a lot more to this story. I suspect that we will be finding out in the days ahead. I don't think it was just as simple as, Steve Easterbrook is going to leave, he's going to sign a massive NDA, he's not going to work for a competitor for 2 years, because that separation agreement was hilarious. Every possible food. So he's not in the food space for 2 years. Great.
2 years.
But with the CPO, Chief People Officer, leaving on the first business day after this, and apparently this whole thing went down on Friday afternoon, so not a great weekend for the McDonald's board. I think there's a lot more here, and so on what we know, there's relative optimism, but I would be very cautious here if I were really trying to hitch my horse behind a certain narrative of what's going on. That's all.
And there is some caution here, but some other people thinking, buy the dip, because
it's tough to re-rate the stock. Piper came out and cut their outlook, but not many analysts came out and changed their view on the company just based on this one departure. So
yes, Piper says the risk profile changes in here. Other places to go in the restaurant space if you want to get some yield.
Yep, at the very least.
And they don't have that impossible thing.
All right, coming up here on the final round, the race for cloud dominance is on, with the SaaS space expected to reach $140 billion in just 2 years. Straight ahead, we're talking to Senior Vice President of Oracle Cloud, Steve DeHeeb. But first, take a look at how some of the big SaaS names are trading in today's session with 39 minutes to go.
Forget the streaming wars, the cloud wars are heating up with big money on the line. And Steve DeHeeb is Senior Vice President of Oracle Cloud, joins us now to discuss. So help us figure this out, because we talk a lot about the cloud, the public cloud. Everybody's going there. There are all these SaaS plays. But the names that we throw around the most, or that analysts talk about, are Amazon AWS, Microsoft's Azure, and then Google Cloud. Where does Oracle fit in to this landscape?
I think when you look at cloud, there's sort of three primary layers. There's the application layer. So you think about where your ERP lives, where your supply chain applications live, where your customer engagement applications live, the likes of Salesforce and Workday. So you have that entire layer. Then you have the platform layer, which is where your database lives. You know, we're leading there with your autonomous database or analytics or integration, or really important things like security live at that space. And then that baseline is going to be infrastructure. So that's your base server, storage, compute. Instead of, you know, hosting data on my prem, I'm moving it and I'm renting it from somebody in cloud. So you just really got to think about those three layers, and we play in all of them. You know, from a customer perspective, when they actually think about solving their needs and what they're trying to do, they don't always sort of put them in those discrete buckets. You know, there's no place where apps stop and platform begins when you think about connecting them, when you think about analyzing them. So we play in all layers of the cloud, and that's different.
So I think when the street and the investor community talks about the cloud, they use them as interchangeable, right? They don't really think about those three layers. And I guess for the lay audience, and as you're talking, I'm realizing I don't really know anything about the cloud. I mean, what to you is the area right now where the most is happening, and what to you is maybe which one of those three buckets where we haven't fully yet seen the changes that will impact corporate America?
Yeah, it's sort of interesting. I think no two journeys to cloud are the same. So when you look at customers, there's different entry points. There's some customers that are simply looking at new applications in the cloud, and that might be changing my back end and modernizing that with ERP. That could change modernizing.
ERP, just for people that don't
enterprise
know.
resource planning. So that's like the core things your financials run on if you're a business. So that's about as mission critical as you get. Then you have your HR systems, your sales and marketing systems. So we're seeing a lot of adoption there. You also have people using things like analytics. I mean, when we think about data and getting answers to questions, you know, we couldn't answer before, didn't even think to ask. So that analytics space is really important. Security is interesting. You know, security used to be viewed as an inhibitor to cloud. And now people are thinking, you know what, your data center is going to be more secure than what I can possibly manage on my own. And I think you've had infrastructure. I mean, that's sort of what Amazon introduced a decade ago. But, you know, there's a lot of other pieces happening today. And really enterprises are looking at it across the board.
So when you're looking at it from Oracle, again, I think we talk a lot about the public cloud, but there's also so much discussion about the hybrid cloud.
Absolutely.
What do you see in terms of people having stuff in their own, you know, their ability to control in-house and having it outside? Where are you seeing companies focusing their resources?
It's really interesting. It really is sort of a hybrid cloud / multi-cloud, meaning it's not just one cloud, it's multiple clouds. And hybrid cloud, again, is connecting public cloud with what you have on-prem. And again, there's really, you know, it's about a thoughtful path to cloud. So different customers will sort of be at a different place at different times. There might be some applications where I'm like, let's just move that to cloud. There might be something else. It might be this custom application that I built, you know, it's been running there for 20 years. I don't want to mess with that anytime soon. So it's about having a solution that spans both, that allows you to connect on-prem with cloud as well as multi-cloud. And that's sort of where we come up, because, you know, for 40 years we've been serving enterprises in, you know, on-prem as well. And we started moving our applications to the cloud almost a decade ago, you know, 2011. And so for us, it's just a natural conversation to have. So it's not about, hey, we got cloud and that's all we have. You know, we can sit there thoughtfully, think about the application, think about the type of data. Maybe some data stays, maybe some data moves, and go from there.
And then I guess just thinking about what corporate IT departments seem to want right now. I mean, is there any tension between a group that said, hey, we've done this stuff ourselves. You know, we don't want to be moving apps to the cloud or moving certain data to the cloud just because you guys say it's going to be cheaper or it's going to be more, you know, and a lot of times things get lost in those kinds of transitions. What are you seeing from the corporate IT side on that true B2B side on what those teams are looking for right now?
Yeah, that's a great question. I think, you know, when you looked at sort of first gen cloud. It was about, okay, to your point, some cost savings, some scalability. Let me take what I have on-prem, get out of the data center business and move. I think now the discussions are much more strategic. It's not just about moving to cloud. It's about what can I do now that I've moved. It's not just about moving my data and storing it someplace else. Now that data is up there, how do I use analytics or blockchain or IoT or all these different things to actually fundamentally change my business? And so I think there's a lot more strategic conversations that are happening, and they're happening in conjunction with the lines of business, sales, marketing, finance, along with IT.
What is the state of the blockchain discussion in corporate America right now? Because it wasn't too long ago that all we ever talked about was blockchain.
I know.
But that was like 2017. That was ancient history.
So 27. I know. It's interesting. We're doing some really incredible things there and seeing some good momentum. So what we've done is, rather than having a standalone blockchain offering, we've taken things like blockchain and we actually have integrated it into the financial applications that we sell our customers. So why is it not just being a technology, but a feature of what we offer to help secure transactions, to help better log them, to provide the provenance of a supply chain? So there's really some interesting things happening, and I think it's moving from the hype of, it's sort of like AI, let me download this algorithm and play around with it in my lab, to sort of integrating it into things like we do around databases to make it self-driving, self-securing. So it's interesting.
Steve DeHeeb is the SVP of Oracle's Cloud Initiatives. Thanks so much.
Thank you so much for having me.
All right, and coming up here on the final round, data security is a pivotal topic as we head towards the 2020 election. Straight ahead, we're going to talk to the head of cybersecurity firm Racktop Systems about data security and election integrity. But first, let's take a look at some of the tickers trending today on Yahoo Finance. Hello everyone, Miles Udland here in New York, and this is the final round on Yahoo Finance. Stocks at all-time highs right now. The Dow about to join the party, set for its first record close since July. We'll have more on that and all the market action coming up in just a bit. Plus Uber and Shake Shack, little New York City trade there with their earnings after the bell. We'll have the numbers as they break, and how to keep your data secure ahead of 2020 election day. We will discuss. Plus, fashion powerhouse Rachel Zoe talks the biggest trends in retail right now. Joining me as always is my co-host, Jen Rogers. Did I get the pronouncer right on Rachel Zoe?
I thought you meant on my name.
No,
Yes.
I know your name.
You got both right.
Okay.
Yeah, Rachel Zoe.
Not, even though it's
not
spelled
Zoe, but
right.
Zoe.
Okay. All right. 27 minutes to go in today's session. Let's take a look at where we stand. We've got all three majors set for record closes. The Dow right now about a 70-point cushion ahead of its prior record. So it looks like, though we are losing steam into the close, we will hang on for that. Of course, the NASDAQ and S&P both hitting record highs on Friday. Any positive close will be a record for them to begin this week. And for more on today's market action, let's go to Scott Gammey. He's live on the floor of the New York Stock Exchange. Scott, talking about the overall indexes making record highs. When we look at individual stock names, what are some big movers into the close?
Well, Miles, when we talk about the Dow hitting a record high today, we have to acknowledge the surge in Apple shares. The stock is now above $257 a share, getting closer and closer to $260. And I feel like we've been talking about the continuous record highs in Apple's stock for a few weeks now. But before this latest kind of month or 2-month rally in Apple, the prior level that Apple really needed to take out was the October 2018 high in the stock, which was at about $232 a share. That was the prior record before the stock plummeted in the fourth and first quarter over the past year. And not only has the stock, of course, taken out that $232 level, but we are over 10% above that threshold. So that just speaks to the broader surge that we're seeing in Apple. Now, we're still, of course, keeping an eye on earnings. We've got a couple big ones after the close today. First up, Uber. We know the lockup period for the stock expires on Wednesday. It's been just about 6 months since the company went public right here at the New York Stock Exchange, and the stock is down about 30% since then. So the expiration of that lockup period this week could bring some volatility for the stock. And we know that the path to profitability for Uber is a big issue as of late, and not just for Uber, but for all these newly public companies. And we know that rival Lyft just a couple of weeks ago said that they would be profitable earlier than what Wall Street was expecting. So there, of course, is pressure on these companies to get to profitability. Now, it's not just Uber we're watching, Shake Shack as well reports earnings after the closing bell. We're expecting revenue of about $158 million for the quarter. That would be a slight decline year over year. Now, Shake Shack shares are up about 85% so far this year, but they are down about 19% from the stock's 52-week high, which was at about 2 months ago in early September when the stock was at about $105 a share, Miles.
All right, Scott Gammey, we'll talk to you after the closing bell.
Voters all across the country will be headed to the polls for Election Day tomorrow. And we sit just 1 year away from the highly anticipated 2020 election. Some tech and security experts are growing worried over how the government is working to secure election data going forward. And here with us to discuss is Eric Bednash. He is Racktop Systems CEO, a veteran of the U.S. intelligence community. I think people read stories, see headlines, are very worried about this idea of election fraud. I think there's two different areas. There's a sense that stuff is happening in social media, but there's also this sense that we're vulnerable at the polls. Can we discuss that first? Do you think there's any issue about voter fraud or votes being stolen in the air at the polling places and at the place where you vote?
Well, yes. There's always an issue, right? We've seen voting machines that have been hacked before. So we've seen the manipulation, and it's been proven, right? So that's why it's important to have paper ballots, things that you can, different risk limiting audits that you can use to check the votes if there were any tampering or anything that had occurred to those machines.
Go back to paper.
Yeah.
I guess, though, when you think broadly about election data security, how do you define, because we were kind of talking before, like it's really about what people are exposed to ahead of the election, how secure that whole process is. I mean, I think in some ways, like we all agree-ish, right, that I don't think it's like Russia went in and changed all the votes, right. But ahead of the election, they changed what seemed to be reality for a lot of people who then went and cast votes.
Well, that's really the bigger problem that I believe is the sort of the front end of the election, right? It's manipulating the way that people think about a certain candidate or a certain issue. And it's, we've sort of the last few years, fake news has been a big part of the news, right? And it's, it's that misinformation that really could change the outcome more so than someone, physically hacking into, one of the devices that records the votes.
So outside of the government stepping in and telling these large platforms what to do, or a platform like Facebook making changes, we've seen Twitter make some changes in terms of political advertising. What can a company on the outside like yourself or another company do, or even be hired by people that are worried about it, RNC, DNC, to secure this kind of an issue?
Well, I think some of this starts with the platform, right? So you have to, the folks that are running these social platforms, right, that give everybody this voice, there's a certain responsibility there that comes with fact checking. We've seen this, two different sides of this with Facebook and Twitter recently in the news. And so there's a little bit of responsibility that goes along with ensuring that what gets published on those platforms is actually truthful. But the other side of that is it's also very difficult, right? So we talk about deep fakes and what artificial intelligence could do to create something that may seem real, but really isn't.
So, news today that Adobe, Twitter, the New York Times are going to try to find a way to make it clear on what's real, what's not. But, that kind of gets me to the question of what do you think about the responsibility that some platforms have decided is not their responsibility? For all intents and purposes, Facebook has kind of said, it's not our problem. I'm sorry, we don't sell, we sell advertisements, but we don't sell reality, I guess, would be sort of the way that I interpret their language.
Right, well, you can cite free speech and an open platform, but there is a sense of responsibility that comes with this, because you have this this platform that's essentially lowered the barrier for people to be able to put this kind of information out there. In the past, we'd have to purchase a TV ad if we wanted to get information out there, and that would be very expensive. The barrier is very high. But with social media platforms, it's very low. It's very easy for this stuff to get out there. It's very easy for adversaries or the bad guys to put stuff out there to manipulate the way we think about certain things. And so I believe that there is a level of responsibility that comes with that, to fact check, to implement technology that provides some sort of assurances that what is actually being published on those platforms is somewhat truthful and can be tied back to a truthful source.
So aside from the platforms, there's also the issue, I think, of security within the campaigns. What do you think that the DNC or the RNC need to be doing to make sure that they are secure? First of all, do you think that the campaigns can make sure that they are safe from hacking from either competitors or state operators? Does that concern you?
They have to be, absolutely. Anything involving security, and information and data is concerning, right? So if you think about political campaigns and the information they have, we've already seen it in the last few years, what information that can be obtained by an opposing party can do, the damage it could do, and that opposing party could not necessarily be, the Republican or the Democratic Party. It could be, a foreign nation, right? It could be something that information is used, to manipulate a certain situation. So we have to have security at every level of every process, right? I think the days of, assuming that things are going to be secure by default are gone, right? So I think we're in a connected world, and all of our information, all of our devices are connected, and we should take the point of view where we need to think about things from the data perspective and data security first, so that we don't end up in trouble.
Are we better off or are we worse off than we were in 2016?
Paper, yeah.
Which one?
What was that?
Are we better or worse off than we were in 2016?
Progress is a good thing, right? We just have to be mindful of it.
Racktop Systems CEO Eric Bednash, thanks so much.
Yeah, thank you.
All right, and coming up here on the final round, our next guest says the economic story, is not about manufacturing. Why Manulife's chief economist Francis Donald says it's all about the consumer. We'll have that conversation straight ahead. But first, take a look at the most actively traded stocks in today's market. Stocks hitting record highs on Monday. Investor optimism about the economy and the Fed abounds. Joining us now to discuss is Francis Donald, Chief Economist and Head of Macro Strategy at Manulife Investment Management. Also joined right now by Yahoo Finance Editor-in-Chief Andy Serwer. So, Francis, let's go back to what Jay Powell said last week. You called it game-changing. I think it stood out to us here, to a number of other folks. And that was his suggestion that rates aren't going higher anytime soon. So, did that change what you had been thinking about where this Fed might be headed after this mid-cycle adjustment?
Well, the first part of the communication was all about how this was a hawkish cut and they weren't going to be cutting again. And that initially seemed like something that would be a risk off. And then at the very end, Chair Powell starts commenting on how it would require really significant inflation in order to hike rates again. Wow, what a powerful message. Now we know that we're going to go for an extended period of time without rate hikes. So this is unlike the period of 2015, 2016 when we were worried about normalization. To me, this suggests a multi-year period where the Fed is on hold, and if so, that's very bullish for equities.
So that certainly grabbed our attention, but we are not completely done with rate cuts as far as you see. Is that right?
I still think there's a possibility that the Fed has to go one more time after Q1. We're expecting that first quarter of 2020 to be a rough one because we are thinking that there's some contagion from that weak manufacturing sector into the consumer, that there's going to be a stalling out of that consumer in Q1. It's not a terrible situation. It's not a recession, but it's enough for the Fed to say, you know what, 75 basis points, that wasn't all the insurance we needed. We need one more. So we're keeping one more cut into our forecast.
But Francis, does that really matter in the real economy? I mean, it'll matter for the stock market, maybe. Either the market will go up or maybe more likely it won't go down.
No.
Right? But like in the real economy, it's like, oh my God, 25 basis points. I'm going to run out and do.
Well, but Jay Powell seems to think it does matter.
I know.
And
Well,
he
what
was,
does Francis?
He was dunking last
Right,
week.
yeah.
Look, does it matter for what's really ailing the U.S. economy and global economy, which is trade tensions and uncertainty? No. Companies aren't sitting around saying, you know what my big problem is, cost of capital?
Yeah.
No. They're
Right.
sitting there going, what is my supply chain going to be?
Yeah.
Do I have tariffs? How do I absorb these costs? So 25 basis points does nothing to help that. What does it help? Helps financial conditions, and it helps make sure that dollar doesn't appreciate too much. It's the only tool they have. They're going to continue to apply it whenever they see weakness in the U.S. economy.
So let's go outside the U.S. for a second and talk not about the U.S.-China trade war, but about China's economy, because that discussion really hasn't been had in some time. I think we've all forgotten about what's going on there. What is going on in China's economy right now, and what does that mean to the rest of the world?
Thank you for asking this. We spend so much time talking about the United States, but guess what? As China goes, so too will the global economy. And here we have a little bit of problems, right? We've had that China PMI that's been sub 50 for 6 months, and many people were saying L-shaped recovery, U-shaped recovery,
This
and then
chart
we got a double
looks
dip.
a little different here.
Yeah, this is not looking like a really positive growth story. And the big problem is that we've had two mid-cycle slowdowns before since the great financial crisis, 2013, 2016. But in each case, we had a sizable China stimulus and infrastructure spending that was through the roof. We do not have that part of the story this time. And that's why we're a little bit more concerned about heading into 2020 as a period where we have rough growth, not recession, but 1%. If we're going to get back to 2 to 3%, we need that China stimulus. It's just not in the pipeline right now.
Yeah, you brought up the path of the U.S. dollar earlier. You say it's the most important macro call this month.
It is the most important macro call. You have to get it right. We've had some U.S. dollar weakness. So the big question on our teams is this just a window of weakness, or is this the big structural shift lower? Our sense is that we're probably in for 6 weeks, maybe 2 to 3 months of a stabilization in the USD, which of course helps the U.S. economy. It creates a bit of inflation. It helps global financial conditions. But we have this ongoing problem, which is that the world is looking for carry. The world wants yield. They're going to continue to move into U.S. assets. That probably means we're not at that tipping point for the U.S. dollar on a structural basis just yet.
Does that make it sound like a bubble could be developing in U.S. what?
Well, what it does tell you is that
Yes.
the world is changing.
Yeah.
We have extremely low yields on government bonds. And if you want to make any sort of return, if you're an investment manager, if you're running a pension fund, then you got to find yield and carry somewhere. So that means that money is moving towards emerging market debt, high yield debt, US, Canadian, anywhere that you can find yields, you're going to see more money moving into it than you have in past periods. And if, as we know, got 40% of the global bond universe that's now giving you negative yield
Right.
and debt. That's up from 0% in 2014. This is a structural shift that said the world is operating differently than it was even 5 years ago.
So, I mean, it seems like in some ways, a number of strategists, yourself included, have said 2018 for a brief period, it didn't look like people had to be pushed out the risk curve. But once again, it seems like that's all we're doing, right? 2020 and beyond is just you're going further out, because you can't get return anywhere.
Well, at this point, I'm okay with that because there's elements of the story that are actually bullish and pro-risk that go back to fundamentals, like global growth looks like it might be troughing out and recovering. That U.S. consumer is structurally sound. I'd be more worried if we get to a period, and this is a risk, where the U.S. consumer is decelerating if there's job losses and people are still bullish risk. Then we'll be in a situation where I'm worried about things like capital B bubbles.
All right, Frances Donald, Manulife Investment Management, thanks so much.
Thanks for having me.
And Yahoo Finance's Brian Chung will interview Chicago Fed President Charles Evans on Wednesday. You can catch that conversation live on The First Trade, 9:40 a.m. Eastern, right here on Yahoo Finance.
Coming up, we've got the closing bell on Wall Street. It is less than 10 minutes away. First, though, we're going to get technical with Jared Blickery at the Wi-Fi interactive touchscreen. He's looking at records. We'll be back right after this.
Minutes ago in today's trading session, all three majors at records highs. Jared Blickery is at the Wi-Fi interactive touchscreen with more.
Yeah, we have the Dow up 120 points, had given back some of the gains, and then we got them right back. The S&P 500 is up about a similar percentage, 43 basis points, and NASDAQ outperforming up 63 basis points. Now, this is a year-to-date, actually 3-month chart, so let's go to the candlestick. We can see the breakout that we've had over the last few days from this level right here, right around 3,028, 3,030, should act as support if the market comes back down, but today it looks like we're going to have record closes in all the major indices. Russell 2000 still about 8%, 9% off of its record highs. 10-year T-note yield, another big day today, up 6 basis points. And any day that we've seen this, and I've said this many times, where the T-note yield is up significantly, we have momentum underperforming to the downside, along with value performing to the upside. And in fact, it's been a terrible day for momentum. A lot of baskets, which are short oil, are down quite a bit right now. So there is this rotation that's going on that's very healthy for the market. So as we climb to new highs, we're seeing more cyclical and more more value stocks enter that rotation. And so here we have today's heat map. We have the Dow Jones Industrials, tech doing well, Apple's up 0.2%, Microsoft up 0.5%. Energy, we have crude oil hitting a 6-week high, and we have shares of Chevron and also Exxon up 3% there. Financials doing well. Goldman Sachs is up 1.2% or so, and very close to hitting a new 2019 high right here. And lots of charts we could go through, but a lot of stocks are at record highs, including Apple and JP Morgan.
Well, and Jared, you mentioned that value rotation that we've continued to see. I want to talk a little bit about what you're seeing in financials and the bank stocks, because a big leader today. They've done a lot of legwork at various points in this rotation. When you look at the charts there, what's it say to you?
Well, here we're looking at the KBW NASDAQ Regional Banking Index. So this includes a lot of the mid-sized banks. And what we see here, we had this downtrend that had been in place until very recently, and we had this breakout. So we have a lot of different markers here that I call the canaries or leaders, and a lot of them are either staging breakouts right now or very close to it. So we can look at the transports, which are up 2.2% today, and we can see that they're very close to this 2019 high right here. So they are on the verge of a breakout. We could look at semiconductors, they're at a record high. Retail, that's doing well. We can look at the XRT retail ETF, and we can see that we have this uptrend that's in place here. And then we can also finally look at value. Value, I believe, is close to hitting a record high. It's definitely hitting a 2019 high right now today.
And then, Jared, just very quickly before we let you go, I think that a lot of analogs in the next couple of days are going to be made between what we're seeing in the 2019 market and the 2017 market. To you, what are the main differences between both of those rallies, which at this point appear to be on track, 20% plus in the S&P?
Yeah, I think 2013 is a better analog. If you look at the peaks and the valley of what's happened in the year to date, very similar charts, and it goes straight up to the right to the for the rest of the year. So we should, if we follow these analogs and also the presidential cycle, I would expect to see higher highs into year end. But that is just a seasonality that we're
All right, Jared Blickery at the Wi-Fi Interactive Touchscreen. We'll talk to you tomorrow. Coming up here today on the final round, we've got the closing bell on Wall Street. Plus, we are awaiting. Don't call them earnings. We'll call them quarterly updates from Uber and Shake Shack after the closing bell. We're back at that right after this.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with Miles Udlin and Yahoo Finance Editor-in-Chief Andy Serwer. We are just moments away from the closing bell, and we are poised to have records in our major indices. The Dow has been the holdout so far, looking to see if we can close above 27,359. Live pictures there of the New York Stock Exchange and the NASDAQ market site. Today we had outsized performance from a slew of energy names. XLE up more than 3%, financials up about 0.8%. And also worth noting here, over 200 new 52-week highs, around 212 at the NYSE and 250 over at the NASDAQ. Well, the cushion was able to hold to get us through. That is the highest that we have seen the Dow since July. We were back at,
well, this
that is the highest ever. Yeah. But
July 15th was the last record
July
close.
15th.
Yep.
So
Yeah, we've gone up from 15% up for the year for the S&P in October to now 22% up for the year. So we're climbing fast, and that's a big number.
what could stop this into the fourth quarter? Because everybody, we all
It's the unknown
have
at
done the
this
fourth
point.
quarter before. Last year, a lot of people have some PTSD from it.
It's the unknown unknowns at this point.
Yeah,
because
that's
the
right.
known knowns
That's
are
right.
not going to get
We've
us.
all decided that the
known
known
unknowns.
unknowns are fine.
Exactly.
So how does the trade war end? Okay. Does the president get impeached? Don't worry about it.
Right.
So it has to be something that we're not talking about.
Doesn't have to be a big black swan, but maybe a little ugly duckling.
Yeah. I mean, think about where we were
Right.
in January 2018. No one was waiting for there to be an implosion of short volatility ETFs that apparently would take the Dow down 1,000 points twice in a week.
We were
right?
just focused on Apple warning.
Well, right. I mean,
And everything
remember-
falling apart.
And you guys remember, you were there. That was like 2 weeks after you went to Davos, and all anyone said was, "Boy, isn't this so great?" And then kind of the wheels came off that thing. It was a very rough year for the markets, and so I think that the consensus now, and I got that from our conversation with Francis Donald of Manulife just a few minutes ago. The consensus now, Andy, is that the trough in this little downturn has been reached. It won't get worse for the global economy. Therefore, stocks are discounting a better future, right?
Yeah, I mean, I'm throwing up my hands at this point. It's very hard to figure stuff out. And, you know, when you look at China, you know, are we getting a soft landing? And Francis was just saying, for instance, oh, they're not stimulating there, but they're actually, my understanding is they're starting to. So that could turn things around, which is another timeless Groundhog Day thing. Things get bad enough and just ask the old Chinese Communist Party to help out the global economy.
Yeah.
Go figure. But that's what we've kind of come to right now, isn't it?
And what we also have come to, Jen, right? Isn't it? It's like, well, the U.S. consumer will fix it.
Yeah, those
That'll
are the
be
two,
fine.
Those
right?
are the two things that
Put it
hold
on
up
your-
the world.
Put it on your credit card.
Xi Jinping's button, which is the fiscal stimulus button, he just goes boop.
And your wallet.
And yeah, and the people at Walmart shopping.
It's all on us.
Those two things.
Keep shopping at Costco and going to Disney and buying
Right.
new streaming products and everything that we outlay our wallets to. We have not been able to, despite our best efforts here in New York City, help Uber at all. I think that's sort of the last. We've looked at, Jared was saying that now we've got value in the sun again, and we've gone through, we were talking about financials earlier here, having a pretty good month as well. Healthcare has been a nice outperformer recently. The IPO names, still, even in these record highs, it is tough to catch a bid. We're waiting for Uber to come out and post financial results. Stock down on a day when we saw records across the board. Uber's down 1% almost.
What would W say about it? Fool me once. Right? I mean, you know, we're not that dumb.
I mean, to that point, you know, talking about sentiment, doesn't that I see this as a positive. Right? I think it's good that these frothy names. I think it's good. It's bad for, well, it's good for the bankers, but it's fine that WeWork had a major issue getting to market because that company was the disaster.
But are we going to say the same thing on the flip side when everyone moves into the IPO names? Will that be bad? That will be a sign of fraud?
But they're going to be down 60, 70, 80%.
Will they by the end of that? I mean,
they're-
if everybody is, if we start to see people move in, you see Jared going through the Canaries, you see Jared
Right.
going through the levels and what the resistance is. You know, if people start to move into these names, wouldn't that be good?
But they're never the same.
Yeah, no, I think
like
it would be.
value
You think it would be bad?
No, I'm not saying it would be necessarily bad. I just think that in terms of trying to get a sense of how disciplined is this market, the discipline the market has shown to continue to look skeptically at some of these very interesting consumer-facing IPO names, to me, speaks to some discipline. Now, on the other side of that, Procter & Gamble shares are up 50% this year. Maybe that's not super disciplined. I'm not sure if that company is 50% more valuable than it was at the beginning of the year. You look at a number of industrial names in the Dow. We might know one well. That stock has gone up quite a bit, and you're like, is it really that much better than it was last year?
Well, but it's that much better to have your money there.
Exactly.
Than in those
the dividend.
You're getting a yield.
Buybacks and all that stuff.
That's why people are there. We are waiting for Uber and Shake Shack, but right now let's go to Scott Gamm on the floor of the New York Stock Exchange for the very latest on the record close. Scott, take it away.
Yeah, that's right, Jen. And on a day when the Dow not only reached a record, but rose a mere 114 points, I do want to highlight the stocks that tried to bring us down today. It was pretty remarkable to see Procter & Gamble down 4% today. It was the worst performing Dow stock. The safer stocks really got smoked today. Coca-Cola was another Dow laggard today. There really wasn't much of a reason to be putting new money to work in these stocks when you had such optimism on the other side, on the riskier side of the market. We also saw declines, of course, in McDonald's shares. That was the second worst performing Dow stock, but that was largely because of some stock-specific news surrounding the departure of the CEO. The gainers in today's session were equally as interesting, with Chevron leading the way. Exxon was also one of the big gainers. We saw a lot of strength in the energy sector today amid optimism from the upcoming Saudi Aramco IPO, which seems to finally be happening. We saw that announcement from Saudi Arabia yesterday. We've been hearing about speculation surrounding the IPO for years, but this is the closest we've ever been to some sort of a decision on the IPO. And then Apple was another stock that really helped the Dow today. It was up about 1%, crossing $257 a share, another record high for Apple. And then the two bank components within the Dow, JP Morgan Chase and Goldman Sachs, were up today. It's interesting, we saw a steep decline in the 10-year Treasury yield late last week when it crossed below 1.7%, but that decline was short-lived because today we moved up sharply with the 10-year yield now approaching 1.8%. Now, one more stock to tell you about in the Dow, of course, Boeing. That stock was up today, but it's interesting, when the Dow was last at a record high in mid-July, Boeing was at about $363 a share. Well, today, the stock is down 3% from that level at about $350 a share. So the Dow's record high was driven by other stocks, not exactly Boeing, guys.
Scott Gamm, we'll talk with you tomorrow.
All right, earnings alert here. Uber's third quarter results hitting the tape. Jared Blickery in our newsroom with the latest. Jared.
Yeah, don't call it earnings. We're looking at a loss per share for Uber that is wider than expected, coming in at 68 cents versus expectations of only 63 cents. And then revenue is a beat. It came in at $3.81 billion versus expectations of $3.39 billion. They're seeing their full year adjusted EBITDA loss at $280 to $290. And previously they saw a loss that was greater, from $3 billion to $3.2 billion. Another key metric we're looking at here, that the street is looking at, is gross bookings. And that came in a little bit under expectations, $16.47 billion versus estimates of $16.7 billion. And we're seeing the stock heading down now under $30 per share. The options market had been looking for up to a 12% move. So far, we've only seen about a 5% move to the downside, but it looks like the low for this stock is $28.31. Will that provide support? We'll have to figure that out and see.
Right, Jared Blickery in our newsroom with the first look at Uber's quarterly results. Jen, I think everyone's going to look at this press release and immediately notice they are now breaking out all 5 of their segments in very clear language, letting you know what the rides business is doing, what the eats business is doing. I take that as a sense that they want you to be looking at the eats business, right? I mean, revenue there up 73% year over year. Revenue in its rides business up just 20%. So that trajectory is not, I think, what a lot of investors thought they might have been signing up for here.
Eats actually called out pretty early on, I believe, in the first paragraph here. Dara Khosrowshahi, the CEO, saying that revenue growth and take rates in our Eats business also accelerated nicely. So again, pushing Eats up in the breakdown here as well. Look, this goes back to the whole IPO story that we had from them that differentiates them from Lyft, rides, Eats, freight, other bets, and then this ATG and other technology programs as well in here. That's a story they want to be pitching.
Yeah, I mean, you still, boy, to get in, you got to be a believer, and it's got a market cap of what, still 52 billion. And so you're asking yourself, well, how long do you have to go, right, to start to see green ink instead of red ink? And it's going to be a long, long time.
Right. I mean, so you look at total revenue, right? About $4 billion for the quarter, so 16. So you're paying what, 4-ish, three or so for the whole business. But I mean, I look at Rides. Rides is adjusted EBITDA positive, right? They made $631 million in that part of the business. And so I think you could go through an exercise here where you could talk yourself into being excited about the whole company based on a valuation for the Rides business. But I mean, you're still looking at G&A losses of $620 million in the quarter. Other bets, $72 million loss. So I think it's still going to be tough in the current corporate structure to get investors more excited about
it. The marketing spend, you talk about G&A, and I think they let go 400 people not long ago. And so, you know, I mean, everyone looks at like things like Salesforce that you can just have unlimited G&A and then eventually, I mean, this is the whole problem opportunity with Silicon Valley. So you have the paradigms, in this case, maybe a little bit Salesforce, for others, Facebook, build it, they will come, scale, and then you just flip a switch. Who knows with these guys, right?
So much to dig into here on Eats, and also just looking at the geography, sort of the flattening that we're seeing in Latin America. But we just got Shake Shack's third quarter results coming out. So let's go to Jared Blickery. He's in the newsroom with that breakdown.
Shake Shack stock is tumbling here, and it is a miss on the revenue numbers. So that came just shy of estimates, 157.8 million for the quarter versus expectations of about 157.9 million. So small miss there, but they did beat on adjusted EPS, coming in at 26 cents versus estimates of 21 cents. Another key metric we're looking at is full year comp sales, and they're estimating that will now be about 1.5%, whereas previously they saw 2%. So that could be a disappointment there. Again, seeing full year revenue 592 to 597 million. That is up from their previous estimate of 585 to 590 million. But they are, the shares are in free fall right now. It's 74 down 12%. The options market had been looking for up to a 9.5% move. So this is really a big surprise for investors here as we watch the stock tumble in after hours trading on that revenue miss.
Jared Blickery in the newsroom on Shake Shack's results. Again, the stock right now moving sharply lower. You can see it here. It's off 10 bucks. That works out to just about 12%. Shake Shack is a name trying to grow internationally. That's been a big play for them as well. They note in here increases in food and paper costs. The margins are always
because
you take a look at that one too. Driven by higher food costs associated with chicken bites since its nationwide rollout at the beginning of the year.
And speaking of chicken, and speaking of comps that were weak, what happened in this sector over the past quarter or so? Everyone went to all the, like, go to Popeyes, right, and check. I mean, that's got to hurt, you know. And when you think about innovation, which is what comps is all about. I mean, comps can be technology and innovation and execution. I mean, I didn't really think about you think about them as a growth story, not a comp story. But at some point, you got to turn to comps. But you know, this has been a wild ride for investors. Stock was up 80% year to date before today.
And that was off its highs.
Also down from 102 in September.
That's right. Yeah, that's right.
And it's still a tiny company, you guys. I mean, it only has a market cap of $3 billion. So, you know, there's a long way to go here, but it's not an easy category.
Well, you know, we get excited about our own dinner choices here.
Some fries today.
I like it. I mean, I'm a big fan, but, you know.
It is interesting.
It is a local concern.
With what we're seeing with inflation, that they have increases in labor-related expenses driven by inflation, availability of labor across the country. Food and paper costs, dairy and beef, slight commodity inflation there as well. They also had, as a direct result of digital sales mix, some additional packaging
We should probably
costs.
raise interest
more
rates to
money.
cool this inflation, don't you think?
Should we give this data point to Jay Powell?
He
said
don't confuse the man.
If inflation went up materially, right?
Well, this is
Shake
inflation's
Shack
killing this company.
got two bullet points
my Brian
here.
Chung impression. Chair Powell, have you seen the Shake Shack press release from last quarter? Because that certainly indicated some inflation. Yeah, I mean, look, I think this is a macro story. And Shake Shack has always been an interesting company. Cheesecake Factory is another one I like to look at, where they are in higher end-ish locales, you know, expensive malls, you know,
fancy neighborhoods.
Orange County, right?
Upper
That's where you're
middle-class
going to exactly. Yeah, I mean, Cheesecake started in Calabasas, right? So I think the inflation, the labor inflation on these companies is very interesting. And I think in some ways, it's a very positive economic story that Shake Shack can't find workers and it needs to pay people more to work in its restaurants. Of course, if you're a Shake Shack investor, then you don't see it quite as positive.
That's how the consumer is going to keep chugging along.
I mean, I don't disagree.
I mean, that labor inflation thing is real. I mean, you talk to people I've talked to people like closing shifts a restaurant. My thing is, once you pay people a little bit more, but then I get in arguments with people.
Seems to be happening at Shake Shack.
Well,
up next, we're going to have more earnings reaction coming up, plus powerhouse fashion designer and stylist Rachel Zoe breaks down the biggest trends in fashion right now. We're back in 2 minutes.
All right, Uber shares trading lower after hours following their latest quarterly results. Jared Blickery is in our newsroom for a recap. Jared.
Uber did beat on revenue, coming in at $3.81 billion versus expectations of $3.39 billion, but it was a bigger loss than expected, coming in at, let me see my notes here. Well, I do have this written down, I promise. Here we come at 68 cents, and the expectation was for 63 cents, so that bigger loss. One of the disappointing things in the report here, now they do have some expectations for the future here. They also have gross bookings coming in a little bit under expectations. Now that gross bookings number coming in at 16.47 billion. Estimate was for 16.7 billion. As you noted, Miles, they're also breaking out a bunch of their segment revenue, and they're notifying that gross bookings jumped 29% in the quarter, and third quarter revenue increased 30%. But we did have that miss on the bottom line, and we're seeing shares here off. They had been up or down by as much as 7.5%, so they paired some of their gains here.
All right, Jared Blickery live in our newsroom with a recap of Uber's latest quarterly report.
Moving on to retail and fashion, Rachel Zoe is a celebrity stylist and designer who has collaborations with companies like Starbucks and Pottery Barn. Yahoo Finance's Melody Hom joins us now with Rachel Zoe at her West Hollywood offices out in California. Melody.
Hey Jen, yeah, I'm here with Rachel Zoe, the entrepreneur, designer, stylist on Melrose Avenue here in LA. Yes. Thanks so much for joining us today.
I'm so happy to be here. Thanks for coming over.
Of course. So you have a bunch of interesting collaborations that are in the works right now. Some of the recent ones are with Pottery Barn Kids and Teen, and of course Starbucks Asia, as well as Janie and Jack, which is now in by Gap. Tell me about your thought process as you think about how you've decided who to collaborate with.
Well, it has to be very synergistic. It has to be something that completely feels right to me and the brand, and really be able to sort of capture the DNA of the brand, which is, glamour and style, and sort of constantly trying to figure out different ways to help women live a life of glamour and style in a very organic way.
When you think about the net worth of, now you have a subscription box service that's a quarterly offering, what I found really interesting is that the average household income is about $250K for the people who are receiving that. So do you feel as though that's actually making fashion accessible? Is that affordable luxury? What kind of category would you put it under?
I think it's one of those things where I'm constantly trying to make style, fashion, and glamour less scary to people, less intimidating, and more fun. And I'm also trying to do a lot of the work for them and take a lot of the guesswork out of the process of, all of us women that stand there in our closets every day and wait for some great outfit to fall on our head some epiphany and like run out the door and do your life every day. And I think about really how to make that the most accessible and most affordable to as many women as possible. So I think with the Box of Style in particular, I think the fact that the household income is so high, to me is wonderful, because it just shows that we're putting out great product to people that can afford to buy possibly a lot more things, but also making it affordable to people with a lower household income, but every season being able to have those products kind of show up at their front door and have them be excited and work it into their everyday lives.
Yeah, speaking of high end, it's really an interesting time for the industry. When you think about Barney's New York, when you think about Zac Posen's label, I know, and you seem very sad and you have a lot of sympathy there because you've worked with a lot of these folks during your years as a stylist and now as a designer. What would you say is kind of the pulse of the industry right now? Do you feel like it's a sad state? Where's the opportunity?
I think all of us are trying to find the opportunity. I think it is the hardest time in fashion that we've I personally have ever seen. And I think that most of us have seen, at least most of my peers. And I think whether you're succeeding on every level, whether you're not, whether you're, excelling in certain parts of your business and not others, I think everybody's trying to navigate their own path right now and trying to really be nimble and really kind of change with the times. And I think that while the internet and social media has really helped a lot of us in a lot of ways, in marketing and in all these other ways, I think there's also parts of it that have really hurt a lot of smaller businesses, and the fact that, people are not going into stores as much as they are, as much as they used to. And I think that, I think there's pros and cons. And I think to Barney's, it's really sad. I think Barney's New York just meant so much to so many of us. And also, Zac is one of the best talents in our industry. And I think that he's been very, candid, very honest in his interviews and in, sort of what happened. And, listen, this is only the beginning for Zac, and he's such a talent, and his talent, no one can take that away. And I think his talent will just prove to, have him succeed much further in whatever it is that he does, and I'm not worried about Zac. I mean, he's a talent, and I've known him since the day he started. I was actually
spending... He was a wonder kid in many ways.
A wonder kid, and still is a wonder kid, and he's still young, and he's classy, and he's elegant, and he's kind, and he's all of these wonderful things, and truly talented, and truly makes women look and feel their absolute most beautiful. And I think, as Zac said, I mean, no one can take him away, right? So I think it's what's next for him, and I'm certainly very excited to see what's next.
Yeah, and even next for you, when you think about your partnership with Mark Burnett, as I understand, given the fact that you previously got a lot of household name recognition through your Bravo show. What's your next project looking like when you think about the new landscape for media?
I mean, we'll see. I think having launched the Zoe Report so long ago, and obviously the box of style in my collection and doing all these things in social media. It's like, okay, what's next, right? And I think, I've had a lot of television opportunities that I've talked about with various different people over the last several years. But I think for me to go back on TV, it has to be the really, really right thing that gets me very excited. And, I have to have a really strong message to put out there. And people are asking for the Rachel Zoe project back constantly.
It's a reboot season.
It's
the
a reboot
nostalgia
season.
effect.
I think I would absolutely be open to the Rachel Zoe project 2.0, but I have to really think about what that looks like and what that is now, and, how I can really, sort of have that same impact on a lot of people and get them excited about it. So we'll see.
Yeah, I, for one, will be waiting with my fingers crossed for that
Thank
reboot.
you.
Thank you so much, Rachel,
Thank
for joining
you.
us today.
So much fun.
Back to you guys at the final round.
Rachel Zoe with Melody Hom out in California. Thank you so much.
All right, coming up after this, we will have what we're watching tomorrow in Look Ahead. We're back in just 2 minutes. All right, welcome back to the final round. Shares of Shake Shack lower after hours following their third quarter results. Jared Blickery is in our newsroom with a recap. Jared.
Yeah, small miss on revenue, and that came in at 157.8 million. Street was looking for 157.9 million. It was a beat on it.
That was lower than street expectations, also coming in and giving a lower number for the third quarter than the street had been expecting. So the revenue actually slightly raising their guidance there, if I had the numbers here correctly. Looking at full year revenue of 592 to 597. They'd been looking for 585 to 590. So slight increase, but Andy, it's really just the comp growth.
Yeah.
We're seeing at Shake Shack disappointing the street, just 1.5% for the full year 2019.
And maybe they're not focused on that because they're focusing on the growth story, which is not comps, right? On the other hand, I noticed here they only opened, it looks like about 20 stores in the quarter. I mean, that's not that much. And you wonder if there is the infrastructure at this company to have delta, right? So in other words, increase the trajectory of growth for store openings. I mean, they have to watch the birdie in terms of execution. I mean, comps is always what you've got to have in one of these businesses.
And talking about
But they have a lot of room to open a lot more stores.
That's true, but a company in their release saying they're having trouble hiring,
Right.
and I think it's a nice compliment actually to Uber's results because Uber loves the Eats business, and Shake Shack says they have higher costs because of delivery, and I think that's such a challenge for a lot of these businesses that, Shake Shack was a stand, and then it became a larger restaurant, but it still has a stand feel to it when you go in there, but doing delivery, there's a reason why pizza and Chinese food is the main delivery food in the U.S. It travels best.
You gotta get the fries.
It's really
fast.
difficult for other types of
fries
cuisine.
have to be.
Hey, I got to ask you a question about this.
Really out of there.
One question about this release. They opened a store in a town I never heard of in New Jersey, so I'm going to ask Miles.
Yeah.
But it's a good one.
I know where it is.
Eatonton.
Yeah.
You're going to open
It's
a
off the
restaurant. You want to go,
turnpike.
but eat restaurant, right?
It's down by like the New Brunswick area. They got a Top Golf in Eatontown.
Oh,
Nice.
wow.
Okay.
While we have Shake Shack up,
Thought you had me on New Jersey trivia.
I never doubted you.
It is important that this stock is up over 82% this
That's right,
year.
yeah,
So
yeah,
we're
right.
down off incredibly high levels. People have gotten so excited around the delivery issue, which had come out and talked about that last quarter. And again, remember, this stock has been up huge this year, kind of a price to perfection story.
After a couple of subpar years, it languished for a time.
I mean,
after
because
the IPO.
it's only its third Shake Shack in Osaka. I don't even know if they're in China. But can you imagine? I'd like to own that business.
I know.
Moving on, here's Miles with a look ahead at what will be making headlines on Tuesday.
All right, well, on Monday, the Dow joined the party and closed at a record high. And so for the first time since July, we've got all three major indexes right now at this moment at record levels. And as tends to be the case when stocks hit records, the story why isn't just one thing. It's not just that Jay Powell made a huge signal last week that rates aren't going higher for years, or that earnings have come in a little bit better than analysts had been fearing, or that global growth appears to be stabilizing after a brutal summer, or that the Vatican-style smoke signals sent by the Trump administration continue to suggest some optimism with respect to the U.S.-China trade fight. Because if there were just one factor suggesting optimism for investors, we wouldn't be able to overlook all the warning signs we're seeing, like waning CEO confidence, or declining capital investment, or a declining demand for business loans. And if we didn't always have to look past some negative piece of news as stock prices press higher, well, then this whole thing wouldn't be all that much fun anyway. Now, turning to the schedule for Tuesday on the economic data side, we'll get two key readings on service sector activity from ISM and Market Economics, and we'll also get the latest data on job openings and labor turnover. Then on the earnings side, Match Group, Peloton, and Tapestry will be the highlights. And don't forget, tomorrow is Election Day here in America. I believe it's 364 days from 2020's election.
The big election.
Couple gubernatorial races, Kentucky, for example. Also, local concern, we were talking about this earlier. Andy, you've probably seen the commercials. Jersey City, massive referendum on whether Airbnb will be allowed in Jersey City.
Yeah, I don't know how that's going to go down. I don't know how they feel about that.
And we've got a ranked voting proposition here in New York City.
Oh, is that right?
Exciting.
Oh, that's like, that
could
kind of
really
stretches
change
your brain,
things.
right?
Yeah,
they do that in Maine.
Yeah, they do it a lot of places,
What's
but New
ranked
York
voting?
City, where you rank your choices.
Oh, I see, sure.
And so it's not just, we're going to go
Right.
with this person or that person.
Right.
And you're like, second I would take this. And it's a way of getting more
It's-
consensus.
It's like the
around.
AP poll.
Yeah, that's a little complicated.
Yeah.
It really is.
Right. Yeah. I like to just pick.
kind of a
I want to just
winner
pick
take all kind of
and
thing.
it's also it goes to like this is the kind of year where you'll have a lot of local referendums. You want to do
we
a
have a
school
lot.
bond, and the language on those is always a little bit brain teasy, right? Like vote no if you want to issue the bond.
Depends
Yeah,
who got
oh,
it.
yeah.
Depends who got it on.
That kind of stuff.
Yeah, it's
But
the
go
people
read up
against it
about
who
the,
write the language.
Ranked
right?
voting. Both of you go read up about ranked voting.
Oh, I know it.
Coming up, more on the final round, plus what the shocking revelation at Under Armour means for the stock. It's our top take of the day. We're back in 2 minutes.
back to the final round here on Yahoo Finance. Miles Olden with you in New York. I'm joined for the final 25 minutes of the program by my co-host Jen Rogers. Also stopping by today, Yahoo Finance Editor-in-Chief Andy Serwer. Let's take a look where the market finished on this Monday. Record high close for each of the three major averages there. The Dow making its first record close since July 15th. The NASDAQ and S&P had hit their first records since July in last week's trade. Now let's talk about a less positive story in the market right now. Uber shares are lower after hours. That stock, or that company rather, coming out with its most recent quarterly report, stock off about 5%. Now the company did come in with some revenue that was a little bit better than expected, $3.8 billion for its most recent quarter. The street was looking for around 3.6. Uber did release a number of new metrics in their report, breaking out each of their business lines, giving us a sense of what's happening at their core rides business and the Eats business. Pace of growth slowing considerably at the rides business, up 19% revenue was there during the third quarter. Eats revenue up 64% during the most recent quarter. Interesting to me, stood out in this report, is that adjusted EBITDA in the rides business positive, $631 million the company made during its most recent quarter, but overall adjusted EBITDA, that loss $585 million.
Down
Steeper,
28%.
Steeper, yeah, than the same
previous
quarter
year.
last year. So you see the top line results here. Loss larger than expected, revenue better than expected, but certainly some holes here in the report in the street.
But do we expect? I mean, are we still accepting the fact that, you know, as revenue grows, EBITDA declines more? The EBITDA decline is greater than the revenue growth. How long can we do this?
A lot of it's going to have to do with the
game?
competition, right? The cost to acquire new riders, which we have seen in many of the notes that have been coming through. They feel that that has, at least in the U.S. ride-sharing market, which is the most mature, has been getting better. But this report, I mean, look, the loss is bigger than what Wall Street wanted.
The company is saying that they believe they'll be profitable. So overall business will be profitable on adjusted EBITDA basis by 2021. Same timeline as Lyft. So I guess we'll see. Raise prices, get rid of business lines. I don't know.
You'd love to see the underlying assumptions there, right? I mean, because
we'll see them in analyst notes tomorrow.
Are you growing revenue at 30%
right.
and assuming no slowdown in the U.S. economy? You know, there's a lot of if,
all that
then.
If. That's right. All right, very quickly, let's talk about our top take story we're watching in today's market. Have not talked about during the 4 p.m. hour. That's Under Armour. Over the weekend, just a flurry of bad news for the company, confirming that the U.S. Department of Justice is probing their accounting practices. Then the company coming out this morning giving a worse than expected sales outlook. Just a very disappointing earnings report. Andy, when you look at the Under Armour story right now, stock off 18% in today's trading. Is it about what's happening at the business, or is it about a clear, they use the NCAA, lack of institutional control seems to be a problem there at Under Armour?
I mean, I think it's of a piece, right? Because, you know, first of all, this investigation's been going on since 2017, right? And so you talk about a management focus. Where is that? And then
I guess they wouldn't have told us if the Journal hadn't reported it.
Right, which raises other issues. Like, was it material? Seems that way to me. Mr. Market told me it was material, didn't he?
Yep.
And then you didn't even mention, you know, the other problems they've had with expenses and Me Too stuff. And then Kevin Plank leaving-ish, but not really-ish. And then how's that connected to everything else? And then the discounting. And, you know, you start to ask yourself, does this company, with its current management, have the wherewithal and the focus to turn this thing around? Because it's obviously a great brand, and it did something that was heretofore unthinkable, which was to challenge Nike domestically. Yep. Nike has its own issues. Right now, the company with mojo in this space is Adidas, or Adidas, as they call it over there. So, these brands are so cyclical. You always see it. They get. Look at Adidas itself. I mean, this was dead in the water. Then it comes back. But I mean, as far as getting in now, if you're a value person, I'd be a little wary.
I mean, talking about the cycles, though, and you asked the question, is this management team ready?
Right.
I guess, luckily, a lot of the management team is changing.
Yeah.
We already know what's happening with Plank. We have the C-suite is going to be in some turmoil, it seems, for some time. But when they come out of it here, if you can get the fashion part and the cyclical part right, maybe it is
pricing. I mean,
a place to start to look around, because they still have great distribution. They're still they're next to all of these names. Any store you go to, they're there.
It's about the marketing.
It is.
Right, and pricing and all that. And,
They had it so.
it kills me because they're my people.
And the Maryland,
That's right, the
people.
Maryland peeps.
Oh, man, come on.
Yeah.
Right, I forgot about that.
All those garish uniforms at the University of Maryland with.
Yeah, I mean, I remember some years ago they were going to be the next big player in the specialty running sneaker business, and they have running sneakers now, but they're not a major player there. They made some big hires, and it just they've. And Dan Roberts does the whole funny thing where he acts out sports, sweat, tough, but like they haven't gotten away from that, right? They still are focused on football and lacrosse players, and that's fine, but they are not average consumers. I'm not a football player. None of us are football players.
Right.
I want to go to the gym in something that I think looks decent and fits okay, and Under Armour is looking for something to go under my pads. Still.
And doesn't smell after you wear it. Which
Under
it
Armour
goes back
does.
to Lulu.
So do you buy that special detergent that takes the smell out?
No.
You should.
Really?
It's sports detergent.
Lulu just doesn't. It seems to work. This is not an ad. This is
okay.
just
Yeah,
this is just a continuing conversation.
This is advanced level teenage parenting. You've got special.
I've forgotten already.
All right, Under Armour. Certainly a story that will continue. Andy Serwer, your time with us for today is done.
Okay,
You are
thanks,
excused.
guys.
See you later this week. Thanks for stopping by.
Yep.
Coming up, we got more on the final round, plus more shoe talk. The Jordan brand celebrates the Air Jordan 1 franchise this holiday season. Yes, the holiday season's here. Our resident chief sneaker correspondent, Reggie Wade, does the big unveil. We're back right after this.
Our Wade.
The Jordan brand is celebrating the holidays in style this year, launching an all-new line of sneakers for its Fearless Ones collection. And joining us now to discuss is Yahoo Finance's Reggie Wade. And we are unboxing the special collection here. We've never had so many shoes
I love
on the
it.
final round.
This is the ultimate Yahoo Finance.
I don't see
sneaker
any. I don't
unboxing.
see any 11 and a halves though. So you got to
No. These skew smaller, but yes, this is the Jordan Fearless Ones collection. They started releasing at the end of October. They were released through the holiday season. And let's go through them one by one. First, we have the Air Jordan 1 Fly Ease. Now, this is some very special stuff because it's the first time that Jordan brand has put Nike Fly Ease technology. As you see, one-handed, you could get into them. So people with disabilities, you could slip in.
Oh, I see.
Cool.
Come right in. And there you go.
Wow.
One-handed. Yep. Next, then we have the Air Jordan High OG Fearless, and this is a special tribute to Michael Jordan's professional and his college career. We have the North Carolina Tar Heel Blue and the Chicago Bull Red here.
And the patent leather.
Yes.
I like that.
This, for sneakerheads, that's the most coveted shoe in the line.
Yeah.
That could retail around $500 right now. Sold out. As soon as they put it on, sold out in minutes. They retail for $160. You get them for about $500 if you like.
Okay.
Next, we have, this is exclusive for the women. We have the Nike Air Jordan Women's High OG Fearless, and this is called Made to Shine. We have this gold. It's technically a gold color, but I call them the pennies because they have that copper look.
You do look like a
Yes.
shiny penny.
I like those.
Made to Shine. Next to it, we have the Air Jordan 1 Bloodline. That's a new take on the bread colorway.
Yep.
Sneakerheads call black and red shoes bread.
I was going to say, let Jen know what the bread is.
Yeah. Black and red bread. Very nice colorway.
Now Reggie, just a sneaker-related question. Typically the bread, like to get full bread credit, it's got to be that classic where you'd have the red, where we see the black in this sneaker, with the black swoosh. You know, they've got the one football cleats, for example, that everyone's wearing this year are the breads. Do you think the community is going to acknowledge these as proper breads?
Great question, Miles. No, they're not.
Okay, that was my suspicion.
They will acknowledge it as a nice-looking sneaker, but not in the traditional bread, as Miles has pointed
So
out.
you can't say, I finally got my breads if you got that shoe.
No, exactly. You can say you got a hot shoe, but you can't say you got your
That's
breads.
right.
Yep, Miles is on it. Then next to it, probably the most subdued look of the series.
Very simple.
Yes, very simple. We have the Air Jordan 1 Low, and this is made by New York designer Ghetto Gastor.
I just want to turn it a little because there's this green.
Has a store up in the Bronx, and this was inspired by the grittiness of New York City.
Kind of cool.
And that's actually one of my favorites in the collection.
Yeah.
Oh, you're like a simple.
Yes, I like that simple.
Reggie's a simple man.
Simple man.
There you go.
Humble beginnings, humble
yeah,
footwear.
but you see, I like that green and red at the top. All right, that's
and
nice.
finally, we have, this is another women's exclusive
These are my
shoe.
favorite.
Yes.
It's a woman's shoe.
Yes. The Air Jordan
gonna get
1
to wear
Fearless, the Melody Ashani. This was designed by LA-based designer Melody Ashani.
Watch this, guys.
Look at this.
So cool.
Has a watch on the front.
watch
Sneakerheads
on
have to know what time it is. And it has the inscription on it
Yeah,
right
here's
on the side as we
inscription.
see.
And it goes around. You want me to read it?
Yes.
If you knew what you had was rare, you would never waste it.
Exactly. That was inspired by Michael Jordan's career. That was part of the series here, highlighting things that he has done and messages they wanted to get out to the community.
Do you get a watch on both shoes?
Yes, you get a watch
right
on both
and
pairs.
left?
Yes.
So you could do one like New York time, the other LA?
Exactly.
Oh, that's so
You see?
cool.
Yeah.
Look.
And the shoes don't match.
No. And on the bottom, they have more inspirational quotes
Yeah,
from
the
Melody
bottoms are
Ashani,
cool.
from Nike as well.
These are cool, huh?
Yes.
All right, so Jen, I feel like you're going to get these, although I did get the sense that you really liked
I like the shiny penny.
penny
I actually
ones.
really like the regular
the
one.
men's, the
Yeah.
patent leather ones,
Yeah.
the ones that I'm going to get.
Yeah, I like those. So
And the price point, $130 on those, Jen.
what's the deal?
The problem is you can't get these unless you're like on the sneakers app when they launch.
That's the thing, and that's something that many people have complained. They're like, these sneakers are great, but if you really want a pair, you have to sell resell because the bots are out, people line up for these
Right.
things, and
Are they already sold out?
are they, some are sold out. These patent leathers are sold out. Those are yet to come. Those drop on the 15th. So
Yes.
Jen, you are wearing exclusive sneakers, never worn before.
Congrats to Jen. There you go. Right, because if you're Mike Sterling, our director who buys every sneaker, he can go on the app and get them.
Exactly.
But me, who only
you're
buys
nobody.
sneakers every so often via the sneakers app, I can't get these.
The algorithm treats.
That's
its
right.
These
faithful.
are really.
It does now.
Wait,
It does.
Reggie, how much are these shoes?
Those are $130.
Oh, I like them. All right, $130 and you get 2 watches.
Yeah.
And you get 2 different colored shoes.
Yeah.
And,
I guess we have to wrap.
And with the yellow,
By the time I get
it's
back,
like all
I'm
colors
definitely
today.
gonna have this shoe on.
All right.
Cinderella. I got one on.
Jen Rogers, officially a sneakerhead. Reggie Wade,
Getting my bread.
already a sneakerhead. Thanks for stopping by.
Thank you.
All right, time now for all the best moments that you missed today right here on Yahoo Finance.
But why did you have to appoint a CEO today, right? Why didn't you say, okay, we're going to be in a search, or we're going to go into a search for a CEO and maybe appoint him as interim CEO or something like that? But why they just went all in with this guy who really does not have any relationship with the street, if you will, or the franchisees, and they're just betting the farm on this guy.
So the Under Armour brand image has really taken a hit over the last couple of years. They've been really unable to pick up on the trend of athleisure. The brand has largely fallen out of favor with teen boys.
After, the whole WeWork thing, I think that an exciting IPO is probably good for the market. I do think if you're coming to an IPO right now, your numbers are going to be studied much more than they have been in a long, long time.
They're overestimating his power of intimidation, and they're underestimating how good they could be post his departure.
We need clear trust, right? And if you don't have trust, if your chief people officer if there's any kind of maybe tie to anything, I think it's the move that they had to make was to make that cut. You have to make a decision that represents the employees and the brand as a whole.
I don't think there is a credible plan for the state to step in right now, because that is an extremely complicated next step. But even if they can't step in, if they apply enough pressure here to get these two parties to agree to something, it might help.
I still think there's a possibility that the Fed has to go one more time after Q1. We're expecting that first quarter of 2020 to be a rough one, because we are thinking that there's some contagion from that weak manufacturing sector into the consumer, that there's going to be a stalling out of that consumer in Q1. It's not a terrible situation. It's not a recession, but it's enough for the Fed to say, you know what, 75 basis points, that wasn't all the insurance we needed. We need one more. So we're keeping one more cut into our forecast.
Up next, Under Armour in the hot seat. Straight ahead, we're going to hear from Challenger, Gray, and Christmas Vice President Andrew Challenger on what this means for the company heading into the big holiday season.
Under Armour's third quarter earnings topped expectations, but the company cut its revenue outlook for the full year and disclosed that federal officials have been probing its accounting practices for more than 2 years. Earlier today, Challenger, Gray, and Christmas Vice President Andrew Challenger joined Yahoo Finance's On the Move to discuss what's next for the company and the state of CEO-founded businesses.
I think what's interesting about it is that it's coming at a time when there's a lot of founder CEOs that created the company out of nothing that are departing right now. We've actually tracked more CEO departures this year than we have at any other time since we started tracking it in 2002. So that includes 2008 data. And there's a bevy of CEOs that created companies, Uber, Juul, WeWork recently, where the CEO that created the company feels like they're no longer the right person to lead the organization at a time when it's a little bit more of a mature organization. So I think corporate boards and shareholders are all a little bit wary about this magic bubble surrounding these founder CEOs, and it feels like it's popping a little bit right now.
That and the fact that the replacement CEOs are getting older and more male. We can come back to this, but in your report, you saw retail hiring up 18%. Notably absent from the list of companies you tracked was Amazon. So I'm on a holiday mindset already. Was singing Christmas carols on Friday, boring my team. But let me ask you, this holiday season, what should we look for from Amazon, but also some of the bigger retail? Because I know Target is already front and center.
Yeah, like you mentioned, we saw an 18% increase in retail hiring. That's not surprising in this environment when unemployment's very low, wages are rising, consumer spending is really strong. It's a time when we expect to see hiring. We actually saw a 17% decrease in retail and the warehousing and logistics side of holiday hiring. That is a little bit more surprising with the rise of e-commerce, and I think it certainly says a little bit more about the labor markets itself than it does about retailers' expectations for consumer spending this holiday season. When we talk about Amazon, they haven't made an announcement yet. They typically have announced about 100,000 hires temporarily during the holiday season, and they're the biggest player. They're driving a lot of change. 2 years ago when they increased their wages to $15 an hour, it really shocked the system. So we can expect to see some announcements from them coming in the next couple of weeks here.
Andrew, I follow your CEO departure data very closely. How do you explain a lot of the shakeups we've seen in C-suites since pretty much since the summer?
Yeah, there's not a simple answer. A lot of it has to do with being in the longest expansion in American history. There are certainly some CEOs that are taking this moment in time to step down when their company's on top. They can cash out at a good time. They can put into place their succession plans, which they may not have the luxury of doing later on. But we're also seeing a lot of these founder CEOs that created companies out of nothing, and as they've come into a new life cycle, are deciding the boards are deciding to move them out. And then kind of a third main reason is that we're seeing people leaving those areas for a number of different reasons.
That's going to do it for us today. The Dow, the record, and those other ones too. That's all for now from New York. You're looking at it. I'm Jen Rogers with Miles Edlin. It's the final round on Yahoo
Party
Finance.
on, party on. Great job.